Good morning, everyone. Thank you for joining us for the 2024 Agricultural Tax Issues Seminar today. I will be turning it over to Christine to get started.
What I want to start with is just I like to give every class we have and sort of one of the popular things that I encounter out there on the road is you all want to know what the latest is on important things that you're dealing with for your clients. And so kind of the hottest topic this year has been the beneficial ownership information reporting, even though specifically it's not tax related, it impacts you all as tax professionals because your clients are looking to you. I was at a conference in Kansas City a couple of months ago with a bunch of farmers. It was a room full of farmers, and I was talking about the importance of them filing their beneficial ownership information reports. And one of them raised their hand and stood up in the group and said, "Well, this is irrelevant to us." And I said, "Well, why is it irrelevant to you? Do you not have an entity?" He said, "Oh, no, we have LLCs." I said, "Well, why is it irrelevant to you?" Because he said, "Because this is what my accountant does." I said, "Oh, well, did your accountant say they would do this for you?" "No, but this is their job." And so even though we've had a lot of questions about whether non-attorneys can help clients with beneficial ownership information reports, bottom line is our clients look to us, even if you're a non-lawyer, to say, "I don't know what I'm doing." So I know a lot of you have been out there educating. So the latest on this is that a court in the Eastern District of Texas back on December 8th said stop, enjoin the law. So currently what that means is there is a preliminary nationwide injunction that says that the FinCEN agency that's responsible for enforcing the penalties associated with the beneficial ownership information reporting, cannot enforce the law, and that is nationwide. Now, there was another injunction back in March, but that was a narrow injunction that only applied to the plaintiffs in that case. So right now we're operating under this injunction that has said only stop, you can't enforce the law right now. And a lot of people, a lot of your clients might want to say, "Oh, good, I don't have to worry about the Corporate Transparency Act anymore." But unfortunately, that's not what this means. And that's just what I want to give us an update on today, because what happened is immediately December 5th, the federal government filed a notice of appeal right up with the U.S. Court of Appeals for the Fifth Circuit. And so the federal government is asking the Fifth Circuit to lift the stay. So they want to just get back to action. They want to get back into the filing. And FinCEN issued a statement, and what FinCEN said, and it was on December 8th that FinCEN issued their statement. It was on December 3rd that the injunction was issued. But what FinCEN said is, okay, while the litigation is going on, we'll comply with the order, but for as long as it is in effect. So it leaves us in a little bit of a quandary, in my opinion, because what could happen at any time is that the Fifth Circuit could lift the injunction. And if it is January 6th, for example, that they lift the injunction, there's no court and no agency and nobody yet who has said, "Oh, at the time the injunction is lifted, you will have a reasonable period of time to make your filing." That hasn't been promised to anybody. So that's the difficulty of this issue. In a lot of cases, you have to say, what does this mean? Well, right now we have to really, if you are at all involved with the beneficial ownership information reporting, even if you're the person that is just educating or answering questions for your clients, it's something that we have to be watching very regularly. We do update people on our website on www.calt.iastate.edu. That information is at the beginning of your slides, but we regularly post blog updates and things. If you're looking for a place where you can get the latest information on this or any other ag tax issues, that is a place you can go. But a lot of clients, a lot of people subject to this reporting are going to go ahead and voluntarily make their reports by the end of the year. And the reason is because they just don't want to have to worry about that uncertainty of, if the injunction is lifted, do I have to make the report that day, or what's going on? So the AICPA has given this advice. They say, we don't know what the Fifth Circuit is going to do. We continue to advise members that, at least if you're assisting at all with BOI report filing, continue to gather the information, continue to prepare to file those reports in case the injunction is lifted, because it's sort of one of those times. So my question, this is a polling question, and it gives us a chance also to just kind of talk about this a little bit. Do you think that most of your clients will continue to voluntarily file these reports? I'm going to go ahead and launch this poll. And again, I think that there's something in the question box. I'll look here. 34 in Morgantown, West Virginia, 33 on the Hill. Cool. If anybody wants to open their mic during polling time and talk, I'd love to know you're out there. So looks like 67% of you say no, and 33% of you say yes. And that's kind of been my experience too. But I think we are going to talk a little bit more about the big questions that have come up with the beneficial ownership information reporting, just because it is something that the questions I've heard most are what I want to address today. So I'm just gonna forward through and say, we know that there's more than 32 million businesses that are subject to this reporting that were in place before January 1st of 2024. And there's additionally around 6 million new entities that are subject to this reporting. And of course, it's administered by FinCEN, that agency that does the FBAR report that some of you may deal with, others of you do not. We did get guidance about a month and a half ago in terms of what's been happening with the data that's gone in. And so some of your clients may wonder about that. And so the information has been disclosed already to federal agency users that have accessed it with a need. That started happening in the spring. Treasury offices started being able to access the information over the summer. Law enforcement, national security, they started to be able to access it over the fall. Notice that it doesn't prevent FinCEN from using the data, the injunction. It just prevents them from enforcing it. So it's kind of interesting. The intermediary federal agencies haven't gotten access yet. And then the banks, there has to be new rules written in order for the due diligence and everything to fit together with the Bank Secrecy Act. But that will come next year if this injunction is lifted. And honestly, I don't know what will happen, because multiple courts have looked at this. Most of them have really not gone the line of this is unconstitutional. 2 courts have said they think it's unconstitutional, but just to know how the posture of this case works, there wasn't a decision on the merits. What a preliminary injunction is just, well, I think you have a really good case, so I'm going to enjoin the law before we decide. And we'll look at the matter and we'll decide whether it's unconstitutional later. So the guidance that's been enjoined is here, the FinCEN guidance. I still think the very best resources, if you're helping clients who continue to file or just have questions about preparing, you might not be filing, but just helping clients prepare to file in case the injunction is lifted, is still the small entity compliance guide. And then the FAQs are really the best resources out there. And so some of the biggest questions I think that we get from clients and farm clients, people who have farms that call in, they get really confused about who is required to file, who is not. So we know that the rule is, if you had to file a document with the Secretary of State's office in order to become an entity, that's when you have to file. And I've had some interesting calls throughout the year. One of them was from a retired doctor in my area of central Iowa who owned a lot of farmland and had it in an LLC. And he called me and he was so frustrated because he had called around, he said, to 3 different Iowa agencies and 4 different federal agencies, including FinCEN. And he said, nobody can answer my question. I said, well, what's your question? He goes, I'm just asking if I have to file this darn report I've heard about. I said, well, what's your situation? He said, well, I have an LLC that owns farmland. I said, well, do you have any employees? He said, no. And I said, well, then you have to file. He goes, well, how would you know that? And I said, well, he goes, I don't know what a document is. I go, what? He said, well, I've read the law and it says that you have to file if you were formed by filing a document, and none of the agencies could tell me what a document was. I said, well, when you set up your LLC, you had to file your certificate of organization to create the LLC. That's your document. And I tell you that story just to say that, you know, some things that are second nature to us, even very smart clients just may not understand. And that's why it's important to educate. There's also confusion about, okay, well, I have a partnership with my brother and my sister. Do I have to file? And the answer is no, unless you're a limited partnership that filed with the Secretary of State's office to get liability protection. If you're a corporation, you have to file, whether you're under the tax S corporation rules or whether you're under the C corporation rules. It doesn't matter. If you checked the box and your LLC, you still have to file, even if you're taxed as an S corporation. None of that matters. Now, the only one that's a little bit weird is trust, and people get confused about that. And no, generally, you do not have to file if you have a trust. You just have to watch, though, because a lot of trusts are going to own membership interests, for example, in an LLC. And if the trust owns a membership interest in the LLC, the trust isn't the beneficial owner. Instead, it is the trustee or it is the beneficiary of the trust. So that's where trusts come into play. Now, there are the 23 exceptions to the rule that also cause confusion. And so we just have to remind clients, you cannot just look at the category. If we rolled down the categories and we said, oh, number 15, accounting firm, I'm exempt. Most of us are not exempt because in order to be exempt under an accounting firm exclusion, you have to be large public accounting firm that is subject to the Sarbanes-Oxley Act, which is not most accounting firms. So again, I'm going to highlight just common questions that have been answered to try to kind of just answer some of those that I hear over and over out there in the field. And so the first thing is large companies are exempt. And so this kind of flies in the face of everything else that usually happens. Usually it's the small people who are exempt, but here it's only the large operating companies that are exempt. And you're a large operating company if you employ more than 20 full-time employees, if you have more than $5 million in gross receipts, and you operate on physical premises in the United States. Now, with all of our other tax laws, folks, right, if I want to be able to use cash accounting or not have to report inventories, I want to stay below $30 million in gross receipts, right? But if I own multiple entities, IRS makes me aggregate all of the gross receipts from all those entities to reach 30 million. Can I aggregate here in order to get up to the place where I'm going to get to be a large operating company? And the answer is no. So if you have 5 related LLCs with your farm business, and if you add them all together, you have 50 employees and you have $7 million of gross receipts, it doesn't matter. You have to look at each one of them separately. So that's another unique thing about this law. Another thing that causes a little bit of heartburn is the idea that you have to report dissolved entities, even if they dissolved in 24. So we might look at the deadline and say, well, an entity that existed before 24 is not subject to reporting until the end of 24. So as long as I dissolve before the end of the year, I'm okay, right? And FinCEN has said no. The only way that a dissolved entity is exempt from reporting is if they completely, formally, and irrevocably dissolved before January of this year. And so that is important because irrevocably means most likely that if you were administratively dissolved, where you just have to file something back with the. Hello, is somebody here? Did somebody ask a question? There's also some scribbles on the screen. I'm not sure if somebody was taking notes, but I don't know if those can be deleted, but it's fine. But there's scribbles on the screen. I'm not sure where
I
those
should
came
be able to
from.
take care of them. They're annotations that
Okay.
you can do. I'll
Oh,
take care of it.
perfect. Okay. Thank you. I just don't want us to get too many scribbles on the screen. But we only don't have to report if we were irrevocably dissolved. So if you were administratively dissolved, you usually have the ability to go back to the Secretary of State's office and say, oh, I'm sorry, I didn't file my biennial report on time, etc. And they just restore you. And so if that's the situation, a client would still be on the hook to file in 24. Also, if they had finished doing everything, they dissolved their business by distributing all, let's say it's a limited partnership, or an LLC, and they distributed all of the assets out to the people, the land, the equipment, everything was distributed. They were all done operating last fall. But the last thing they had to do was to file the articles of dissolution with the Secretary of State's office. And they did not do that until January 2nd of this year. The guidance says, oh, they still have to file here in 2024. So it's kind of not intuitive. Also, what about after you have reported? You have to file updates, as you know, if anything changes, like your name changes, etc. So when you terminate, if you did file, let's say you terminate, do you have to file a new report to say you terminated? And FinCEN says no. FinCEN does not expect a reporting company to file an updated report when they dissolve. Okay, but what about the obligation to update personal information after you dissolve? Interestingly, the law says here, FinCEN retains applicant and beneficial ownership information on an ongoing basis for at least 5 years after the reporting company terminates. Until we get further guidance, it would almost seem like you have an obligation, if you were a beneficial owner of a company that has made a report, to file an update. For example, that company would have an obligation to file an update if somebody moved. So the information is out there for the company, but if any of that information changes with respect to the beneficial owners, we have an obligation to update that report. So this is real onerous, and we'll just see what the courts end up doing. But in the meantime, we do have to understand how all this works, because it could go back into play literally at any time. Now, if you do not meet the definition of a dissolved entity, make sure that you check the inactive entity status, because that is another exemption. And so for a company that was in existence before January 1st of 2020 and essentially hasn't been doing business since, they will meet the definition of inactive, and they will be exempt from reporting. The other thing that has come up time and time again, and there aren't a lot of agricultural businesses that are tax exempt, but it's an important thing in this space, so I don't want to ignore it, is which tax exempt entities are exempt from reporting. It's not all of them, as you know. It is the 501c3 tax exempt organizations, the 501c tax exempt organizations as listed in this chart, but it is not any homeowners associations or community associations. And I'm just curious with this group here, you all are a diverse group, I think, of tax professionals. And so outside of the ag world, I'm curious just what type of representation you do. And so I'm going to ask the third polling question here. Gonna get used to these polls. And I'm just curious if any of you out there represent any sort of community associations. Now, I'm trying to launch this third poll and I wonder what is going on that it doesn't appear to let me launch it. So I might need Lisa to help me with that. Let's try one more time. Oh, I think that I didn't end the second poll. That's the reason. Launch the third poll. There we go. Do any of you represent homeowners associations or anything like that? Just curious about the mix, and it does look like a lot of you do. So that is helpful to me. I figured you were a fairly diverse group of clients that you have. And so I thought it would be important to tell you that the court did address this issue specifically in October in Eastern District of Virginia. So your sister state over there said, you know what, homeowners associations, housing cooperatives, condo associations, you might be tax exempt, but you're not exempt from this beneficial ownership information reporting. And
Um,
so just to know, did somebody have a question?
yeah, I have a question.
Yes.
I've been trying to research it, and everything I come up with, because it's pretty unclear on the tax exempt organizations, but I have a 501c7, and I've specifically looked for that, and it always ends up with 501c's, and it doesn't go in specifically to, of course, a 501c7 it's a tax exempt nonprofit, but it's a social club. And
Yes.
there is no exact guidance on it. And from everyone I've talked to in every seminar, they said, no, it doesn't need to report. But I'm just not sure.
Well, I think that it's here in the first exemption here, is it not? The entity is an organization that is described in 501c of the Internal Revenue Code. And then it says determined without regard to section 508A, and it's exempt from tax under 501A. And so I would say it is described in 501c. And because it's 501c6, is that what you said?
C7.
Yep. Oh, C7, sorry. And there's nothing that you have to look at in 508A, is there? Have you researched that?
No, I haven't.
Okay, and it's exempt from tax, and it is exempt from tax.
It's
So
exempt from tax except maybe UBIT, if you have UBIT.
yep, yep. And I think that is where you are able to say that the 501c7s are exempt. But if you email me, I'll track that down even more and send you, because I do want to look at 508A, but that is the reason why I think it is okay, whereas homeowners associations and condo associations are not 501c's. And this, where the court used the language 501c3, I think it was just using that because it is the more commonly understood exemption. So
Okay.
yeah, that's a great question.
Thank you so much.
Mhm.
Christine, if I can jump in here.
Oh, yes.
I think the judge did not fully understand the issues associated with homeowners associations. We have one. It is not a corporation. 501 homeowners associations will file using an 1120H. That's the form that they file. A lot of people assume that they're corporations. And what do corporations have to do? They have to file with the Secretary of State. However, we're an association. We're not a corporation. We're not even akin to a 501c3 or a 501c. And we do not file with the Secretary of State. That seems to be the bright line test. As to why we're being drug into this is another question. Even in spite of the court ruling, I would say that our board will not file. One of the issues is the rule is onerous in that our board turns over every year. And we have
Oh,
7
sure.
members, and that means that 7 private individuals who do not want to serve on this association because in our association, it's considered to be a burden and we have to go recruit people. So now this is an anti-recruiting law that people will say, look, I'm not going to do this.
Totally makes sense. And I really appreciate your comments on that. And not every not every homeowners association is subject to reporting. I mean, if you can make the argument that you're not, because the judge was not looking at the filing of the document issue. The judge was looking at the exemption of tax exempt. And so maybe in your case, you can make the argument that yours is not, you didn't file a document with the Secretary of State's office to become an association. So maybe you've got that hook too. Because this case was about the fact that they were tax exempt, and so they wanted the Community Associations Institute, that, as you know, is sort of an umbrella association that represents all these types of associations, and they're all very different in how they're set up. So maybe that's where you can hang your hat with the way that your homeowners associations are set up. Ours here are more likely set up with some documents filed with the Secretary of State's office. So I know this whole thing has been a total pain, and I don't even like talking about it, but I think we have to, because it's just been such a burden on all of us this year, because clients are worried. And so what has been enjoined is, of course, these deadlines. And so any reporting company that was created or registered before January 1st has to file the report by January 1st of 25. But now the court has said, oh, never mind, you don't have to do that. But like I said, they could lift the injunction tomorrow, and then we're back to the January 1st deadline. Where it concerns me isn't lifting it tomorrow. My concern is lifting it on January 2nd. And then I think the court would give us a reasonable time to comply, but you just never know. There's no guarantee. So that's what brings a little bit of angst. And then the way that the guidance was set up is that new entities that were formed this year had 90 days to file their first report, but next year that is supposed to only be 30 days. And then, of course, the big thing to me that has been a big pain, and so anybody that already filed is subject to updating reports within 30 days. And that has been a big deal. Like, if any of the information you reported changes, the deadline is only 30 days to get that thing changed. And so one of the things that has been a problem is that, as you know, once you file the BOI report, you have the ability to print out a transcript, but you can never go back online. You can never go back online. Did you have a question, Freddie? You can never go back online and access that report again. It's like, whoosh, it's gone into the black box, which is, I guess, good, because you want privacy. But you don't have any way to prove that you filed it. And if you only just need to update somebody's address, you don't have any way to just go in and update the address. So that's why I've advised people to download the PDF. And then that way you can go in and just update the one field you want to update, and then re-upload the PDF. And that's the easiest way to upload. Now, it's interesting. We've had issues. Have you all had issues where you have 95-year-old owners of entities in nursing homes who do not have a driver's license or a passport? And what do? There's no answer from FinCEN on that. If anybody has a creative answer they've come up with, let me know, but it's a problem. What FinCEN has said is, if you're filing and there's driver's license out here that's not expired, but it has a different name, it says you can use that driver's license. Like, somebody got married and they didn't update their driver's license. But I don't think that's a good answer, because as soon as they update the driver's license with their real name, then it says you have to update the report within 30 days. So, you know, no matter which way you turn, this thing has been a real pain to comply with. And so here's the portal where you go to file. Again, like I said, if you file, you basically get no evidence unless you download that transcript. So you better download the transcript, or else you will not have any proof of filing. We know that the fields that we report aren't that extensive for the reporting company. It's just the full legal name, the address, the physical address, right? We know it's the physical address because what's this report for? It's for law enforcement. So they want the physical address so they know where they can go visit you if they want to talk to you about an issue. Also, the jurisdiction where the entity was formed and the taxpayer ID number. So that is going to be for a single member LLC, just most cases, the driver's license, and that's okay. I mean, not the driver's license, the social security number. And then for every beneficial owner or capital company applicant, it's just the name, it's the birth date, it's that physical home address, except for company applicants get to use their business address. And then it's uploading that driver's license, that passport, and the image of it. And that is what we have to do. Now, with the company applicants, there's been some confusion with some people that is anybody that helps with the filing of the beneficial ownership information report. I'm sure you know that it is not that. It's whoever helped the entity set up the entity. So it's only for entities set up in 24 and later where there are company applicants, but it's the person or people who help them file the articles of incorporation for corporation, etc. And so those people are out there as well. And so for company applicants and beneficial owners, I've really advised that all those folks really get a FinCEN ID. It makes things a lot easier. I get to be in control of my own driver's license. I'm not giving it to somebody who's a representative of the company I own an interest in. And so I think the FinCEN ID is the way to go if you're still filing these reports. And the only thing though is if I go on and I create a FinCEN ID for myself, then I am on the hook within 30 days of any change. If I move across the street, I have to make that update. So that is required. The company, here's the polling question. I guess we'll find out what you think. Must a company file an updated report if a beneficial owner with a FinCEN ID updates their information? I'm gonna launch this poll if I can find the panel again. We're doing okay. We're flying through our polls here. You all are doing very good with this. I'm gonna go back and do question 4. And I'm gonna launch it. Oops. I guess the question I have here is, can the preliminary injunction be lifted at any time? So might have my questions a little bit out of order, but go ahead and answer yes or no, what you think about that. And yes, you're all saying yes, and that's exactly right. It's true. It can be lifted at any time. It is currently pending with the Fifth Circuit Court of Appeals. So that's where we're at, unfortunately, with that. So I'm going to go ahead and end that poll, and we're going to move on here. I'm sure Lisa is better at running polls than I am, but keeps me on my toes. So the answer to the question I asked before the polling question, which was different, is if I have a FinCEN ID as a beneficial owner and I move across the street, I have to update my FinCEN ID information, but does the reporting company have to file a new report? And the answer is no, because they are tied to my information via my FinCEN ID number. So it's just me who has to update my information, but the company is still going to be on the hook to make sure I do that. So, you know, it's a little bit difficult because people are going to be in charge of making sure that their beneficial owners are really doing what it is that they're supposed to do. So we know this, but just a quick review, and also to say, you know, if there are specific questions you're dealing with, like the questions that have come up already, this is great. This is why this class is going to be helpful. Like the size of it is great because we can just ask and have conversations. And I really love hearing the issues that you're wrestling with. But beneficial owners, as we've wrestled with the definition, right? It's anybody who directly or indirectly exercises substantial control. And that's why when you were talking about the homeowners association, obviously you're right. Like the only people that would be beneficial owners under this definition would be the board, because they're the only ones that they have substantial control, and it would be everybody because nobody's singled out as the president. So it's been a real predicament. And it's anybody that owns directly or indirectly 25% or more of the ownership interests of the company. So we know that the substantial control prong has been a little bit of a challenge because all the senior officers or people with fancy titles, all of them are definitely beneficial owners. But then there's some that it's just a facts and circumstances test. So in the typical company that has officers, and then you also have a board of directors, sometimes the directors are not beneficial owners because they do not have substantial control. So FinCEN has told us it's a case-by-case analysis, which is a little bit murky, a little bit ambiguous, but we have to kind of make that determination. Also, FinCEN has said that the breadth and the depth of the substantial control definition that they've provided is so broad that every reporting company is going to have at least one beneficial owner, and it's going to be that person that has substantial control, even if they don't have anybody that owns or controls 25% or more of the ownership interests. So that's the second way that you can be a beneficial owner, of course, is to have a direct or indirect ownership interest of 25% or more. But it's not just direct. It's not just owning stock or membership interests. It's also owning like a profits interest or something that's convertible into a capital interest or an option to buy an equity interest. All those things count under the definitions provided by FinCEN. Also, joint ownership counts. And I don't know if you practice in any states that have community property. Here in Iowa, we're close to Wisconsin, and I work a lot with people in Texas, and there are community property states around. And the glitch with community property states is that if I'm, for example, an owner of a single member LLC and my spouse doesn't have an ownership interest, the community property laws of my state likely deem him to be also an owner of my ownership interest. And so we've said, and FinCEN has suggested as well, that the spouses of owners are also beneficial owners in community property states. So another thing that makes this difficult. We have some exclusions, but not too many. I don't know how often you've dealt with it, but the minor children do not have to be reported, but we have to report their guardians. So it doesn't really help us a whole lot. The polling question, can the preliminary injunction be lifted at any time? You already answered that. So we're going to move on to penalties. And this is why we're talking about it. And this is what has been enjoined right now. There's no penalty today, at least at the last time I checked before I came online today, because of the injunction. But if the injunction is lifted in 24, the penalty was $591 per day. And that's why this has been a big deal. And who's responsible for the penalty? Well, both the reporting entity, but also individuals. So those people who have substantial control could be liable for the penalty for not filing properly. Those people who are beneficial owners who have a FinCEN ID who do not update it properly, they could be held liable. All of that. And then on this side, I told you the story about the farmer who said it wasn't his problem, it was your problem. It was the problem of his accountant. I think FinCEN has propagated that myth a little bit with some of its guidance. So if I'm a farmer that goes on to the FinCEN information and I read this question, is a reporting company required to use an attorney, a certified public accountant, an enrolled agent, or any other service provider to submit beneficial ownership information? And of course they say no, but then they say reporting companies that need help can consult with professional service providers like lawyers, like accountants, and like enrolled agents. So they've been told to talk to you, right? To say, hey, I have questions about this. Can you help me? And I think some of you have been helping, some of you have not, because of the question about unauthorized practice of law. We're not going to go into all the details of that. Now, here in Iowa, our Supreme Court did weigh in this year to say that, helping someone file a BOI report, helping someone determine whether they need to file a BOI report, and helping them to do general determinations about how this process works is not the unauthorized practice of law. So I think across the country, that's pretty much been what the different decisions have been, although we haven't had a lot of them. Where we cross the line is if we have maybe a trust that owns a limited partnership that owns an LLC, and then we're trying to read all these documents that are legal documents and interpret who the beneficial owners are, then I think I'd refer it to a lawyer. But otherwise, I think the big thing is, I know that was quite a bit of discussion about beneficial ownership information reporting, but it has been the hot topic this year. I don't think there's been a tax course this year that hasn't covered it, even though it's not a tax law, but it's just kind of the hottest thing going. So stay tuned. Like I said, watch out. If you have any specific questions, reach out to me. I've been following this closely and I do love to talk about these issues, but we're done with that. So now we're going to move on in our workbook, and we're going to start with page 68, where we're going to talk about the next hottest thing that's been talked about this year, and that is the fact that it's 2024 and next year's 2025, and we have a whole bunch of tax provisions that are expiring. So they have expiration dates in the tax code of December 31st, 2025. And we have that going on, but we also have the idea that at the time that these provisions were passed back in 2017, if you remember, it cost $1.5 trillion to, over 10 years, to implement the Tax Cuts and Jobs Act. And 1.5 trillion of that was to reduce the corporate tax rate from 35% to 21%. Now, CBO estimates it would cost 4.6 trillion to extend provisions of the Tax Cuts and Jobs Act over 10 years. And so this is where we're at right now. So a lot has changed this fall. We had an election where now things look different maybe than they did in October as people were prognosticating what was going to happen. We have a little more information. We have a few more pieces of the puzzle, but there's a lot going on. Right now, for example, we know that they have to get out there and they have to extend the Farm Bill because the Farm Bill has expired. And it hasn't really been that big of a deal right now. The only thing you can't do is sign a new CRP contract for example, but you'll still get payments on the things you've been doing. But if they do not get their act together by year end with the Farm Bill, then all of a sudden we go back to milk quota prices that are from the 30s. I mean, things would definitely go crazy. So I can't imagine a scenario where Congress won't do some kind of extension with the Farm Bill. We'll talk about that a little bit later this afternoon. But that is just one of like a million pieces of the puzzle that have to happen. And so no one really knows what tax code will look like next year at this time, because we've had the House say that they would prefer to get a tax bill passed early in 25. And I say, amen. I think that's what every tax professional would want, is the tax stuff settled by March or April, so we know what we're doing. Senate has said, well, we have other priorities. We want to work on the border bill. We want to get the defense bill. We want to work on healthcare. We got trade issues. We want 2 sets of legislative packages, and we want the tax bill to be the second piece. So that would push it to later next year. And incorporated into that would be climate pieces from the Inflation Reduction Act that many in Congress would like to get rid of, pull back money, all that. We're going to talk about all that later too when we're talking about the tax credits that apply to farmers under the Inflation Reduction Act. But all that to say, we can just do the best that we can to sort of give our clients good information. I pulled this from the September issue of the Tax Advisor, and I think it's still appropriate today, even though we've gotten through the election. The election gave us what? Well, we have all three, House, Senate, and presidency, controlled by the same party. Interestingly, though, the margin in the House is maybe going to be 1. That is much slimmer than it was back with the Tax Cuts and Jobs Act. We all kind of lived through that. We know how hard it is to get any sort of legislation passed, and so it's not going to be an easy road. It's not just like, oh well, Tax Cuts and Jobs Act, it'll be extended. There's a lot that could happen in there, a lot of bargaining chips that could be used. So I don't think anybody really knows exactly what things will look like. So it's our job to make sure that we're staying well informed, so that when clients are asking, we're giving them the latest information, we're giving them good information, and we're not lost. We're not just like, I don't know what Congress will do. So I'm going to start with the 3 provisions that were actually put in a House bill that passed bipartisan support by a wide margin at the beginning of 24. This is kind of interesting, right? So we had a tax bill that looked like was going to pass. It passed the House with flying colors, and then the Senate shut it down. And so these are the 3 provisions that are also part of the expiration in 25, even though they've already been changed. So the first one is the business interest deduction limit. This is, of course, one of those limits that only applies to entities that gross $30 million or more, or to syndicated tax syndicates also are subject to this as well. And this was put in place by the Tax Cuts and Jobs Act. But when it first went into effect in 2018, it wasn't so onerous, because of course what it says is you are limited in your deduction for business interest to 30% of your adjusted taxable income. All right. But when you're figuring your adjusted taxable income, we're going to let you add back in all of your depreciation, all of your expensing, and all of your amortization. So what does that mean? It means your adjusted taxable income is here. So 30% of here is here. People weren't thrilled about it, but it wasn't crushing. It had a trigger in there because, of course, this is part of what we're going to see this year as Congress will be negotiating a new tax bill, is you have to have some give and some take. And one of the hair triggers in here was, well, we need more pay-fors. And one of the things that we can do is to put in place a situation where adjusted taxable income, you do not get to add back a depreciation, expensing, and amortization. But we don't want to do that right away, so we'll make that happen in 2022. And so that's what happened. It was a hair trigger. I think Congress thought, well, we'll be able to extend this thing before 22. They weren't. So in 2022, some of you might have had clients that got sucked into this. Your adjusted taxable income is determined outside of any of your expensing or depreciation. And so 30% of this is this. So 30% has become very onerous for businesses impacted by that. There's been a big call to go back to the way it was initially with adding back those extra items. The other issue that we have, farming businesses, of course, aren't subject to that. If they want out of it, they can get out of it, but then they're forced to use ADS for any of their larger assets. They can't use bonus, they can't use anything. So it's a huge trade-off. Research and development expenses is the other issue that really got crushingly difficult for some select entities in 22. In the agricultural sector, there are companies, that are researching new seeds, that are researching new drones and new crop production technology, all kinds of stuff in agriculture that's impacted by this as well. Software companies really hit by this. And of course, this was prior to the Tax Cuts and Jobs Act. Your research and development expenses would be presently deductible. There was a provision in 174 that allowed you to just deduct those expenses. So if I had a couple of employees over here that were devoted to research, I could deduct their wages like any other employees. I'd be okay under Section 174. What the Tax Cuts and Jobs Act did is, again, not implement this in 2018, not to make people upset right away, but to have a hair trigger that went into effect in 22 that said, oh, now we're in 22, we have to amortize those expenses over 5 years. So for those companies impacted, this thing is huge, because if I have a unit of employees that are working on research, I can't even deduct their wages anymore. I have to amortize those wages over 5 years. Very difficult. Again, another bargaining chip in this whole thing that's happening next year with negotiations of a tax law. Also, the Tax Cuts and Jobs Act allowed 100% bonus depreciation through 2022, as we know, but then it too started to phase out. So for our clients that use bonus, and of course, bonus is something that's automatic. You have to actually make an election out of it. Sometimes we start relying on software so much. Just a word about a year ago, I was at a seminar, and one of my longtime attendees who had always practiced for like 30 years, she told this terrible tale of how her software hadn't been making the election out. She hadn't realized it, just a terrible thing. And so what a mess, right? To think that you were electing out, but you weren't electing out, but yet you weren't actually depreciating. You weren't taking the advantage of bonus. So in 23, we have 80% bonus, 24, 60%. And when the clock strikes midnight on January 1st, we're going to be at 40% bonus. So we'll be below 50% for the first time in forever. So one of the big questions, of course, is going to be, this is one of the more favored provisions. So I would expect that we would maybe go back to 100% bonus. It seems to get scoring that generates economic stimulation. So it seems to not be one of the big numbers hits that makes it hard to put into a tax bill. However, it's just difficult to know, are they going to go retroactive? Are they, what would they do? So again, we just have to watch. So question for you, I think we got the polling question out here for this one. Where do you think tax rates are heading in 2026? Do you expect tax rates to increase? Okay, here is my polling question. And as you're answering the polling question, I want us to think about where we're at. So a lot of us, and I see like most people, there's a polling question, folks. Good. When we think through this with clients, we have to remind them that to maintain status quo, Congress has to pass a tax bill. They have to agree to something. And that's just to maintain tax rates where they're at. Now, after the election, it does definitely not appear anymore that there will be any bill that will increase tax rates in a global way. That I think is off the table. But if something expires because Congress cannot agree to do anything, that will be a tax increase by virtue of the expiration of the Tax Cuts and Jobs Act. So there's a lot of factors at play. And so we just have to kind of watch and see, and then also just educate clients on what's going on. So that's why I want to just remind us of which provisions are expiring, which ones are not, what's going to be at stake, and all of that. So with our farm businesses, right, the Tax Cuts and Jobs Act across the board, as we know, really lowered tax rates. If you read the popular press articles, though, which our clients do, and they get bad information from them a lot of times, it just says, oh, somebody that's in the 24% tax bracket would go up to the 28% tax bracket. Somebody that's in the 37% tax bracket would go up to the 39.6% tax bracket. But that's just simply not the case because of the way the tax brackets are structured. The bigger part of the story, as you know, but your clients don't. So a lot of what I'm telling you in this section is information that you can convey to clients so they can kind of keep track of what's going on. Is the income rate at which you would go into that next tax rate. So for example, right now in 24, if you're married, you have to make $731,000 in order to be in the top tax bracket of 37%. If the Tax Cuts and Jobs Act provisions that lowered tax rates across the board were allowed to expire at the end of 25 as scheduled in the law, then you would reach the top tax rate of 39.6% when you hit $585,000 of income. Pretty significant difference. Now, I also want to talk about this group in here, the 24% tax rate bracket. And I have a little picture. I'm not very good at charts, but I wanted to kind of show you how this works. So you can see from this chart that a large swath of income that's currently taxed in the 24% bracket right here on the top in 25 would be taxed not at the 28% bracket, but at the 33% rate, just by virtue of how the marginal tax brackets work and where the income cutoff points are. So it could be very significant difference for some folks. The other thing that is up for negotiation, because this too is set to expire, is our doubling of the standard deduction. Now, I think it's really cool that next year in 25, we actually have round numbers, right? And accountants, tax professionals are taught to avoid round numbers. It looks suspicious. But next year we would have a $13,000 standard deduction for singles, and we'd have a $24,000, or sorry, $15,000 deduction for singles and a $30,000 deduction for married filing joint. That's not on your screen because those are 25 numbers. For the returns that we're dealing with in 24, the standard deduction is $29,200 this year, $14,600 for singles. And this has made a world of difference in terms of who's even required to file all of that. But and people are not itemizing, and they're not itemizing because of the high standard deduction, but they're also not itemizing because, of course, the miscellaneous itemized deductions went away. Those would come back. Also, what would come back is the personal exemption. Now, USDA has done a little bit of work on what the impact of the expiring provisions would be specifically on farmers. The USDA's definition of farmers is generally different than mine, probably of yours as well. If they call a farm large, it's probably moderate in my mind. And if they call it mid-size, it's probably fairly small. But you can see that the percentage of change in tax liability attributable to the tax rate change alone is pretty significant. Now, one of the big things that everybody's wrestled with over the last 6 years, really, because after the Tax Cuts and Jobs Act went into effect and it put a cap on state and local tax deductions, then they got the creative solution across the country. Different states popped in to say, oh, we're going to have a pass-through entity tax, and the whole system created only to be able to avoid this $10,000 cap. Very frustrating. But this is one of those things that we don't know where this thing will land. There's been proposals to maybe increase it to 50,000, or maybe eliminate it altogether, or maybe, who knows? But the whole pass-through entity tax that has been so difficult for us to navigate, it's most likely going to be in a state of flux as well. Home mortgage interest deductions. This was actually a pay for in the Tax Cuts and Jobs Act. So it'll be interesting to see if it stays where it is or if it goes back to where it was. Remember, you used to have a $1 million deduction for married couples who were filing jointly, and now it's $750,000. And also, we don't have the ability to have home equity loan deductions for home equity loans for any purpose, only for expanding or improving our current home. The charitable contribution limits, very slight changes there. Personal casualty losses would return. That's really huge. All of the federally declared disasters that we've had this year, you do have personal casualty losses available in those federally declared disasters, but otherwise there haven't been any available to us since 2018. And the PEAS limitation would come back. We have to brush off our books to remind us what that is. One of the big bargaining chips will be the child tax credit. So right now, of course, we have a $2,000 child tax credit. That is because of the Tax Cuts and Jobs Act. It was $1,000, but the bigger story there, and I don't think this will go away, but you don't know, is that in the pre-Tax Cuts and Jobs Act days, remember, you had phased out that child tax credit as a married couple starting with $110,000 of income. So many fewer married couples, singles, because singles started phasing out at $75,000. Many fewer parents were eligible for that measly $1,000 child tax credit. Today, it doesn't start phasing out till you reach $400,000 of income. So that's sort of a big deal. This is a huge bargaining chip we'll see discussed a lot, especially in the days of COVID. You know, remember we had a $3,600 child tax credit for some folks. I've put here the chart that shows the impact on farm families of the child tax credit as depicted by the USDA. You can take a look at that. I think the biggest provision that impacts our farmers and our agricultural communities is 199A. And I would suspect that Congress will do everything it can to extend 199A. But again, we just have to sort of watch what happens. So this is not just our 20% QBI deduction. It is also the whole DPAD that went away permanently, right? The 199 DPAD that we had way before the QBI deduction in the agricultural sector for agricultural cooperatives, that was permanently ended. So the question is, will DPAD return in 26 if Congress makes no changes? Let's see if I have a polling question out there. If I don't have the same polling question, we'll ask something else. Let me go to polls here. And these polls are great times too. If anybody has anything they want to share or say, just open your mic. It's much more interesting to hear somebody else talk than just me. Let's see what these are. Gotta find my polls. Doing good with your polling questions, everybody. Yep, this is the one. Are you ready? I'm going to launch it. Will the DPAD return? At least I think I can launch it. I think I have to close something else and pull. Launch. Okay. Will the DPAD return in 26 if Congress makes no changes? What do you think? Going to go ahead and give you a little bit of time because remember, DPAD predated 199A. That was something that was there. And so actually the majority of you are saying yes. And the answer is no. DPAD will not return if Congress makes no changes because the Tax Cuts and Jobs Act permanently ended DPAD, and the 199A put in the 199AG provision, which is basically a simulation of our old DPAD, the 9% deduction that's passed through, but that has to be renewed by Congress in order to survive. And so that is where we're at with DPAD. The corporate tax rate reduction is permanent. So again, there's a lot of issue in this bill that will be discussed this year with a lot of impact to our clients. So we'll have to be watching that to see what happens. Here is the USDA's chart that says what they think the impact of the 199A deduction going away would be for agricultural businesses. All this is in your materials. You can look at it more closely. Now, one provision that was not in the Tax Cuts and Jobs Act, but it has been passed outside of that, and this is just another piece of legislation that will need to be decided. Is it going to be renewed or is it going to end, that impacts agricultural clients? And that is the increased Affordable Care Act subsidies. So I think most of you are familiar with the fact that at the time of the American Rescue Plan Act, and in 21, and then the Inflation Reduction Act in 22, Congress extended and created a new provision that said that you could be eligible for a premium tax credit even if your income exceeded 400% of the federal poverty limit. So it's like this. It's like I am a married couple. Let's say my husband and I make $70,000 a year. We might be just over 400% of the federal poverty limit. In 2020, I was not eligible for a premium tax credit, so I could not get insurance on the marketplace. In 2024, I can. And the rule that Congress changed is they said, okay, no matter what your income is, if the cost of the second lowest cost silver plan on the marketplace, if it would cost you more than 8.5% of your household income, we will give you a premium tax credit to make up the difference. So even if you're at 600% of the federal poverty limit, and as you know, the cost of insurance is so high, and in the agricultural sector, many of our clients are self-employed, so they're not offered insurance through an employer. So this has become very common for people to go on the marketplace. They go on, they maybe get a high deductible health plan, they get, and then they can have an HSA, like all kinds of arrangements like that, but they're getting their insurance on the marketplace. And the premium tax credit is pretty generous because let's say if I'm pushing 60, my cost of my insurance is going to be really high. Just for a couple, it might be $30,000 to have a year of insurance. And that's going to be over 8.5% of a lot of people's income. So the premium tax credit in that case is going to be significant, maybe $20,000. And so I can do that now. If this is allowed to expire at the end of 25, I wouldn't be eligible for a premium tax credit. I would be required to pay all $30,000 out of my own pocket, even if I only make $70,000. And that's just probably not going to happen. So that is another issue that is on the table with Congress. Now, AMT, we've been operating under really high exemptions, really high phase outs. All of that would go back down under the Tax Cuts and Jobs Act expiration as well. And then the last thing in agriculture that when we look at this, we have to realize, okay, now wait a minute, this isn't a expiration thing. This is something that the Tax Cuts and Jobs Act actually put in place. And that is, we've had many farm corporations that provide meals for employees under the de minimis meals exception. And so there's two different provisions that are out there, but the one that was changed by the Tax Cuts and Jobs Act was it used to be that corporations that did that got to take a 100% deduction for the cost of those de minimis meals. In 2018, that went down to 50% because the Tax Cuts and Jobs Act said, wait a minute, we're only going to give you a 50% deduction. But in that law is built in an automatic change in 26, which brings that down to a 0% deduction. So what it means is that corporations that are providing meals for the convenience of their employees are not going to be able to take any deduction in 26. I don't think Congress will change that because that was the intent of the law back in 2017 when they passed it. The thing that I want to highlight though is this does not change the fact that under Section 119, an employee who receives a meal for the convenience of the employer, for example, they provide the meals on site to the workers in the fields, they get to exclude that from their income under Section 119. That is still in place. So just a little thought about meals. Then we have this provision that was put in place by the Tax Cuts and Jobs Act, but it has been a continuous well of money from which Congress has drawn. So it's already extended through the end of 2028. And I just expect the Tax Cuts and Jobs Act, it could make it permanent just to have extra funds to pull in. And that is the excess business loss limit rule. So if you have a loss that exceeds in 24, $610,000 for your married clients, that loss is disallowed. You have to carry it forward as an NOL. So I don't think that will go away. Also, things that are permanent. So as we're talking with clients and thinking through things, we remember things that were changed by the Tax Cuts and Jobs Act, but we're like, is that going to come back? And the first one is, remember, like-kind exchange with our property, our equipment, our tractors, and all of that. That is not coming back. That 4-letter word real that was added to the 1031 code is there to stay. So we will not get our like-kind exchanges back for farm equipment and vehicles. Also, vehicle depreciation, we had a lot of increases for passenger automobiles. Those were here to stay. Those are not going away. Net operating loss restrictions, where if you carry it forward or you carry it back 2 years for farmers, we can only apply it against 80% of our taxable income. That is not going away. Cash accounting, remember that was expanded in the farm sector. We've always been eligible for cash accounting for partnerships and non-corporate entities, no matter how big you were, as long as your income was not distorted. But for C corporations and partnerships with a C corporation partner, there was a really low limit that you had to have in order to be eligible for cash accounting. And the Tax Cuts and Jobs Act raised that. So in 24, it's $30 million or less, and you can use cash accounting. So that is here to stay. And then the rules that we got for farm machinery, where we suddenly could use the 200% declining balance method. And if I buy new equipment, I got 5 years instead of 7 years. Those were permanent changes as well. So question, was capital gain modified? Will that change? And remember, the Tax Cuts and Jobs Act did not modify our capital gains tax rates. It also did not modify the income tax brackets that apply to capital gain. In fact, the top tax rate for capital gain is more akin to the top tax bracket that used to be in effect before the Tax Cuts and Jobs Act for ordinary income. And so in your workbook, figure 2.6 shows the 2024 capital gains tax rates. And so here's an issue too with clients, that I get calls like this, and I just want to make sure that you realize how your clients might think that doesn't really make sense to you as a tax professional, because you don't think this way. But they read articles in the public press that kind of give a misunderstanding of how this works. So I had a couple calls this year, which is really funny, where somebody called me and they said, so I have talked to my accountant and they don't understand how the capital gains tax law works. And I said, well, what do you mean? And they said, well, I read an article on msnbc.com that said that if I had less than $94,000 of capital gain in 24, that I wouldn't have to pay any tax on it. And I sold, $90,000 I had $90,000 of gain from stock that I sold, but my accountant says I still have to pay tax at a high. I have to pay tax on that. I'm not in the 0% rate. And I said, well, was that your only income? And they said, oh no. And it turned out they have all kinds of income. I said, well, that's not how it works, right? So I think reminding clients that this can be a helpful tool, but that the ordinary income comes first, and then the capital gain goes on top of that. So the capital gain is going to get pushed into that next income tax bracket, if you have enough ordinary income to push you into that, but also to remind us that it can be a planning tool for certain groups of people. Maybe you have a younger person who is just sort of starting out And maybe they do have a little bit of stock that they inherited from a grandparent, or maybe they got gifted it when they were young, or they have something they could sell that would be subject to capital gains tax rates. And that's a time to do it when they don't have any ordinary income, or they have low ordinary income, because if they're single, their taxable income can go up to $47,000, of course, including their capital gain, and they can pay 0% on the capital gain. So again, it's something that's kind of helpful, but not as helpful as some clients might be led to believe. The next provision that I want to highlight, because this one is hitting more and more and more of our clients. Why? Because the darn thing isn't indexed for inflation. So of course, the net investment income tax went in place back in 2013, was part of the Affordable Care Act. And at the time, we were given threshold amounts that you only had to pay it if your overall income was above 250 for marrieds and 200 for singles. And here we sit with the still same threshold amount. So I don't know, I think in the farm rental situations, especially when somebody wants to sell property that maybe they've been cash renting, things like that, it gets to be a very important provision. 3.8% is definitely not insignificant. Here's the overall chart that the USDA has provided, just in terms of, what's at stake with all these tax negotiations in the agricultural sector. And we're up to another polling question already, guys. So I'm going to see if I can open your polling question and ask you just how many of you do help clients with income tax planning. It's going to be a pretty interesting year for that. So just curious if you have meetings at the end of the year or how exactly that works. But I'm going to launch that. So if you could answer the poll, if you're still out there with me. And again, this is a great time to chime in with anything that you have that you want to share with the group for the good of the cause. You're actually almost up to a break, which is good.
Now, Christine, if you don't do income tax planning after you prepare the tax return, you're probably going to have a surprise at the end of the following year where the client has not paid the appropriate estimated taxes. So probably the most important part of income tax preparation is not the preparation itself, but the tax planning on the tail end.
Very good words of wisdom spoken from your colleague here. So absolutely, that's why we spend time talking about these things, because I don't think we're really tax professionals if we're not able to really help our clients get where they need to be with respect to that sweet spot of income and planning beyond just this year, but looking down the road. And so when I think about income tax planning considerations, right, obviously these are scheduled to expire. But given the composition of Congress and the presidency, there is this narrow window, at least, maybe at least for the next 2 years, where it looks like Congress does have the ability to extend these. Will they be able to? Probably, but it might not be what our clients might want in terms of certainty, because some of the trade-off might be, as I've read in articles from Tax Notes and other publications that speak directly with the legislators, they might not be able to extend these things for 10 years because of the cost. They might have to settle for a 3 or 4 year extension, which is really difficult for long-term planning. Also, when we have so many clients that are steering retirement down ahead, it's trying to figure out, how do I wind things down? How do I plan so that my last year I'm not faced with this incredible amount of tax liability? And what will the tax rates be at that time? Right now, it's just very uncertain. So I think that, again, as James has pointed out, it's just, we have to work with clients where they're at, educate them with the best knowledge that we have. I think avoid any high risk strategies. Like I wouldn't say, oh, we're going to just convert you to a C corporation right now. I don't think that's a good idea. But if we think, and I will say, unfortunately, we're also got another factor in the mix in the agricultural sector. And the other factor in the mix is that farm income across the country is down and is expected to go down even further in the next couple of years, just because of the way commodity prices have been going. And so that is another challenge. So maybe we expect tax rates to rise in 26. Maybe we don't. Maybe we have all the confidence that Congress will pass extensions and our rates will be just about where they're at now, but our clients' incomes are lower than they have been. Either way, whichever way we look at it, some of the strategies that we need to look at is, you know, in the farming world, a lot of times our clients are just all about defer, defer, defer. They're also all about avoid self-employment tax at all cost. I have had multiple conversations this year from farmers in their 60s who were very disconcerted because they did everything within their power throughout their entire career to pay as little self-employment tax as possible. And now when they want to retire and start drawing Social Security, they didn't have anything much to draw. And they were very disillusioned, and they were looking at their neighbors and their friends who had a fairly decent amount of Social Security, and they didn't have that. Now, they still had farmland and farm equipment and things, but that was sort of tied up. And so what they were unhappy was worrying about cash flow just for living expenses. And even they weren't necessarily retiring, because a lot of our farmers don't actually stop, but they slow down and they maybe want to travel some more, they want to do some things. And so I think in our planning, we need to help make sure that we're helping clients think through retirement strategies in terms of maybe deferral, so that we're just deferring until that bubble pops. We'll talk about that a little bit later. Might not be the best strategy. So here are some things, like if we're going to reverse that trend of just deferring everything, like if we have lower income, let's get more income into this year, pay a little bit of tax, but then next year, maybe things will look up, or maybe tax rates go up down the road. Maybe in 2 years, things flip and tax rates go up, or 4 years. Maybe we try to level things out a little bit more. So we can delay expenses and purchases. We do not have to prepay all of our expenses. I know we might be on a cycle, but we could say, you know what? Not going to prepay this year. We're going to wait, and we can still maybe get the discount for prepayment if we purchase things in January, but there's different options that you can have. And I'm just throwing these out. Slowing down depreciation deductions. We do not have to always take Section 179 or bonus. We can actually even do straight line if we choose to slow something down. We can trade or sell equipment that's subject to ordinary income recapture, and then not necessarily take that corresponding Section 179 deduction for the new equipment that we purchase. We can maximize our income averaging benefit in future years. Remember, we can always go back and fill those buckets from years where we did not have high tax rates in a year when we get ourselves pushed into a higher tax rate. And then we can choose to amortize fertilizer deductions. Now, we're going to talk a little later today about excess fertility deductions. I want to make sure to talk about that. It's been a hot topic, but in the terms of just our farmers who are fertilizing, and they're most always making the election to just deduct the fertilizer costs in the year they apply the fertilizer under Section 180. Just a reminder, that's not a required election. You can choose to amortize that fertilizer over 3 or 4 years and spread that out if you choose. You can also think about how to use retirement accounts, where more and more of our farmers are seeing opportunities if they sell grain or have a little excess. Hopefully during some of the boom years, they've taken some money and put it into some retirement accounts, IRA accounts, for example. And if you're having a low income year, it's a good time to convert maybe to a Roth. You pay tax now, but then down the road, when you retire, down the road, maybe income tax rates rise 5 years from now, then you don't pay tax when you pull it out. And so those are all just things to consider. Electing out of the installment method. So when we sell our commodities, we can sell them under deferred payment contracts where I sell it now, but I do not get my payment until January. And if I make sure to have my contract correct, then that gives me total tax options come next year when I'm filing my 24 return. I have 6 contracts. I might want to pull 3 of those installment contracts into my income in 24, even though I didn't receive payment until 25. And I can do that under 453. It gives me that ability because it says elect out of the installment method, and you can recognize income in 24. So that's a good option as well. Again, like I said, not prepaying supplies. The discount might still be there in January. Again, these are just options. And again, if your client is having a boom year where they have all kinds of income, and you expect tax rates to go down, then you just do the opposite of everything that's on this checklist. Delaying the sale of lost property until a time when you might be able to use the loss more is also something else to think about. More and more of our farmers, as I said, are looking at retirement plans, and there is a section in our workbook, chapter 6, I believe, on the retirement planning, and it talks a little bit about even defined benefit plans are an option for some larger farmers that are maybe in a corporation where they're earning a wage. And if they plan for a couple of years in those last years of farming, they can put away maybe $500,000 into one of those defined benefit plans and save tax, right? Because that's one of the big things in your last year of farming. You have a lot of income and you don't have corresponding expenses, and all of the deferral train comes to a halt, and you're like, wow, what do I do? Some farmers have been looking at defined benefit plans. Those are unusual. Those are not the staple, but I'm just highlighting that as an option for some unusual clients that might be in that category of exceptionally wealthy, needing to know what to do. And so, don't just eliminate the idea of any retirement planning. I think that SEP plans, things like that, are great options for farmers. You can still put quite a bit of money into those in years where income is higher. In terms of entity considerations, I think that right now we just are not at a place where a C corporation is a good bet for anything that holds property. We know that, and the same with S corporations. If you've got an operating entity that doesn't hold the land, and I'm not even a big fan of the S corporation holding the equipment. I know some people like that. Really, the S corporation, the reason people go into it is to limit the self-employment tax. But again, if you're following the reasonable compensation requirement, you got to look at what you're looking at is that difference between what a reasonable salary is for your person and the maximum amount of Social Security that's required to be paid. And I know that limit raises every year, so it seems like a lot. But again, we have to look at the overall picture, and in a lot of cases the disadvantage of the S corporation in getting out of the entity, pulling things out, right? If I have a partnership, if I have an LLC that's taxed as a partnership, and I'm in a farming entity and I have siblings and we all end up hating each other, and I hate those stories, but unfortunately we all hear enough of those that they just happen, right? In most cases, now we have mixing rules and everything else, but in most cases, I can just pull land out, give some to this sister and give some to that brother, and I can take some, and none of us pay tax on that. That's great. But, you know, if we're in an S corporation and we have equipment in there and maybe some land, whatever, we pull it out, it's like we sold it. And so it's so much more difficult, even though I know people get tempted to just go down that path of the corporation for the SE tax. You know, in the farming sector, I just say, let's just take a deep breath and walk through clients what the options are and whether that's really the best way to go. Charitable contributions with our farming clients, I just still love gifts of grain for any of your clients that raise that type of thing, gifts of produce, gifts of commodities. Those are such great options. So even if we go back to a place where we're able to itemize and take advantage of charitable deductions, it's still an option. I mean, here we were talking about it's not always bad to pay self-employment tax, but you can save self-employment tax even if you itemize. But of course, the biggest thing has been, so many of our clients don't itemize, they get no deduction for a charitable contribution. And so if they give the grain, they do not have to count that as income. They do not have to add back all the expenses. It's a great, awesome thing. And of course, those of our clients who are 70 and a half and older can continue to draw their QCD. They can take their, if they're 73 or older and they're taking their RMD, they can just direct it to a charitable organization through a QCD, and they don't have that hit income either. The one thing I would point out about QCDs, just to remind you that those do require the contemporaneous written acknowledgement. That's right in the law, so that is required. The gifting of grain commodities, there is no requirement built into the law because it's not a charitable deduction, but it's still probably a good idea to have that information. So I want to draw your attention to chapter 8 of the workbook. We just worked through very simple high-level overview of some things to think about in terms of accelerating farm income in years of lower income. And if you want any more detailed instructions about any things that we highlighted, like the contract deferral, the deferred payment contracts, and electing out of the installment method, or making sure to amortize your fertilizer instead of depreciating it, instead of deducting it in the year you apply it, those things are worked through in more detail in chapter 8. All right, the next update I want to give is on page 77, and we are 2 minutes out from a break. So what I'm going to do is just give a quick introduction, and then you've actually very much earned your first 15-minute break. So here we are.
Hey, Christine, can I, before you finish out?
Absolutely.
Yeah, so you brought up an important point with defined benefit plans, and we did this with an insurance agent, and it can easily be done with a farmer, because you're exactly right. They've minimized their Social Security income, so they don't have much of a Social Security benefit. But let's say they're a corporation, they're going to sell the farm property. Of course, you have a capital gain. But if they want a lifetime income, I mean, they can go back and create a defined benefit plan and fund 30 years, 40 years of unfunded benefits with that lump sum. It's up to them. What would they do with the capital gain? In this case, with the insurance agent, he received a lump sum that would have been taxed at ordinary income in the year he received. It was about $1 million. We set up a defined benefit plan, we funded it, and we've now deferred those distributions through the plan over his lifetime. So these defined benefit plans are ignored. They're powerful tools for people that don't have retirement income. He never set up a retirement plan in those 40 years in which he worked. So all he had was Social Security.
Do you feel comfortable sharing the company that you worked with to help set that up? Because that's a question I get a lot of times.
So go find a good actuary. We use an actuarial company out of Pittsburgh,
Mhm.
Dunbar, Bender and Zaff, DP&Z. If you've got any good major actuaries in the major cities across the United States, they'll know exactly what we're talking about. They will. So that's your help right there. I didn't do the calculations. These are all actuarial calculations. The choice of entity will come into play. So if you do a shift from a sole proprietor to a corporation, be careful. This may derail that type of strategy. Are farmers eligible as a sole proprietorship for a defined benefit plan? Great question. Corporations, easier done than a sole proprietor. So there's a lot of technical questions here, and you really have to anticipate this. Again, what type of income is a farmer receiving? He may just want to pay the capital gains rate and live off the lump sum from the sale of the farm and forgo the retirement plan. But you have to do the planning. For us, it worked. Would it work for a farmer? It could. Might be a very powerful tool. What type of income? Capital gains, ordinary income? Again, dig into the weeds, but don't forget the defined benefit plan. It's out there and it's probably underused in terms of a tax deferral strategy.
Thank you for those great comments. And there is a little section in the retirement chapter of the workbook that does talk about that. So if anybody wants more information or talk about it more, reach out to me outside of the class. I love to talk through those things. So great. Well, I think we are definitely up to a break. So I'm going to go ahead and turn you loose until 10:25, and then we'll start back up with the estate and tax exemptions section. So thanks, everybody.
Thank you so much.
Well, welcome back, everybody. I hope that you got some coffee or some kind of break. I did want to just again reinforce in our, oh, hi, Lisa, did you need to say something? Oh, she got
No,
coffee. That's
but I got my coffee.
good. Yes, and again, I like the mics unmuted. You guys can talk and share things. It's a great opportunity to have a conversation about things that I'm kind of passionate about here. So, chapter 6 of your workbook, if you want to just take a look at that real quick, I wanted to suggest that the first part of it talks about Social Security and helping clients figure out how much Social Security they're eligible for, et cetera. And then the second half of the chapter really does run through some of those retirement plan options that might work for clients like SEP IRAs or even solo 401ks. And then as the item was discussed, the possibility at the end of the defined benefit plan. So there is a little bit more information in there that might be useful to you. And but now we're going to go back and we're wrapping up the hot topics issues. And in all my seminars, I like to spend time on that information that has changed or is changing or is the latest that we need to look at. And so that's why we're wrapping that up and we're looking at the estate tax exemption. And of course, this is the estate and gift tax exemption. And it in 24, it's 13.61 million. We've got the numbers for 25. It's up to 13.92 million. So it is high. We know also that this is set to go back down to $7 million at the end of this year. But of all of the tax cuts that are pending, I would say this one has the most support for an extension. And I'll explain why I think this one will be extended, the higher exemptions, because if you look at the cost to extend that doubling of the exemption, this doesn't apply to everybody, right? It only applies to people that have income or not income assets between 7 million and 14 million. And it is a state tax on those folks. And it isn't very many people that are impacted. So right now in the farming sector, across the country with the current exemption, we only have 87 farmers in a year who would die and owe any estate tax. Now, if that went back down, it would increase. Let me ask the polling question to make sure you made it back from break and to make sure that you're all still out there. But this question is, what will the basic exclusion amount be if Congress does not intervene and pass a law? And so will it be 4 million? Will it be 7 million? Will it be 10 million? What will it be if Congress does not actually get a law passed? And so I'm launching the poll. If we could go ahead and weigh in on that. It is, I'll give you the answer. It is 7 million. Because right now we have essentially a $14 million exemption. And that's because the Tax Cuts and Jobs Act doubled it. If the Tax Cuts and Jobs Act is not extended in this area, it would go back to $7 million per person. And I was suggesting that although I can't be sure, none of us can, what Congress will do, if they have the ability to get any law passed, I would think they will extend this. And the reason is because, like I said, it gets constituents very worked up and interested, and it doesn't impact the budget as much as many of the other provisions. So again, we've had a lot of push to do a lot of fancy gifting, a lot of fancy trusts, a lot of things like that. And I'm going to end the poll. But I think that after the election, we're probably at a place where we're having plans that are still maybe put in place where they could be triggered if necessary. But I think that the concern about the lowered exemption is a lot less than it was 2 months ago. And of course, it's all a big deal because anything over the exemption amount is taxed at 40%. And the USDA did put out this chart that showed us how for example, for large farms, you can see that orange bar. Wow, many, many more farmers, if they passed away, would be subject to estate tax if the exemption were cut in half. So just a couple of planning things that I think apply even if Congress extends this exemption. Again, thinking long-term, Congress and tax policy, unfortunately, has been like a pendulum, right? It swings this way, then it swings this way. And so even if Congress extends this, who knows what will happen 4 years from then, right? Like maybe there'll be a whole nother Congress that would cut it way back. So good planning is about preparation, and portability is always keeping our client prepared for whatever contingency arises. Because if we elect portability for a client, then we've locked in whatever that deceased spouse unused exclusion is at the time of death. And if that goes down, then we'll still be able to use that higher amount. If it would somehow go up, we won't be penalized. So portability is kind of a win-win situation. The only negative part of portability is simply filing the Form 706. So for clients with any sort of assets, I really do highly recommend considering the portability election when one of the spouses passes away in the farming context. We have to remember how gross estates are valued. This year has put a lot of emphasis on figuring out what would be in our estate. So there's also been a lot more emphasis on looking at entities and the fact that if I have an LLC, I actually have the ability to maybe lower the value of my estate by gifting shares in that LLC. We used to have to only do this through limited family partnerships, but of course now LLCs do the same thing. And we can assign lack of marketability, lack of control discounts to those shares. And long story short, right, the gifting that we've done then is lower than it would have been if it didn't have those discounts. And those are still available under 2704. There has been a lot of push. In fact, the current administration in their Green Book forever since the time that they've come into office has proposed to get rid of valuation discounts. There's been pending guidance supposed to come out anytime, right, to get rid of this. But now this will not happen for some time. Right now, the new administration will not be in support of eliminating valuation discounts. So they live on. So these are tools that are available to clients who want to lower the value of their taxable estate. We do also, of course, have special use valuation for farm property, but boy, that amount that is the maximum amount that you can take, which is $1.39 million, is the maximum discount we have for qualified real property in 24. It has not kept up with the times, folks. So if you have any connection to your legislators, this might be a piece of small legislation that could be put in a legislative vehicle just to up it, maybe give us 10 million, something. Special use valuation really isn't very helpful. At the most, it will save you $556,000 in tax. And it is such a hassle because you have to make sure that everybody's materially participating and all of that. So this little example in your book just shows you how that's calculated, right? 400 acres of qualified real property. If the average cash rental value is $250 an acre, the property taxes are $50. If the average federal land bank loan rate is 4.57%, this was from a couple of years ago, the discount is going to be 1.7 million, but of course that exceeds the max, so you're only going to be able to take a discount of 1.39 million, and that's the discount of the value. So then you multiply that by 40%, and that's where I got that just over $500,000 in tax savings is what's allowed. The other thing that is a provision that some clients might get excited about is conservation easements, because when we're thinking of valuing our estate, we do have the ability to lower the value of our estate by any conservation easements that are placed on the land. But again, that is really significantly limited by the legislative cap of $500,000 of value limit. So again, for tax, we can save $200,000 of tax. But, you know, we have lots of ability with conservation easements. They've really picked up, I think, in recent years in popularity. Clients can just flat out sell a conservation easement if they prefer to do that and actually get money and get compensation for that, or they can donate the conservation easement. And you know, for a real farmer, a qualified farmer, which is defined as having gross income from farming more than 50% of gross income from anything else, then you can take up to 100% deduction against your AGI. And if you have more that you've donated, you can carry that forward for 15 years. None of that is changing with any of this Tax Cuts and Jobs Act legislation. I would not expect them to fiddle with that, but we'll see. Again, when you're valuing your estate, the max reduction is 500,000. So multiplied by 40, that's a $200,000 tax. And so when we're looking at of all of our gross estate, that's still not what we're looking at in terms of what we're taxed on. We're only taxed on our taxable estate. So we have an unlimited marital deduction. We have charitable deduction. We have mortgages, debt, administrative expenses. All those things are taken off the top. And then we calculate our taxable estate and we add back in any of our lifetime gifts. And then we multiply by 40%. That's why, for example, the discounts of the gifting of the interests in the LLC is important, because the value of anything we gift during our lifetime does get pulled back in if that exceeds the annual exclusion amount, which in 2024, the annual exclusion amount is $18,000. And so once we have our taxable estate, we multiply that by 40%, and then we subtract any gift tax we paid, and we subtract what's called the unified credit. Now, the unified credit is actually the place in the tax code where we figure out how much we get out of paying estate tax, but it is just the amount of tax that corresponds to that basic exclusion amount. So the basic exclusion is that 13.61 million. In the code, it shows you the unified credit, which is 40% of that. So that's how all that works. And then any tax remaining has to be paid by the estate. So when people are worried about estate tax and they're worried about thinking, even if they're thinking that Congress will allow that provision to expire, even if they think Congress will allow the basic exclusion to go back down to $7 million, a lot of my work has been to have people remember what is the value of the income tax benefit you have in appreciated property that has not been sold, where if you die, that basis is going to step up. So in the farming context, we just look at all these different categories of assets that we have, and all of that gain. It's like what we talked about earlier this morning in terms of all of this just gets pushed. It's all of it unrealized gain. And so just this ordinary farm that has, you know, a fair market value of $7.5 million has gain of $6.3 million because the basis on a lot of assets is zero or very low. And I could have made this a lot more dramatic because, for example, a lot of the basis of a lot of multi-purpose buildings is zero because they took 100% bonus when they built it, or the basis of the land might be a lot lower than what I've put on this chart. So lots of built-in gain that has not been taxed, that when you die, all that gain goes away. Under 1014, it just if it goes through your estate, there's a basis adjustment, and all of a sudden it's considered fair market value, so that if your heirs are farming, then they get to restart depreciation, right? Say the basis is going to be fair market value, and I just inherited a a single purpose agricultural building. I just inherited a hog barn. I get to start depreciating that thing over 10 years. Now, of course, I don't get to use accelerated cost recovery because I inherited it, but I do get to start depreciation. For my multi-purpose ag building, I get to start the 20-year clock going. For my equipment, I get to start depreciation over 7 years. There's a lot of value in that because the basis stepped up. If I gifted it, all that would not happen because the basis would be a carryover basis. With my land, it all steps up. My heirs could sell the land and all that could happen. Now I got a question. This is a question that that has come up a couple times in the last year, and it surprised me. But apparently what had happened is a lot of clients, and this is going to be a polling question too, so I'm going to actually launch the poll, but clients have sold land or sold, more likely grain, sold a farm asset on their date of death. And so it raises the question, when does the basis adjustment actually occur? So we have a polling question. I'm going to ask you to answer. Does the basis adjustment actually occur on the date of death, or does it occur on the date after death? This is not very intuitive. And I'm going to leave that up for just a little bit, but I'm here to tell you that it actually occurs on the day after the date of death. Now, do not get that confused with what the fair market value of the basis adjustment is. That's the thing that makes us think that it's the date of death, because if I inherit a piece of land, I inherit it with a fair market value as of the date of death of the person who gave it to me through their will. But when does that basis step up? And so here's where it matters. Let's say that I was a farmer. I raised some commodity. I had grain in the bin and I sold it on the day of my death. And so do I, as the beneficiary of the estate, get to take a step up in basis because it was on the date of death? And the answer is no, because assets sold on the date of death are part of the last day of the decedent's tax year. And those have the old basis, and it's part of its IRD if it comes in, if they haven't actually collected the money. And it's not until the day after the date of death, if I sold it that day, then the basis in that commodity would step up to fair market value and I would recognize no gain. So it's kind of, like I said, not terribly intuitive, but it is something that does come up on occasion, and I wanted to point that out to people. The other thing that comes up is, what is the basis of land that comes out of a life estate? Very common that we have life estates, and if you Google on the internet, it's always going to tell you that the basis of property coming out of a life estate is stepped up. And why does it tell you that? Because all of the internet wisdom, the collective internet wisdom, is out there talking about somebody. Let's say that I have a house and I want to save it from Medicaid recovery, and so I gift it to my children with a remainder interest, but I keep a life estate for myself. Well, years ago, when estate tax was actually a thing, right, it applied to a lot more people. I mean, it wasn't that long ago, I think 1996, that we had an exemption of $600,000. I mean, so this was a big deal. Congress was worried that a retained life estate like that, I would be taking it out of my taxable estate. So they said, no, we're going to keep that in your estate. Well, if something's in your estate, it also gets the benefit of the step up in value. So voila, if I do that, if I gift my children a remainder interest in my house and keep a retained life estate, then the basis of that house will step up on the date of my death. Now, if I was wealthy and subject to the estate tax, it would also be pulled into my estate, subject to estate tax as well. But that is a different rule than a granted life estate. And that is what we see more in the farming sector. So granted life estate would be grandma gives grandpa a life estate in farm property in her will. And then grandma has an untimely death at the age of 35. Grandpa got the life estate and farmed it until he was 90, and then he passed away, and then the grandkids had a remainder interest and title passed to them after grandpa died. So then the question is, what is the basis of that farmland? And unfortunately, the internet sleuths come to the wrong conclusion, and they're not very happy when they realize that at death of the life of tenant, that is the basis. So in my example, the basis of the farmland that the grandkids eventually receive from grandpa because he dies goes all the way back to the fair market value on the day that grandma died and gave grandpa the life estate. So that is a difficult difference there. Also, jointly owned property is treated differently, as you know, and that's a big deal too when we're trying to figure out what the tax consequences of different gifts or sales or death is to jointly owned property. If I hold property joint tenant with right of survivorship, which is a very common way for marital people to hold property, if we're married, then the surviving tenant gets the property with a 1/2 basis adjustment. So 1/2 of the basis of that property steps up. If I'm not married, then we have a consideration furnished rule. And if I contributed 60% of the value, then 60% of the basis will step up. Now, under this rule, it's presumed that the first person to die has 100% contribution because that's also included in the estate. And Congress at the time was more concerned about the estate tax than they were about the basis adjustment. And the basis adjustment is actually much more valuable to us now, but it's sort of a remnant of years past when it existed, because if everybody was going to be subject to the estate tax, it didn't make sense to double tax the income by requiring people to also pay tax on that gain. And so that's how it all came about, but really those have been disconnected. So it's been interesting how things have evolved. Now, in the community property states, I think there's 7 of them across the country. It's 100% basis step up at the death of each spouse. So that's kind of a cool tax benefit of community property states. Lifetime gifts, right? They may be subject to gift tax. It's very rare, though, that we actually have to pay the tax because you have to actually give more than your basic exclusion in order to be subject to the gift tax itself. But you have to give just more than the annual exclusion to be subject to file a Form 709 gift tax return. So we have to keep the difference separate. There is no penalty if you fail to file a Form 709, but you're really, in most cases, penalizing yourself if you're giving anything more than cash, because filing a well-filed Form 709 gets the statute of limitations going for valuation. So if I gift, for example, those membership interests in an LLC, and I want to take a minority interest discount on that, then if I do all the proper filing and I don't have any fraud or anything like that involved, the IRS has 3 years from the date that I filed that Form 709 to question my valuation. After that, it's too late. And so if you have a client that's new that comes in that they haven't filed their gift tax returns, is it ever too late to file? No, in fact, do it, because we have a tax court case from last year that held that, there was a case where the return, the gift tax return, was filed very late. I think it was 8 years late. And so because it was so late, IRS didn't audit it until even 3 years after until more than 3 years after they actually filed it. So by that time, it'd been like 11, 12 years since the gift was made. And the taxpayer said, wait a minute, you missed the 3-year statute of limitations. You can't audit this anymore. And IRS said, wait a minute, you were 8 years late filing your gift tax return. So you have dirty hands. You can't claim that we're late in auditing. And tax court said, oh, yes, they can. So whatever time you file a well-filed Form 709 starts that statute, even if you're late filing, IRS has to stay within that 3-year period. So I think that's an important matter to consider. Also, when we gift, right, what are we giving up? Well, we're giving up that step up in basis. So we have a carryover basis. Now, remember, the step up is going to eliminate capital gain. It's going to eliminate 1245 and 1250 recapture. It's going to eliminate ordinary income in the case of our farmers that have commodities on hand, like our grain in the bin. That gets a step up in basis if the farmer dies with that asset. And so the heirs inherit it with a fair market value. They can sell that grain and there's no tax due on it. The net investment income tax, all of that, right? So gifting in the farm world is unfortunately in many cases a cash flow killer because you don't get depreciation reset. You don't get any of that. Not that you're sitting there wanting somebody to die, but that is a benefit of death, is that you have a pretty large amount of unrealized gain that's just wiped out forever. And there's another rule I just want to remind us of when we're thinking about basis of property, and that is gifts within 1 year of death. This is something some people use as a planning tool. I'd say you have to make sure that you're following all the tax doctrines as well to make sure that you're not violating anything. But here's what this rule says. It says that if I gift property within 1 year of death, and that property is going to come back to me from the person I gift it to, it will not get a basis adjustment. So the implication and the knowledge of the opposite is if I gift property to somebody and they survive more than 1 year and then they gift it back to me at their death, it does get the basis adjustment. So some people do take advantage of this in very narrow situations where family matters, and I think you have to be able to justify a non-tax reason as well to do this. But here's the situation. Mari owns 500 acres of farmland that her grandmother had given to her before she died. The land has a basis of $500 per acre and a fair market value of $12,000 per acre. Mari gifts the land to her elderly grandfather on the other side and asks her grandfather to transfer the land back to her through his will. And so he complies, but he dies within 9 months of the gift. In this case, Mari would inherit the land with a basis of $500 per acre. But the law also says that if Mari disclaims that, the contingent beneficiary can still get the step up in basis. So it's kind of interesting for planning, thinking about how this could be done, because if the grandfather had survived for 18 months, Mari would have inherited the land with a basis of $12,000 per acre. So some people call that upstream basis planning. I call it kind of interesting, but just to kind of understand how that tax law works. It's now appears likely, like I said, that I think Congress will extend the increased exemption, but they do have to act to do it. They do have to get a law passed, but it is important to kind of just review the rules of where we're at with things like portability and gifting and how it all works, and just even for future situations to get these rules sort of ingrained so that we can also explain them to our clients. So we do have the guidance from IRS from 2019. It's a regulation that's out there that says that the DSUI does apply even if the exemption amount is lower than the DSUI at the time we take it. And the same for gifting. If I gift property today using my nearly $14 million exemption, and then maybe 8 years from now, we get a new Congress and they lower it to $3 million. They could change this law too, but the regulation in place right now says that the whole $14 million exemption would still cover the gift I gave today, and I would be okay. So my question is, how many of you have filed a Form 709 or Form 706 to elect portability? And I'm going to launch that polling question. It's also a good time if you have a question to raise with the group to let us know. So, oops, it looks like I'm open in the question box too to see if there's any. So there's a question about whether you would still have ownership after death, and the answer is no. Once you're dead, you're dead. And so trusts are separate and apart from us. So a lot of people today that have revocable living trusts, they have it, and it's really no different from being themselves while I'm alive. So I have my revocable living trust. It's disregarded for tax purposes. As soon as I die, it becomes an irrevocable trust. So there's nothing you can own. Once you're gone, you are done owning property. So you better put your plans in place. You guys were quick on that poll. And it looks like about 30% of you have filed a Form 706 to elect portability, and the rest of you haven't, but some of you probably have directed clients to elect portability, even if you weren't the person that filed the Form 706, because sometimes I know the attorneys might file the Form 706, but it's important for all tax professionals to be on the lookout for situations where portability might be important. Maybe the estate attorney might not be in the know about the tax matters like you are. And so right now, I think is better time than ever to elect portability and to advise clients about it. Sharon died in 24. She leaves a $13.6 million deceased spouse unused exclusion. Her surviving spouse, Dale, is her executor. He elects portability. He dies in 26. After that, exemption resets to $7 million. This is if Congress doesn't get its act together. But it could be that he dies in 2030, and maybe the exemption resets then. Maybe, that pendulum swings. We have a different Congress. So current regulations would allow Sharon's $13.61 million DeSuey to apply to Dale's estate. And so if there had been no portability, Dale would have only a $7 million exemption at his death. And here's a chart I like to show to kind of say, okay, this is where the malpractice carrier gets called. If those situations were to happen down the line, to not advise portability, even if you're not talking about a lowered estate tax exemption, just having Dale be able to double up on his own exemption for the particular client that might have a taxable estate, portability is very important. And we do have that Rev Proc 2022-32, which says that we have 5 years from the date of death to elect portability. So it is a good thing. You can get a new client and you can find out that their spouse died 3 years ago, and it's not too late for them to go back and elect portability. So that is a good thing. So with all of the interest on the lifetime giving, all the interest on the trust, the potential planning, even if the exemption stays right where it is and not very many people end up executing plans, it's a really good time to realize how the law actually works with respect to the mechanics of a lifetime gift and how the exemptions apply. So what happens is when I give a gift, so if I gave a gift today, if I had a deceased spouse unused exclusion, that would be applied first. Now, here's an interesting question. Let's say that I was married and my spouse died and I elected portability and I got a $13.61 million DeSuey. And let's say that I want to make a lifetime gift. Could I use that DSUI right now in full? Absolutely, right? So I could give away $13.61 million. Then what could I do? I could remarry. And let's say that if my second spouse unfortunately also dies, they leave me another, maybe $14 million exemption. Can I use that one too and make another lifetime gift? Yes, right? It's the last spouse to die, but if I give it away through a lifetime gift, I can keep giving. It's kind of interesting. So, DSUIs survive remarriage, but they do not survive the death of the replacement spouse. So you only get the new DSUI, not upon marriage, you get it upon the death. So if I happen to have a DSUI because my first spouse died and I elected portability and I do not make a gift while I have that one in place and I remarry and my second spouse dies, that second spouse's DSUI will eliminate my first spouse's DSUI because I did not use it while I had it. So just a little bit of interesting interplay with how that statute works. Now, also the next thing is with respect to the increase in the basic exclusion that the Tax Cuts and Jobs Act has put in place. It wasn't just changing 5 million to 10 million. It's a separate section that adds the extra 5 million indexed for inflation. So if I give a lifetime gift, the next thing, and most of us don't have a DSUI, so if I were to give a lifetime gift today, I would be hitting into the $7 million extra that the Tax Cuts and Jobs Act gave me. And I would only be tapping into the original the original basic exclusion. Sorry, I'd be tapping into only the original basic exclusion that was in place before the Tax Cuts and Jobs Act. I would only be tapping into that extra additional basic exclusion that was given to me by the Tax Cuts and Jobs Act if I gave the whole amount of 13.61 million. So let's just look how this works, right? Margie made a $13 million gift this year. She filed the Form 709. She applied the basic exclusion. Now, let's say she dies. Let's say the exemptions reset to 7 million. Let's just give her that. Under the current regulations, her full gift is sheltered. But let's look at Monty. Let's say this year he gave a $7 million gift. He filed the Form 709. He dies in 26 after, let's say, the exemption resets. Although he could have gifted the full amount, he didn't. So he has 13.61 million. Is he sheltered because he gave 7 of it away early? No. The 7 million is the original. He's already used it. He doesn't have any more exclusion. So in this case, he would actually owe estate tax. Now, when we give away things, the thing that we do benefit from, and this is the whole purpose of some of these trusts, is any appreciation in our estate after the gift won't be in our estate. It'll be in the estate of whoever we gave the property to. So when we're thinking about whether it's a good idea to give property in any context on the farm. And this applies even like, let's say I'm a retiring farmer. What do I do with my machinery? Should I gift it to my grandchild who wants to farm with it? Should I gift it? Well, it might sound great, like gift it to them. But looking at the tax consequences, right? What is the income tax benefit I'm trading? Well, I have fully depreciated machinery. If I just gift that to my grandchild, they have what? Fully depreciated machinery. If they trade that, they have to pay full bore recapture on all of the value of it. If they were to want to depreciate it, they can't because they get no cost recovery because the basis is 0 when they get it. When they sell it, they have to pay full tax on it. All that is a lot of tax liability. So a lot of times with retiring farmers that don't need equipment, what we recommend is to rent it. Just rent it out. They'll have to recognize the income from the rental arrangement, but it's kind of a income over years, and it kind of gives them a little bit of spending retirement income as well. And then the lease payments can be deducted by the farmer. And then what happens is if that person who retired passes away and the equipment still has any value, the basis steps up. It goes to the person who's farming, they get a restart, depreciation, all that. And that's just the type of questions I think that we have to ask when we're figuring out whether it's better to gift or to sell. In some cases, it might be better just to sell. Now, with equipment, if I sell my equipment to my grandchild, then of course I'm going to have to pay all the tax on that. So that's why, gosh, it's really hard to come up with a better solution for equipment than renting, even though that doesn't sound like a great solution. Tax-wise, there's really no great solution for that problem. So if we're looking at the annual gifting that we can do to keep things out of our estate, as we said, it's $18,000 this year, $19,000 next year. That means we do not even have to file a Form 709. We also do have that ability for clients that are very gift-minded. They might not realize that if they have grandkids that are going to college, they can pay the college tuition directly to the institution, and it's unlimited. There's no annual exclusion limit. It will not be part of their estate. The other thing that you can do is pay medical expenses directly to a hospital or an organization that provides the medical care. And that too is unlimited, and it is not included in your gifting for purposes of 709 and your overall basic exclusion. Also, when in farming context, annual gifting can be done without adding anything to your estate tax liability when you die by just gifting every year. I mean, if you just think about it, over the course of 10 years, if you have a grandpa and a grandma, they could gift to just one family, and each person could gift $18,000 to each beneficiary, and you can get $1 million or $2 million out of your estate over a fairly short period of time. Another way to sort of get property out of your estate is through charitable remainder trusts. These are another good option. We talked earlier about defined benefit plans, but if I retire and I have a lot of grain in the bin and I have machinery and I don't want to rent it to a young farmer, what I can do if I'm charitably minded is I can gift that property to a charitable remainder trust. The charity can sell it at full value. They can get me, and I can get an annuity over the course of, for example, in this example, there's $1 million transferred to the trust. I get a $91,000 annuity payment over 15 years, and the charity in the end will get 100,000. I mean, projected. This is all just present value. But what the problem, if I sell it myself, I'm going to have to pay more than $400,000 in tax. So when you compare this to the tax liability, you might come out about the same, but a charity is going to get the money instead of the IRS. So it's just something to consider. Have any clients told you that a promoter encouraged them to set up a CRT? So I'm going to ask the next polling question, everybody. Launch that. Oops, hold on. Got to move this. Now, it might not just be a CRT. I think I'm going to ask this question more broadly because, gosh, in all my time of working in this space, I think we've seen more promoters out there encouraging clients in different ways than ever before. And so this poll, oops, what is that? Wrong one. Hold on. Hold tight. I'm not as adept at Zoom. I use GoToWebinar for my webinars, but Lisa's been gracious to help me here with this. Well, I don't think we have this poll in here, so we got to keep up with our polls. So I'm
looking
gonna
for it,
ask
yeah.
you. Yeah, it's no problem. We'll just launch a poll. And for this one, gosh, I'll tell you what the question is later. Right now, just pick a year, any year, 2, 4, 6, whatever number you like best, and answer the polling questions. Sorry, this one doesn't line up. I am curious though, if you've had clients that have had promoters, so you can take yourself off the mic if you want to share anything at all. But we are going to move on here now, just to warn you that in the charitable remainder trust area, there were a number of promoters that were out there talking to farm clients that were saying, hey, you can take this nice little annuity payment that I show here, and guess what? You don't have to pay tax on that. And that's just wrong, right? So the way that it works is Rodney would have to pay tax on his $91,000 annuity, but presumably it would be a lot lower rate stretched out over 15 years than if he paid tax on all of his sale of his grain and his equipment in the year of retirement. So that's how that works. Anyway, they got caught with the courts. And so sometimes promoters get caught, sometimes they don't. I mean, case in point, look at the ERC and all the trouble that's been caused. Again, they're maybe going to get caught, but it's taken so long that the ERC promoters have really harmed a lot of people. And if you haven't heard, just a couple days ago, the current commissioner, Danny Werfel, said that they are starting to really pay out all the final ERC claims. And that has been an issue. I'm doing a sideline here because I think employee retention credit has probably been a big deal for a lot of your clients as well. And I've been hearing a lot of people who actually filed valid claims, but they haven't been paid, and maybe they didn't take the wage deduction, and the statute's running. It ran already for 2020. So what do, right? We have no IRS guidance on that. But Commissioner Werfel did just say that they are getting those final payments made, and they hope to have most of them made by the end of this year even. So we'll see. If that's the case and you did not amend your return already to add back the wages, make sure to get that done. If it's for 2020 and the statute's already run, we're not sure what IRS is going to do. IRS might say, hey, we told you when you filed the claim, you had to take away the wage deduction then, so you did not follow our instructions. But I can't imagine they could charge fraud with that. What happens if you try to amend your claim right now, amend your return? It's too late. It's out of statute. You can't do it. So what some people are suggesting is they're just taking the amount of wages that corresponds to the deduction that they took in 2020, and they're putting that on the 24 return. I'm not advocating anything till we know exactly what IRS is going to say, but I'm just pointing out a couple of those questions. If you haven't amended and you're expecting to get a payment for a 21 claim that's still open, and it's getting close to April, which would be the deadline, you might want to think about filing a protective claim to get your wage back in the event that you do not get your ERC money. So these are some things that people have been thinking about. But back to our estate tax issue on page 85, planning with trust. You've probably heard maybe some of the attorneys that you work with or clients who have wealth are saying that slats or something that have been promoted. That section of our workbook just defines what these things are so that we know, but it's basically just a bypass trust where for one spouse you create this, and then property can accumulate and it will not be part of the taxable estate. We don't need to get into any more detail about it than that. I just like to have people understand what those things are. And then most of you are familiar with ILITs because these were really popular back when the estate tax was a lot more prevalent, and they may become more popular again. They're just irrevocable life insurance trusts. And just remember that life insurance, if I get life insurance because I'm the designated beneficiary when somebody dies, I don't have to pay any tax on that. That's awesome. But the life insurance is included in the estate of the person who dies if they were the owner. So if I own a life insurance policy and my kids are the beneficiaries, they get the life insurance when I die. I don't have a taxable estate, no problem. But let's change the facts and say that I have a $20 million estate. Any life insurance that I had owned at my death is going to be part of my estate. So it's going to be a 40% estate tax on that. And so the solution is the irrevocable life insurance trust, where I don't own the life insurance on my life. This irrevocable trust does. And if the irrevocable trust owns it, then it keeps the life insurance out of my estate. So really pretty helpful planning tool. We'll talk about it in the context of a Supreme Court case that came out this year, this summer. And this deals with family entities where the owners may owe estate tax, and how do you handle the life insurance? And so just going to give you a little bit of overview of this. It's on page 85 in your workbook. It was the Connolly case, and it was a case of two brothers who owned a small family corporation. And so, you know, this could be a farming corporation just as much as this one wasn't. But we had Michael and Thomas, and they were the only shareholders of a small corporation that they had agreed, the corporation documents and everything provided, that if one brother died, the surviving brother could buy the other brother's shares in the corporation. If the brother didn't want to buy the shares, then the corporation was required to redeem those shares for the beneficiary. And to ensure adequate funds, the corporation took out a $3.5 million life insurance policy on each brother. Okay, so the corporation was buying the insurance. Well, Michael, who owned most of the shares, died first. And when he died, his surviving brother, Thomas, said, I don't want to buy the shares on the, so that triggered the buyout of Michael's son by the corporation. And so they used the life insurance to buy out the shares. Now, Michael had a taxable estate, and so that's why this mattered. And so the question before the court was the corporation's obligation to redeem the shares a liability that actually decreased the value of those shares? So in other words, when they were trying to value Michael's estate for estate tax purposes, was his interest in Crown, the corporation that he owned an interest in at the time of his death, was it worth $3 million? Or was it worth $5.3 million, $5.3 million, including the value of the life insurance? And the case went to the Supreme Court. And what the court said is the estate included the value of the life insurance. And they explained it this way. They said at the time Michael died, Crown was really worth the $6.86 million, including the value of the company plus the value of the life insurance. And so anybody purchasing Michael's shares were going to acquire a 77% stake in the company that was worth that amount of money. It included the obligation to redeem, but a buyer would pay $5.3 million for Michael's shares. So that kind of rocked some estate planners because and entity planners and people who set up entities for businesses, family-owned businesses in particular, because they said, now wait a minute, this is how our insurance works too. And so I think the takeaway from this is just remember, you know, you don't have to have the corporation or the LLC or whatever own the insurance. They also didn't really follow the terms of the buyout either. They didn't have an appraiser, none of that. But the court did suggest, hey, if you'd had cross purchase agreements, that would have had a better result. So if Michael had bought the life insurance for Thomas and Thomas had bought the life insurance for Michael, the net result of the outlay of cash for the life insurance would have been the same, but the result would have been much more favorable from an estate tax perspective. And I would also posit that, you know, ILITs can work in the context of businesses as well. So just something to consider there if you counsel businesses in the farming world in terms of how they set them up, because some of our entities, get kind of big and they are valued at significant amounts. The next case that we had this year that was in your workbook is the Schwartz case. I'm not going to really talk a lot about this. It's another hobby loss case, like a case that involves a large ranch, where the question really in these cases boils down to, did you have this ranch to earn money, or did you have it because you enjoy being out hunting and doing all those things? And bottom line here, the court found out that this was hobby. So of course there was no loss allowed. So this case will spin you through those factors. Again, it is an issue that comes up quite a bit in today's world, not necessarily with big ranches all the time. Many of us may not counsel the big ranches, but who you might counsel is somebody who is working a full-time job in the city and they have set up a farm and they're just sort of getting started in farming, and maybe they're not really making a lot of money. Maybe they have some interesting livestock. Maybe they have some horses, things like that as well. And so this will help us figure out, is this really a trade or business, or is it a hobby? And was this business set up for the purpose of profit, or was it set up for the purpose of pleasure? So those are cases that you can review. The next and final case that I just want to touch on, again, we're not going to spend a lot of time on this, and then we're going to get into the nuts and bolts of Section 179. So we're going to get into more nuts and bolts on the farm information after this. But we did have a really large Supreme Court case that came out this summer in June. It was a landmark decision, really. It's called the Loper-Bright case, and it overturned what's been long called the Chevron doctrine. You've probably heard about this, so I'm not going to talk a lot about it, but if you haven't, I want to make sure that you understand what happened. So for many years, since 1986, I believe, the Supreme Court put out a case called Chevron. And the Chevron case said, hey, when we as courts, and this applied to all the lower courts as well, not just the Supreme Court, when we as courts are called in to review a regulation that a federal agency has put in place, or we're reviewing the way that a federal agency is administering a law, we are not just going to go in there and start from scratch. We're going to first say, well, wait a minute, let's look at the law. Is the law just 100% clear? Okay, if the law is clear and IRS or USDA or somebody is implementing it in a way that's completely different than what the clear law stands for, they still could intervene. And that's when they would sometimes overturn regulations, but it wasn't very often. Instead, most of the time, as much as Congress tries, their laws just really aren't that clear, right? Like, you can find ambiguity, folks, right, in almost any law, regardless of how well it's written, because that's the nature of writing something. It can have lots of different ways that it's interpreted. So if the law isn't clear, then what the Chevron case stood for is the court has to defer to the agency's interpretation as long as that interpretation wasn't permissible, which basically means they didn't go crazy. They didn't abuse their discretion. And so for 18,000 federal court cases since the Chevron doctrine went into effect, the lower courts and sometimes the Supreme Court have said, yeah, we might not even agree with what the agency did here, but we can't review it because of Chevron. We can't review it because of Chevron. We can't review it because of Chevron. Then we get this case in 2024 from it's a fishing case. And so it's the agency involved is the National Marine Fisheries Service. And the law that's involved is the Magnuson-Stevens Fishery Conservation and Management Act. And so the Fisheries Service implemented a rule to administer the law that regulates fishing, right? Fishing is something that has to be regulated because there's all kinds of dangers of overfishing and all kinds of things. And so part of the problem with enforcing the law is knowing whether or not people are complying with it. And so the service said, oh, we're going to put a rule in place where we're going to have onboard observers on your fishing vessels. I think that's required in order to be able to make sure that you're complying with the law. So here's our rule. You have to have onboard observers. And guess what? Sometimes you're going to have to pay for the cost of that observer. And the cost of having somebody on your ship for a day might be $710. And so this lawsuit that was filed said, wait a minute, that's 1/5 of the annual returns that we get, like up to 20% over a year. We're having to put into paying for somebody to be our big brother to watch over us. We don't think that's right. And so they sued the government. They said, fishing service, you're abusing your discretion. You're doing all of this. Well, the lower courts looked at it and they said, okay, well, we have to give you summary judgment, fisheries service, because Chevron, like, the law's not clear. This isn't crazy. So we're just going to defer to your judgment. And it went up to the Supreme Court. And in a 6-3 opinion, the Supreme Court said, wait a minute. We want to look at the Administrative Procedures Act, first of all, which is the act that determines how regulations are made and all of that. And the Administrative Procedures Act itself says that courts are supposed to exercise independent judgment when they're determining the meaning of statutory provisions. And so the Supreme Court said, wait a minute, it's us, it's the courts, it's not the agencies that have the authority to interpret law. The agencies have the authority to administer law. Now, you all in tax understand the complexity of that because IRS has to interpret law all the time in order to administer law, because the law has like a 1 paragraph and then there's 100 pages of regulations about what that 1 paragraph actually means, because the tax code is so darn complicated. But what this case stands for is people can challenge regulations now. And if the law is not clear, the court will look to its own interpretation instead of just deferring to the agency. So we're not really sure what this will mean, but I will tell you there's another case that came out this summer that I think means we're going to see a whole lot more challenges to tax law. For example, July 1st, we had Corner Post versus Board of Governors. This is a case where the question was the statute of limitations for challenging a regulation. And it used to be it was 6 years from the time the regulation came out. In Corner Post, the court said, oh, wait a minute, it's 6 years, but it's 6 years from the time that you're personally injured by that. And so that is a change that means that partnership law may have been in effect forever. The regulations for something in partnership law might have been in effect for 30 years, but if this is the first time I've been affected by the regulation, I can still bring the lawsuit. And so I do think we're going to have a lot more court cases. And this is the question that I asked before. How many years do you have to bring a challenge? And the answer is 6 years. We're not going to ask that poll because we already kind of burned that one before, but it is a 6-year statute. And so time will tell, you know, what's going to happen. But that's where we are with respect to everything new. So that is chapter 2, our new legislation, our new regulations, our new court cases. And now we're going to change gears 100%. And we're going to switch over to the chapter in your workbook that is a deep dive into section 179 and other cost recovery. So it's chapter 5, starts on page 147, and we'll get through some of this before lunch, and then the rest of it we will pick up after lunch because you just have 30 minutes until lunch. So you're all doing very well here. So let's first of all look at eligibility. So with this chapter, well, like I said, we're doing a deep dive into section 179 because this is the biggest tool that's available to farmers. It's the most frequently used tool that is used by farmers. And so little things come up that you might not know where to find in the code or where to find in the regulations. So the point in this is to just kind of go through, starting with kind of the basic and working our way into the more advanced issues. So, individuals, C Corps, S Corps, partnerships, they can all elect to take Section 179. What entity cannot? Estates and trusts. They are not eligible to elect a Section 179 deduction. So we'll look at how that works. Section 179 is allowed for the entire cost or just a portion of the cost of any items that are Section 179 property. So we're going to look at the definition of Section 179 property, because that's another thing I get a lot of questions about. And when you go to the code, we're going to find out exactly why something is eligible for Section 179 or why it might not be and why that matters. And the flexibility of Section 179 is really awesome, because I can take just an amount on one item and not take any Section 179 for another. And that's just the basic example here, example 5.1 on page 148 that explains this. So on December 24th, David places into service 3 pieces of used equipment for his farm. He's got a tractor, a combine, an irrigation system, and he elects to expense the whole cost of the tractor and the irrigation system. But for the combine, he only does a portion of it. And this is where we as tax professionals can provide value to clients to try to hit that sweet spot for tax liability. So Section 179 is one of those great tools that gives us flexibility to do that. Now, when do we take it? Well, we can take it only in the year we place the asset into service. So if I purchase it this year, but I don't place it into service until 2025, I cannot take that Section 179 deduction until 2025. Placed in service in the code is the time when it's first ready and available for use for its specifically assigned function. So the next section here, placed in service, page 148, this goes even beyond Section 179. So multi-purpose farm building, for example, is on this list. Multi-purpose farm buildings are not eligible for Section 179. These are just examples of what it means to be placed in service, because the same rule applies to bonus depreciation and regular depreciation as well. So livestock purchased for dairy purposes, when are they placed in service? When they can be milk. If I purchase livestock for breeding, when are they placed in service? When they can be bred. If I have a multi-purpose farm building constructed to house farm equipment, it's placed in service when it's substantially completed and in a condition or state of readiness and availability. I do not have to actually have the equipment in the building. I do not actually have to be using it for its purpose. It just has to be ready and available for use. Farm equipment, same thing, when it's ready and available for use. So if I pay today to have a tractor made for me or reserved for me, but that tractor is not delivered to me until next year, I cannot take Section 179 for the tractor, even if I paid the cost this year. I have to wait until it's ready and available for use. Now, I don't have to have driven the tractor. I don't have to have used it. I don't have to have, I can buy a combine after harvest season and I'm fine, but I have to, it has to be ready and available for use. So Jerry, a cash basis taxpayer, has some unexpected farm income in 24. So she thinks it's a good time to purchase a baler she's been wanting, because she can take the corresponding Section 179 deduction. She purchases it on December 27. I think that's already a week from Friday, how quickly the year end is coming, but it's not delivered from the factory until January 6th. So in this case, when can she take the deduction? Just 25, not 24. Now, if I use property for partial business use with Section 179, I have to use it for business use at least 50% or more of the time. So if it's below that, I cannot take Section 179. It's the same rule as listed property. So when I take the section 179 deduction as detailed on page 149, I get to reduce the basis accordingly, of course. But what happens if I am a trust that owns an interest in an entity that elects to take the section 179 deduction? And these are the things we're going to talk about in this chapter, are those off situations where we have entities, because for example, in an S corporation, the S corporation shareholder is the one that gets to actually take the deduction, but we have to know that the entity itself has to be eligible to elect it, and then that passes it through. So there's two different layers, and those are the things that we're going to talk about in this section. And so with a trust, Section 179 is not available for trusts or estates. So a partner or an S corporation shareholder that's a trust or estate may not deduct its allocable share. And so there's a special rule for that we're going to show you in this example. So Emma owns a small farm and she elects to expense a used sprayer under section 179. The sprayer costs $30,000. Emma elects to expense the full amount in 22. As a result, she must reduce the depreciable basis of the sprayer by $30,000, leaving a depreciable basis of 0, right? So that's just the basic, simple basis reduction for an ordinary individual. But Emma's also a partner in Green Farms Partnership. Her partnership interest is owned by her revocable living trust. She dies in 23 and the trust becomes irrevocable. So we got to be careful too with all this, but the irrevocable trust owns her partnership interest. Green Farms Partnership elects to expense $200,000 of section 179 property. Emma's trust as a partner has an allocable share of $30,000 of that, but can it use it? No, trust can't claim section 179. So the partnership basis in the section 179 property is not reduced by the $30,000 allocable to the trust. So what happens is the partnership can claim a depreciation deduction or credit for the $30,000 that the trust could not deduct. But is that allocable just to the trust? No. So that is a negative of being a trust that has an ownership interest in an entity that wants to elect section 179. You have to think about the fairness of how all that works. Page 149 is when we really dive into the definitions of qualifying property. So we can have used section 179 for our entire careers, but never have really looked into the distinctions that very rarely will have something come up where we need to know the distinctions. So we need to know how to answer the question. I'll tell you at the outset, I just got one of these questions yesterday, and that was having to do with residual fertilizer. We'll talk about that later. But the question was, is residual fertilizer something that is eligible for section 1031 exchange? And the definitions that we're going to look at here with respect to section 179 come into play. And I'll talk about the answer to that question later today when we talk about residual fertilizer. But to qualify, it has to be, in quotes, section 179 property. That's a defined term. We're going to look at what that means. It has to have been acquired by purchase, which means that you cannot have acquired it by gift or inheritance. It has to be acquired for use in the active conduct of a trade or business, and it cannot be acquired from a related party. So what is section 179? Well, it is tangible property that is 1245 property eligible for depreciation. Okay, so that's the definition. If we have 1245 property eligible for depreciation, it's going to be eligible for the section 179 property It'll include equipment, property integral to production, single-purpose ag buildings, and bulk storage. These are the categories of 1245 property that are eligible for depreciation. So if you're wondering where the list of equipment, property integral to production, single-purpose ag comes from, it comes from 1245. And so, for example, what is property integral to production? Well, that matters too, because in the farming context, some of our property is eligible for Section 179, whereas if it were used by a different kind of business, it might not be. And one example is agricultural fence. It is really integral to the production of our livestock and even our crops and things, the fencing. And so we can count that as 1245 property, and we can count that as eligible for Section 179. Outside of that context, if the fence has nothing to do with any sort of production activities, then you're not going to have Section 179 eligibility. So off-the-shelf computer software is also eligible, as is qualified real property. And we're going to talk about the definition of that as well. So here's the chart on page 150 that I really like to use because it talks about different things. Like sometimes the question will come up like, oh, what about a paved barn lot? Well, you have to run it through the statute and you say, well, is it depreciable? Is it used in production? And both of those answers are yes. Is it tangible? Yes. So it is 1245 property. It's property that is integral to production. So it's eligible for Section 179. Same would be for poultry houses. That falls into the category of single purpose ag buildings, hog houses, hog facilities, horticulture buildings. I think all of those fall into the category of 1245 property. Now, some people get a little bit rattled when we think about it's real property. That's okay that it's real. It doesn't matter. It's tangible. So it's eligible. All of those are eligible. The one farm property that's not eligible for Section 179 is the multi-purpose building, the storage building, the barn, right? Those are not. If you have more than one kind of livestock, or if you have a poultry building that also has an office, no, it's not single purpose. Like single purpose under the code means single purpose. Page 151 goes through what does qualified real property mean? So this went into effect with the Tax Cuts and Jobs Act, and it can be a little confusing in the agricultural world just to see how does this fit with our property. And so what it is it's qualified improvement property. We'll talk about that. And then there's another category of property eligible for Section 179. And notice the definition: any of the following improvements to non-residential real property that's placed in service after the date the non-residential real property was placed in service. That includes roofs, HVAC, fire protection, security systems. So those two categories of property were put into the code with the Tax Cuts and Jobs Act that make these things eligible for Section 179. But will these apply to our ag buildings? No. Why? Because they only apply to non-residential real property. Non-residential real property, 39-year property. So example 5.4 on page 151, Miley built a multi-purpose farm building to house farm equipment and supplies. In 24, she replaced the roof on the building. So is this an improvement eligible for Section 179? If I look back here, I say, oh, roofs. Okay, yeah, I can take Section 179. Am I able to do that? And so let's answer a polling question. Got to keep us on schedule here. I don't want to ruin Lisa's poll requirements. So hopefully this one lines up. And if any of these didn't line up, it's not because of Lisa, it's because of me when I submitted them. But here's your polling question. Is a new roof on a farm building eligible for Section 179? What do you think? Yes or no? I'm going to stop talking a minute so you know I'm asking a polling question. And that means you can turn your mic on if you want to say anything. You can let me know you're still here if you have any thoughts or comments. We're a little bit split on this answer, so it's a good thing we're talking about it. All right, I'm going to end the poll, and I'm going to say that no, it's not eligible for Section 179. And the answer is why? Well, qualified real property eligible for Section 179 is limited to improvements to non-residential real property, right? So it is 39-year property. Here, it's a farm building. It's a multi-purpose building. It has a class life of 20 years. So she's not eligible for Section 179. She is eligible for bonus. So the roof would be like a new asset that she's created that year. She could take bonus depreciation, or she could just choose to depreciate it over 20 years if she wanted. So let's look at the definition of qualified improvement property. It's any improvement to an interior portion of a building that's non-residential real property if the improvement is placed in service after the date the building was placed in service. So this one actually can be helpful to some of our clients, even who are farmers. They might have a type of building that's not actually a farm building. And so we do need to know how qualified improvement property works. Now, it doesn't include if you're enlarging the building, it doesn't include an elevator and no internal structural framework. But here's an example that shows how this one might work. So Cyrus is a farmer. He's a seed corn salesman. In 2020, he built a building on his farm to store seed corn and house an office. When he began using the office, it was functional but sparse. So in 24, he remodeled the inside of the office. He hung drywall, he installed a lower ceiling, and this all cost him $20,000. Now, are these improvements eligible for Section 179? So let's walk through all of this. So he's a farmer, but he's also a seed corn salesman. Is seed corn sales farming? No. The courts that have decided similar cases, that's a different trade or business. It's not a farming business. So here I would say that the building that he built for his seed corn business, which is, it's an agricultural adjunct business, but it's not an agricultural business. To be a farming business, you actually have to be involved in the growing and raising of crops, or the growing and raising of livestock. That's just what you have to do. And seed corn salesman is not growing and raising crops. It's just creating sales for seed corn. Even the producer of the seed corn is not farming. So when he began using his office, right, so he put the building into service in 24. And it wasn't until 4 years later that he remodeled the inside and he improved the inside. And so we go back to our definition of qualified improvement property. I think this does meet the definition, right? Because it's not a farm building, so it would be a 39-year commercial building. And this is an improvement that he placed in service after the date the building was placed in service. And it didn't enlarge the building, or it wasn't just putting internal structural framework. It was actually a true improvement. So I think here, Cyrus would qualify for Section 179. The whole idea of qualified improvement property was to encourage people to put improvements in things, stimulate the economy yet again. Doesn't work for farm buildings. It does work for non-residential real property. We just have to make sure that we're making the improvements ourselves if we're the taxpayer. So you can't buy something that's been improved by somebody else and then take a Section 179 deduction. Now let's look at page 152 for the next requirement, the next definition. It has to have been acquired by purchase. So we just went through the definition of Section 179 property. Now we're going to move on to the next bullet when we looked at what qualifies, and it has to be acquired by purchase. So purchasing something from a related party is not considered purchasing it. So it's interesting, if you follow the regulations in the tax code itself, where you find the bar on related parties is in the acquired by purchase requirement. And so who are related parties for purposes of section 179? Same related party rule applies to bonus depreciation as well. And it is our spouse, our ancestors, which would be our parents, our grandparents, our great-grandparents, and it would be our lineal descendants. So children, grandchildren, but who's not on the list? Siblings. So siblings are not related parties. It also does include all controlled groups. If I purchase from another member of the same control group, that also bars section 179. And so page 152, example 5.6 gives us this example. Corey purchased a planter from Talladega Incorporated. It's a C Corp. He and his wife own 60% of the value of that stock. So Corey cannot take section 179 because he and the corporation are related persons. You just have to look at 267B2 to get that answer. But now let's change the facts and say that Rhonda purchased a used tractor from her brother Brent. She paid Brent $50,000. Although Rhonda and Brent are siblings, they're not related persons. And so she can take a section 179 deduction. So we do see a lot of sibling purchases on the farm. So that is something good to know, that it's not excluded from section 179. Now, what was that requirement that said, okay, to be eligible, it had to be all these things, and it also had to be used in active trade or business, and it has to be used more than 50% in the trade or business. So trade or business, more than 50%. What is trade or business? So you all become really great experts of the definition of trade or business thanks to one provision in the tax code, section 199A, right? So when we had to figure out whether something was eligible for the QBI deduction, the big question was, is it a trade or business? And so in that case, if it was regular and continuous, it's a trade or business. But section 179 slips another word in front of trade or business, and it's active. So what is active? We have very little legislative history or anything else that defines it. But what we really believe is that if we're just renting farmland under a fixed price cash rent lease, we're probably not satisfying the active requirement. But if I'm engaged in a materially participating crop share lease, then I am active. If I am participating in a non-materially participating crop share lease where I'm reporting my rental income on Form 4835, I'm probably active as well because I am making some decisions. But there's another problem I might have in taking section 179 if I'm in a non-materially participating crop share lease. And so starting on page 153, we do run through what's called the non-corporate lessor rule. And what this rule says is, okay, any taxpayer other than a corporation cannot take the 179 deduction for property that they lease to others unless they meet certain requirements. And so what are the requirements? Well, the next bullet point tells us that either you had to have manufactured the property yourself, okay, then you can take it, or you have to meet two prongs of a two-prong test. Okay, so here are the prongs for the non-corporate lessor rule. The life of the lease must be less than 50% of the class life of the property. And if the farmland lease is renewable, it may be construed by the courts as having an indefinite life. So that is something that you need to be careful. If you have a renewable lease, you may need to sign something that says it's not going to be auto-renewed. So put that aside. Prong 2, during the first 12 months the property is leased, the total 162 business expenses allowed must be more than 15% of the rental income from the property. Okay, so let's put those into actual practical example. 5.8 on page 153, we have Sherry. Sherry rents her farmland under a crop share lease She pays 60% of the expenses and she gets 60% of the crop, okay? She has a 2-year lease with Liam, who's the tenant. So Sherry installed 10,000 feet of drainage tile on her property. It could be any sort of Section 179 property. Over here in the Midwest, we have a lot of drainage tile. All of that corn that we grow in Iowa would not be possible if we did not drain the farmland. So that's what asset we have here, but it could be anything. She borrowed the money to purchase the tile and she incurred a substantial amount of interest expense for the tile. Now, during the first year of her lease, she was responsible for $25,000 in ordinary business expenses associated with the farm lease, and she received $100,000 worth of corn as rent. So what would be the 162 expenses? It would be those expenses like the cost of the seed and the cost of all of those things that go into the farming and the fertilizer and all those things. So what do we say here? To qualify, she has to pass both the lease duration and the business deduction test. Here, I think she does. The 2-year lease is less than 50% of the 15-year class life of the property, so she passes that. And her total business deductions were more than 15% of her rental income. So if you can pass both those hurdles, you're eligible. She can take the Section 179 deduction. Here's just a practitioner note about where we can help clients provide value. You can help them suggest maybe go talk to an attorney and adjust your lease so that you can actually take advantage of a particular provision in the tax code. If Section 179 would make it possible, for example, to be able to put a particular item of property into service for that property, maybe you want to be an active lease instead of a non-active lease for a couple of years to allow that deduction. Now, the change in business use is something that we always have to be on the lookout for because Section 179 has a pretty hostile recapture rule. So if Section 179 property is not used predominantly in a trade or business of the taxpayer, at any time before the end of the property's recovery period, it's subject to recapture. So predominantly means what? More than 50% in business. Trade or business has the same meaning as Section 162. So if you convert the use of property from trade or business property to the production of income, that would be converting it to a personal use. So this is interesting because what might that mean? Well, if I am a landlord who puts some property into service and I qualify for the deduction, and then all of a sudden I'm not in a trade or business anymore, I'm just collecting income from a net lease, I might have to do some recapture. But how can we get around that? So these are the things we can help clients plan for. So Douglas farmed 1,000 acres of crop ground in southern Minnesota for 25 years. In 2020, this is toward the end of his farming career, he installed $70,000 worth of drainage tile and $8,000 worth of agricultural fence, and he expensed all of it using Section 179. In 2024, he stopped actively farming and he began cash renting the ground to 3 different tenants. He negotiated the leases. He required the tenants to report yield, soil fertility, conservation practices. He's responsible for repairing the drain tile, fences, and outbuildings. And I think you see where I'm going with this. To be eligible for Section 179 at the outset, Douglas had to be actively involved in a trade or business. But do you note that for recapture, he just has to be involved in a trade or business? So the question is, if Douglas, because he's still within the 15-year recovery period for that drainage tile, and even within the 7-year period for the fence, He's going to have to recapture the section 179 deduction if he's no longer in a trade or business. So the question for us is, it doesn't have to be active, but could his cash rental activity be trade or business activity? And if it is, then there's no section 179 recapture required. But if it isn't, then there is. And so it's the same question we would ask. And I'm going to ask you, do you think it's subject to recapture? This is going to be your last polling question before lunch. And the question is, would that rental activity, would it be eligible for the QBI deduction? Because it's the same question in terms of whether or not it's an actual trade or business. And so I'm going to tell you at the outset, here's a polling question, everybody, that I don't think it is subject to recapture. And the reason I don't think it's subject to recapture is because I think Douglas's rental activity is so significant that he's in a trade or business. It's regular and continuous. Remember, the standard is not that high for being in a trade or business. So it looks like most of you agree with me. And I'm going to go ahead and ask a couple more of you, maybe want to weigh in on this poll to get your credit. And then, gosh, it is time for lunch. So I'm going to end the poll and we are going to just leave off right here. And you all get to take a 50-minute lunch. If anybody has any, I'll stay on if anybody has any question real quick that they want to ask about what we talked about. But then we're going to pick up at 12:50 your time. It's 11 o'clock my time. So 12:50. So go have lunch, come back, and we'll pick up where we left off in chapter 5 with section 179. All right. Thanks, everybody. All right. See you soon.
And I'm going to go ahead and leave this open. I'll just put a little coffee thing up that says I'm away having lunch. Hopefully everybody else does the same, but I will leave the room open, and that way you don't have to worry about rejoining. You can just keep yourself on mute. That's fine. Unless you have a question, of course.
About 2 minutes out, I think. Hi, Lisa.
Hello. I hope everyone had a good lunch break.
Hopefully they had some lunch.
Also that. Hopefully you all took the time to stand up and stretch a little, move, get the blood flowing through your body, re-nourish yourselves, take a drink of water.
We have 1 minute before we get started. And then what we'll do is we'll go to 2:15 and then we'll take our 15-minute break. So if you're looking toward the next break already, it's from 2:15 to 2:30. I do think it's warmed back up outside in my neighborhood in Iowa. So hopefully you're getting a little sunshine there.
It's pretty overcast today. We have storms that are supposed to be coming in. I know here, I think it's either Saturday or Sunday when it's supposed to be down in the 20s again, which it's December, so I'll take it. Yeah, yeah, it is. It currently is raining, but hopefully maybe this
Well,
weekend the snow.
yeah,
Hopefully not ice.
I
Okay.
do have 12:50, Lisa, so I think I'll get started and we'll get going. We'll have polling questions just like last time, and we'll just keep things rolling. So you all have been doing a great job with the polling questions, and I'll also invite you. You're very welcome to unmute yourself and talk. It makes things interesting, so don't worry about that. We have a group that's not going to get out of hand here, so we can address the things that you want to address. So where we left off before lunch was our example 5.9, and I ask you a polling question, and I just put now up what I think is the answer. I think that Douglas is in the trade or business of renting farmland, even though he's no longer actively farming, because his rental activity is regular, continuous, it's for a profit. And so because of that, I do not think he has to recapture the Section 179 deduction that he took in 2020 for the Section 179, because I think he's still using his drainage tile predominantly in a trade or business. So that's how you kind of would work through those questions, and different people might come up with different answers because it's not all black and white in tax law, as you know. All right, the next section that we're going to talk about when we're talking about our deep dive into Section 179 are all of the limits. And I think, honestly, this is where it gets really interesting when we're helping clients, because we can have clients that have entities and we can have clients that may not be eligible for the Section 179 deduction in their own right because they've exceeded the dollar limit, but the entity still passes it through, and all of those things. So we're just going to firm up how these limits apply. How do they apply to spouses? How do they apply in the entity context as well? So that's where we're headed with this. And we're going to kind of review all of that. So the dollar limit, of course, that we're talking about is every single year it's indexed for inflation. And as we said, the Tax Cuts and Jobs Act doubled the Section 179 from 500,000 to 1 million. And then it's indexed for inflation. And that was a permanent increase. So we are not looking at the end of next year to see this thing suspended or anything change. Congress doesn't have to act to keep us right on track for next year's Section 179 deduction. The amounts have already come out, and it's just a little bit higher than it is this year. But for our tax returns that we're filling out this year, it's $1.22 million. And that's the deduction limit. We cannot take more than $1.22 million of Section 179 in any given year. And so here's how that works. In a simple example, we have John. He's a calendar year taxpayer. He placed in service the following equipment: a combine, a tractor, a used tractor. And when you add it all up, it's 1.3 million. So John exceeds the Section 179 deduction limit by $80,000. So what does that mean? Well, it just means that he can take the full amount of the Section 179 if he wants to. And then he'll have the remainder of the basis able to be used either bonus, he can use that, or he can just take straight up maker's depreciation. He has the ability to choose whatever he wants. Of course, we do not get to carry forward any excess deduction that we weren't able to take this year because of the dollar limit. We don't get to take that forward to next year. So we have to find our alternative method to get our cost recovery from that excess. The more troubling limit in terms of how it works, I think, is the investment limit. And this is a limit that's been pretty high for a long time. The permanent amount is 2.5, but indexed for inflation, we're up to $3.05 million here this year in 24. And so what does it mean? Well, every dollar of Section 179 property that we put in service that exceeds that amount, we have to lower our deduction limit, which is $1.22 million, by $1. So if you're following, then that means that if I place into service $4.27 million or more of Section 179 property, I don't get a Section 179 deduction anymore. And we'll talk about entities in a little while, because this is the limit that I have seen people starting to reach with farm partnerships and farm S corporations and farm entities, LLCs that are multiple member. They will be putting into service in some years property that exceeds that investment limit. And so they're unable to take Section 179. And then that also means that with bonus waning, they don't have a lot of accelerated cost recovery options. And so for those folks, I think it really matters what happens with bonus depreciation. Also, I just think that there might be some ways around that we'll talk about a little bit later. But here's the straightforward example. We have ABC Farming. It's a C Corp that places $3.3 million of Section 179 property into service this year. And the statutory investment limit, of course, is 3.05. And so when you do the math, they are $250,000 over the investment limit. So that comes right off the top of the 1.22. So their Section 179 limit is $970,000. So straight up example, if you haven't encountered that at all. Now, remember that the Section 179 limits apply to each taxpayer. They don't apply to trades or businesses. So if I'm operating 3 different businesses, but I'm the single taxpayer, they're all Schedule Fs, or I have a Schedule F and 2 Schedule Cs, my investment limit is for all of those businesses. Also, income from active trade or business is another limit, of course, that we have. And so where we get to look is any net income that we derive by active conduct in a trade or business during the year. And of course, this is really broad because this is not limited to the specific trade or business where I'm purchasing the asset either. So the rule even allows me to count my W-2 wage income as active trade or business income, my spouse's wage income. So we have a lot of leeway here. Now, if you want to look specifically where the software and I note that a lot of times our software does all of this, but then when our software does all of this, then we're not really thinking about what's happening in the background. So that's the point of this chapter, is to make sure that we understand, because I think it helps us plan better for our clients. So page 155 lists all of the sources of active trade or business income that we include when we're trying to figure out whether we have sufficient active trade or business income to absorb our Section 179 deduction. So remember that active is a completely different standard than material participant. So 469, the passive activity rules, totally different. Meaningful participation in management is really all we have to have for any sort of active participation, where Material participation is regular, continuous, substantial. Remember the 500 hours in many cases. If nobody else is in the business, we can get away with lower hours, but it is a significant standard as opposed to active conduct in a trade or business. Now, what about the carry forward? Well, here we actually get to have a carry forward if we exceed our active business income limit with our deduction in a particular year. And this is an unlimited number of years that we can carry it forward. What we do is we report the disallowed amount on our form 4562, and then that amount is used in determining next year's section 179. And if we do not have enough active business income next year, we just carry it forward again. So we do have a simple example here where we have Teresa. She had $50,000 of active trade or business income in 2023, and it comprised $40,000 of net Schedule F income, and then she had wages from a part-time job. She placed in service farm equipment that cost $60,000. She took Section 179 deduction, but the cost of the equipment exceeded her active business income, so she had a carryover of $10,000. So she reports all of this on her 4562. She's got the 50,000 on line 12, and she's got the carryover on line 13. And then what happens the next year? She places 30,000 of property into service. She reports $65,000 of active business income. And here she gets to absorb all of it and report the carryover deduction as an actual Section 179 deduction. So, what's the benefit of that as opposed to just not taking the full amount of the Section 179 deduction? Well, it allows you obviously some accelerated cost recovery in the next year when perhaps you would have more income and you would need it more. So it can be a helpful carryover. It is the only limit that allows you that carryover. So just remember that. Now there is a weird circular calculation. It's addressed on page 157 with all the charts and the graphs and the pictures, but we're not going to go into that, or you guys would really tune out on me. But while Section 179 has an active business income limit, other deductions also have a taxable income limit. So the question is, right, it's a circular problem. If I have to use my Section 179 deduction to calculate this limit, and I have to use this deduction to calculate this limit, which comes first, the chicken or the egg? You can use the IRS rules to do that. And I think it's pretty straightforward, and it's in that book. If you ever have to do it, you can just turn there and look. Now, how do these limits apply to spouses? And so the thing about Section 179 is that married taxpayers are treated as one taxpayer for purposes of Section 179. It doesn't matter if we file joint returns, separate returns, whether only one spouse puts something in service. It's one taxpayer in the IRS's eyes. If you file separate returns, then what happens is you're each entitled to 50% of the yearly limits unless you allocate it separately. You can agree to allocate it however you want, but 50% is the default. So if you're in a battle, haven't been divorced yet, but you're separated and you can't get along, it's going to be 50%. Also, the shared yearly investment limit is the total cost of Section 179 property placed in service by both spouses. And if you file joint returns, then you consider your spouse's active business income. But if you file separate returns, you only get to consider your own. So that's actually a penalty to you. So here's an example of how this works. On page 158, we have James and Marcia, and they're married. They file separate returns. James runs his own small business. He placed $1.7 million of Section 179 property into service. Marcia has a farm. She placed $1.4 million of Section 179 property into service, and they file separately, but they have to total all of their expenses for purposes, all of their costs for purposes of the investment limit. And the cost of the property they placed in service exceeds the investment limit by $50,000. So that means that their Section 179 dollar limit is reduced to 1.170. Now, by default, they can each elect to take half of the Section 179 deduction, or they can elect a different percentage if they're getting along and they find it beneficial. So how about the dollar limit and pass-throughs? This is where it gets more interesting with pass-through entities. So if a partnership and an S corporation allocates the Section 179 deduction to their partners, then the yearly dollar limit applies at both the partnership or the S corporation level, as well as at the partner or shareholder level. And even though the deduction is taken at that partner or shareholder level, the expense calculation is limited by the annual dollar limit. Also, the partner or S corporation shareholder has to add the allocable shares of the Section 179 deduction to their own Section 179 deduction from any other business they have to determine if they've exceeded the annual dollar limit. So the question is, if you do exceed it, can that amount be recovered on sale? So I'm going to launch your first polling question after the break and see what we think. The question that I'm talking about when I said, can this amount be recovered on sale? It's, let's say that you are a partner in a partnership, you're a shareholder in an S corporation, and you have your own farming business, and you have been passed through from a partnership and an S corporation more than your yearly dollar limit. So you cannot take advantage of both of those. And the basis for the property in the partnership or the S corporation is still lowered, like you were able to take advantage of it. Does this get remedied when you sell the property? So there's a polling question, folks. I'm going to be quiet a second because I don't think you realize that. There we go. We're back from break. Need a polling question. I don't want to deny you credit from the IRS. That's why we have to ask these pesky questions, but it also gives us a chance to kind of touch base and see if there's anything you want to say or share. And most of you do have the right answer here. And the answer is no, it cannot be recovered upon sale, which is a very bad result. So this is something we got to watch out for. So here we're going to go through it in a little bit more detail. But if a partner or S corporation shareholder's total Section 179 expense exceeds the dollar limit, it cannot be carried forward and it's permanently lost. But our adjusted basis in the property has to be reduced by the share that was passed through to us by the entity. So here's an example on page 158. We have Emily. She owns an interest in two farming partnerships, Green Acres and Sunnyfields Farm. They both elected Section 179. Green Acres allocated $700,000 to Emily. Sunnyfields Farm allocated $700,000. Emily's annual Section 179 deduction limit is, of course, $1.22 million. The combined deductions from both farms exceeds Emily's annual limit by $180,000. So if it were just because she was wanting to take Section 179 for a tractor that she purchased outside of the partnerships, then she could choose not to make that election and she'd be okay. But here's the example where the two partnerships are making the decisions and she's sort of left out, and it's a really bad result for her. So what happens? Well, the Section 179 deductions allocated to her, the excess $180,000 cannot be carried forward. She has to reduce her basis in both farming partnerships as if she were able to have taken the entire Section 179 deduction. So what's our remedy? Well, we reach out to the partnership and we say, hey, can you revoke a portion of the Section 179? Can you help me here? And so it depends, right? Some partnerships that our clients might be part of might be way big beyond our own ability to influence, but if we can influence them, we definitely try, because this is a bad result where you just actually lose a tax benefit outright. No other cost recovery, you don't get to take depreciation, nothing. Now, how does the investment limit work? Well, thankfully, it's a little kinder. So the investment limit is applied also at both the entity level and the owner level, but we don't take into account the cost of equipment put in service by the partnership, for example, if I'm just the partner. I don't take into account that amount. I only take into account my own property that I placed in service. So that is helpful. That prevents bad results. But this is the example of where entities, in my experience, have been bumping up against this threshold a lot more frequently. So we have AB Incorporated. It's a calendar year S Corp. It placed $1.8 million of Section 179 property into service. The S Corp chose to take the maximum deduction, allocating $610,000 of the deduction to shareholder A and $610,000 of the deduction to shareholder B. Shareholder A also placed $2.6 million of property into service, choosing to take an additional $610,000 deduction for that property. So the question is shareholder A okay under these facts? And the answer is yeah, she can take the full 1.22 deduction because the property that he placed into service was below the investment limit of $3 million. You do not have to add in the property placed in service by the entity. And so that is a better result. Now, what about the active conduct in trade or business limit? How does that apply to the entity? Well, like the other limits, the income limit applies at the partnership and the S corporation level, but it is a separate look than it is at the individual level. So the entity itself has to have active trade or business income sufficient to absorb any Section 179 that's passed out to its owners. And the items that you include in those entities' active business income calculation, those are listed on page 159 in your book. So that kind of lists the different fields that you look at. If you do have multiple trades or businesses, obviously the income can come from anywhere. So I can have a big wage earning job over here, a small farm over here, and if I buy a tractor, I'll have enough active trade or business income because of my wages job to offset that, and I'll be okay. So just remember that. What about different tax years? This is an issue that comes about because of the way that Section 179 works, because it says if the the tax year that you place it in service. Now with bonus, it's just the year, the calendar year, so it's different. But with Section 179, it's tied to your tax year. So there are times when the entity has a different tax year than the individual, because most of our individuals have a calendar tax year. Now, some of yours don't. If they don't, then you have to always think about how that works. But more entities do not use calendar years. So we have to figure out how that works. So here's the example. Sarah and Michael Green are equal partners in Green Ventures. Green Ventures uses a tax year that ends March 31st. Sarah and Michael both use a tax year ending December 31st. For its tax year ending March 31st, Green Ventures taxable income from actively conducting its business is $100,000. 90,000 of that was earned during 23. So the way that we allocate is Sarah and Michael each include $50,000, their entire share of partnership taxable income in their business income limit computation for the 2024 year, because that is when it's attributed to them. A partnership or an S corporation, what do? Well, you have to reduce the basis of the assets for the full amount of the Section 179 expense that's elected, even if the entire expense cannot be passed through because of the business income limit. All right, so this is very much like the Section 179 deduction limit, with a catch. This one is a little bit kinder. So what happens is we reduce it at the time of the deduction, even if the entity did not have enough, and the owners reduce their basis only by the amount passed through. So we take the election, we reduce it at the entity level, but we do not pass it through, so the owner's basis is not reduced. an owner's basis in the entity is reduced, even if the taxable income limit restricts the Section 179 deduction at the owner limit. Remember that. But any Section 179 carryover, because remember, with the active business income limit, the entity then the next year might have enough income and then they can pass it through. And so if you get to the end of the entity and you still had a carryover, then that will actually increase the owner's basis at the time the entity is sold. So again, this basis rule is much kinder than the other rule. That is only for the business income limit. It's only increased when the entity is disposed of if the basis was decreased because of the business income limit. If it was reduced because the Section 179 expense was unused because of the dollar limitation, remember that basis reduction is permanent. You do not ever get to make that up. Now, there are also some special rules that apply to component members of controlled groups. So this is how do we look at the limits for Section 179 when we're talking about different members of control groups? So component members of a control group, even if they do not file a consolidated tax return, they're treated as a single taxpayer for both the dollar limit and the business income limit. So for Section 179, if you're looking at a control group, you look at 1563, but you use the more than 50% test instead of the more than 80% test. And then let's just look at whether or not an S corporation is subject to the control group test. What do you think? Does this apply to S corporations? So we're up to another polling question. We're just rolling along here this afternoon. So let me move my window here out of the way so I can launch that poll. Hopefully you're all out there doing okay. We're gonna ask this one, does this limit apply to S corporations? And so what we're talking about here is the control group limits for Section 179. So I need you all to answer your polling question. Give you a few more seconds. I'm going to show you the answer while you're finishing up. So what the IRS has told us is that even if an S corporation is a member of a control group, I'm going to end the poll. It's not treated as a single taxpayer for purposes of the Section 179 limit. So that might come in handy at certain times. What else might we have noticed from that? What are the control groups treated as the single taxpayer for? Which limits? Well, for the business income limit and the dollar limit. Which one is not? The investment limit. So I mentioned at the onset that we're seeing more and more entities that are subject to the investment limit. And so the question has arisen, if this is something that is a yearly problem, and maybe there's just a real giant entity, if the entity were naturally able to be split in a way that would be useful in the business, instead of maybe one big LLC, maybe you have two, and maybe you have the single purpose ag buildings over here, and you have some of the equipment here, then could you be okay even if they're owned by the same people, or would you have to share the same investment limit? And in the law, there's no requirement for you to share the same investment limit. So it seems like you could actually split it and you would be eligible for the Section 179 deduction in both entities if you've been barred because of that investment limit. Okay, now what we're going to do in the chapter, page 161, there's a number of special situations with Section 179 that this chapter reviews that I kind of want to highlight. And the first one is Section 179 and energy property. And so the big question I get is always, can you use Section 179 for solar panels, etc.? And the answer is actually more complex than it seems because it generally can be used. So generally, there's nothing that would prevent Section 179, if that's all you were doing was buying a solar panel, installing it, taking no other tax credits or anything, just wanted to be able to depreciate it, you could depreciate it over 5 years, or it would seem to be eligible for expensing. But what prevents it is Section 48 considers solar panels to be energy property. And if you are trying to take a tax credit for energy property, then you're not allowed to take Section 179, because if you take Section 179, it takes you out of the definition of that property being energy property. Voila, it's not eligible for the lucrative 30% tax credit. And so you never probably want to trade a Section 179 deduction for your 30% tax credit. So that's why you can't use it. They cannot go together, but otherwise you could use it. So Sunny Beef LLP installed solar panels in 2024 to generate electricity for his single purpose agricultural building. The project cost $50,000. It was a small project. It was eligible for the 30% investment tax credit, $15,000 credit. So the way that works, you only have to reduce your basis by half of the credit amount. It's eligible for 60% bonus depreciation this year. The remaining basis is depreciated over 5 years using the 200% declining balance method. And so first year depreciation is allowed, but here Section 179 is not, or the credit entirely would be disallowed. The other issue that has been very confusing for tax professionals, and there's been misinformation that has gone out about this for a number of years, and that is what happened after the Tax Cuts and Jobs Act eliminated real or personal property exchanges. Are we still allowed to take Section 179 for the trade-in value of the property relinquished? In other words, if I trade a tractor for a new tractor, I'm obviously paying for the new tractor partially with the value of my old tractor, and then I add boot. Do I get to take Section 179 for the entire cost of the new tractor, or do I only get to take it for the portion of cash boot that I pay? Now, the old rules, the old way it worked when we had a 1031 exchange, we only got to take Section 179 for the cash boot that we paid because we had a carryover basis. And so that was why. Because 1031 no longer allows a carryover basis, the restriction on Section 179 does not apply. And so what we are left with is an example like this. In 2020, Marvin purchased a tractor for $200,000. He expensed the entire cost. In 2024, he traded the tractor. The new tractor cost $300,000. He paid the dealership $125,000 cash, and the rest was the value of his tractor that he traded in. So in 24, he has to report the sale of his used tractor. And how much was that? Well, $175,000 was the value they gave him. So it's a sale on $47.97, subject to ordinary income tax, not subject to self-employment tax. But he can make an election under Section 179 to expense the entire cost of the new tractor, all the way up to $300,000. Why? Because the basis of his old tractor is, the basis of that new tractor is not determined in regard to the used tractor. It's completely separate. So the entire cost is eligible. So what about single purpose agricultural buildings in section 179? And when is something a single purpose agricultural building? I know that you all have a lot of hot houses out there, you have horticultural structures, and so it's really important that we sort of maybe really look at the definition in the code, because if we look in the code, we actually have a pretty good definition. So classifying a building structure under the tax code, we have to determine the purpose for which the structure was designed and the purpose for which it's used. And that test should really apply equally whatever the building is. If it's a hoop building, if it's a structure, it just, what we're going to look at is the reason we made it and the purpose. And if we can justify that it is a building and we did it for single purpose of horticulture or for a single type of livestock, then we're eligible for section 179. The structures have to be designed for and used solely for the feed and care of specific animals or for the commercial production of plants, and they have to otherwise meet the definition. And again, if we meet that, then we should be okay. The other area where we have a special rule that applies to section 179 is SUVs. So you know that with regard to vehicles, we have all these passenger vehicles, which are less than 6,000 pounds. And then we have SUVs that are essentially just 6,000 to 14,000, but there's a few exclusions for certain vehicles that we'll look at, but it's not that they necessarily look like an SUV. They're just classified as an SUV under the tax code based upon their weight and their use. And so we have a special limit for section 179 and 24 of $30,500. And so an SUV is just a four-wheeled vehicle designed to carry passengers on public streets, and more than 6,000, but less than or equal to 14,000. And the exclusions are buses and pickup trucks and vans that meet these definitions. Again, it's not any pickup truck in the farming world. It really matters because it only excludes pickup trucks that are equipped with a cargo area of at least 6 feet in length. That is an open area designed for use as an open area. So if you have a client that has a pickup truck that meets that definition, it is not subject to the section 179 limit, but otherwise it is. Cargo vans are not subject to that limit either. So we can elect. How do we make the election? And we're going to talk a little bit more, I think, about vehicles a little bit later after we talk about bonus depreciation. But we can elect to expense part or all of the cost of the section 179 property that we place in service. And of course, we're making all of these determinations on Form 4562. And the cool thing, as you know, about section 179 is that I can make this election on the original return, or I can make it on the amended return. And that is really helpful because the benefit of hindsight is super helpful for some of these elections. And so we just have to make sure that we make them in a timely manner, but amended returns work. I can revoke the section 179 election on an amended return. I just have to make sure that once I make that revocation is irrevocable. So you can't just keep doing it. You get a one-time rebite at the apple. So qualified, that's section 179. And as I said, we kind of went through a deep dive on that because I do think it is the single biggest tool that we have in our tool belt for our agricultural producers in terms of kind of getting their income just where we want it to be for tax purposes. The other tool that we have that is kind of going away as we talked, but it can be important. And especially we looked at places where it is really important if we have exceeded our deduction limit somehow, or we're ineligible for section 179 because we're not in an active trade or business. Maybe we are a cash rent landlord or something. In that case, we can still take bonus depreciation because Bonus, we're going to be eligible for that if we're eligible to depreciate the asset. So section 212 property works fine for bonus. It doesn't work fine for section 179. It has to be a 162 asset. So what is eligible for bonus? Well, it's any tangible property depreciated under makers that has a recovery period of 20 years or less. So that's why when we looked at qualified improvement property, we had that special new rule put into place with the Tax Cuts and Jobs Act, because they recognize, okay, I can't take bonus for a commercial building, so there's really no tax incentive. There were some rules that used to exist specifically to restaurants and stuff, but they made the qualified improvement property more broad, thinking, well, let's stimulate investment in these commercial buildings, so we'll allow section 179. And they wanted to allow bonus, but you remember that they made a big guffaw. They forgot to put a 15-year limit in the definition of qualified improvement properties. So for the first couple of years after the Tax Cuts and Jobs Act, there was no bonus allowed for qualified improvement property. And then they fixed it retroactively. And then it kind of confused everybody because there were all these special rev procs that said, oh, you can do this on an amended return, blah, blah, blah. So then everybody suddenly thought you could take bonus or change your election out of bonus on an amended return, and that's just not the case. So let's kind of dig in and remind ourselves what is qualified property. Down there at the bottom of the list, qualified improvement property is eligible. So when we talked about that commercial building for the seed corn salesman, that's why bonus is also allowed for that. So let's do our next polling question, and I'm going to ask you, which year, if you remember, is bonus depreciation scheduled to actually come to an end altogether if Congress does not renew it? And this one might be different than you think. You all are sharp. A lot of people that don't work with bonus a lot say, oh, it must be 25, because that's when all of the provisions from the Tax Cuts and Jobs Act are ending. But that's not true of bonus. So give you a few more seconds to weigh in. Somebody's Googling the answer for polling questions. Nope, that's great. There is no unethical way to answer a polling question. I shouldn't tell you, but you don't even have to try to get the right answer. This is just for the IRS purposes, unfortunately. So we're going to look at that and see, when is it scheduled to end? So we're going to look at that phase out in just a minute, but 2026, we have it. So it's actually scheduled to end, well, at the end of 26, which would mean that we would not have bonus in 27. So farmers this year, as you know, they can take 60% of the basis of depreciable property. Unlike section 179, they can use it for the multi-purpose farm buildings because those have a 20-year life. So they get just in under the wire on eligibility for bonus. The difference though, right, way less flexible than section 179. Bonus has to be taken for the entire class. So if I take it for my tractor, I have to take it for my combine and all of my other farm equipment, all of my new farm equipment, all of my 5-year property. Wow, that's a lot of property maybe. So you have to kind of work with clients to figure out when bonus is appropriate and when it's not. And again, it's automatic unless I elect out. There's the phase out again. So just in January, we're down to 40%. So we'll see what Congress does. We could have some retroactive rules. We all hate those. To be eligible for bonus, qualified property has to either meet an original use requirement or the qualifying acquisition requirement. So original use means the first use to which the property is put by the taxpayer, or additional capital expenditures to rebuild property those can also satisfy the original use requirement. So here's just a simple example to show what that means. You read this in the regulations, but you kind of need to know what it means. On July 1st, 2024, John bought a used tractor from Alicia for $20,000. He uses the tractor in his farming business. He makes a $5,000 capital expenditure to recondition the tractor. His purchase of the tractor was a used property acquisition. Assuming all the other requirements are met, his $20,000 purchase price qualifies for the bonus depreciation deduction, and his $5,000 reconditioning expense also qualifies. So it can be a separate asset or it can be added to the basis of the machine, whichever you want to do, and both are eligible for bonus. If the taxpayer initially, this is something unique to bonus. If the taxpayer initially acquired new property for personal use and then converts it to a trade or business use or for a use for the production of income, we are still considered the original user of the property, and you can actually take bonus depreciation in the year you place it into service. So this is unique. It's only for bonus depreciation, but it also works for depreciation, but it does not work for Section 179. So the example on page 524 illustrates this on page 165. So we have Andrea, and she built a machine shed in 2021. She was building it for personal use. She stored her personal vehicles. She entertained her family. She was going to build a larger equipment shed later, but then she just decided, you know what? I don't really feel like adding all the extra expense. Things seem a little bit uncertain now on the farm. Farm income's down. So in 24, she converted the personal use building into a multi-purpose farm building. So you would know, well, at that point, she would be eligible to depreciate that over 20 years. But just so you know, she is also eligible to take bonus depreciation in that year she placed it into service for her business. So that's kind of a helpful thing to know. But again, that trick doesn't work for Section 179. Also, property that we previously leased can qualify for bonus if it's otherwise qualified property and if the taxpayer or the predecessor didn't have a prior depreciable interest in the property. So let's look at how that works. Jess leased a combine from Frontline Implement in 2021. The lease was a true lease. I say true lease because we have a lot of capital leases. We have a lot of people out there that try to convince our clients that they can do sort of a rent to own. But if you analyze the documents, it's really not a lease at all. It's really an installment agreement, and it's breaking all the tax rules that go along with that. So I was going to draw your attention. We're not going to have time to go into the depths of it. But chapter 7 of your workbook, it starts on page 201. There's a little chapter, it's not very big, but it has a little chapter on lease versus purchase of farm assets. And a couple things I wanted to point out so you know they're there. First of all, the page 202 gives a nice breakdown. If you've ever like, oh, I know there's rules about when something's a lease and when it's a purchase. What are those rules? This section, you can turn to that and it directs you to the proper code section and the regulations that you have to look at. And then it also says, you know, it's not limited to equipment because we have been seeing a really interesting trend in the Midwest. I'd be interested to know if you've seen this at all. Builders of buildings have been going out to our farmers and telling them that they can rent to own a new building. So basically they own the land, the farmer owns the land, and then the building company says that they will build a building for them, but the farmer doesn't consider it owned until at the end of this lease contract. And it definitely seems more like a financing agreement for the property instead of a lease agreement. But of course, the people who are telling our farmers that it's a lease are leading them astray, and then we have to be the ones to do the investigation. So just making sure that we pay attention in that. So in this example, she buys the combine that she was leasing, and it qualifies for bonus depreciation in this particular case. So just how that works, keep that in mind. Page 167 just shares with us and reminds us of what the ordering rules are for our different cost recovery tools. So first we take our section 179. Then we take bonus, then we take makers. So if we elect out a bonus, if we do not take the section 179 deduction, then, we can just knock out 1 and 2 however we choose. We can only take makers if we want to. But it is interesting how it all fits together and how that's changed from 2 years ago when we had the high bonus depreciation. It made a big difference. Now we don't have such a benefit. So on February 14, Josh purchased a new tractor. He placed it into service, and the tractor cost $250,000. And he, using your help, decided, well, the best thing is to expense $50,000 of the cost under section 179. So he's got the bonus down to 200. He doesn't elect out a bonus, so then he takes 60% of that remaining basis as bonus depreciation. So that's $120,000 deduction. And then the remaining cost of $80,000 he uses to calculate his regular maker's depreciation. And it's 5-year property because it was a new tractor. So that's how he would expense it. He could elect out a bonus and do the rest with makers. He could do the entire thing with section 179. Here might be a good point with this ordering slide to just highlight something. We're going to talk about the fact that you cannot elect out a bonus or choose to just change your mind on bonus on an amended return. But notice that because you can change your mind with section 179, by virtue of doing that, you can change your mind on bonus in some cases. So let's say that Josh didn't take any section 179 and he just elected to expense using, did not elect out of bonus depreciation. Well, if he later decided to take the full section 179 deduction, it eliminates his bonus depreciation deduction because section 179 comes first. So there are a few ways around that rule that limits our ability to change our mind on an amended return. So although the deduction is automatic, we have to elect out, like we said. All of this is on page 167. To make that election, we attach a statement to our timely filed form 4562. So as I said earlier today, just make sure that your software is spitting that election out. Make sure on all of your farm returns that you actually have a written statement electing out a bonus if you do not calculate a bonus depreciation deduction, because otherwise you are considered to have taken bonus even if you did not take it, right? Depreciation is always allowable or is versus actually taken, allowed or allowable. And if it's allowable and you did not take it, you're still deemed to have taken it, and it will harm you in the end. So you have to make this election by the due date, including extensions of your federal return. That's it. If you fail to make the election, you have this narrow window where if you file early, so let's say you file by March 1st because you're a farmer and you didn't want to pay estimates, then your tax return was technically not due until April 15. If you go ahead and change your mind, you can file an amended return before October 15, and you can write at the top, filed pursuant to section 301-9100-2, and that is timely. But if you wait and you get past that extended deadline, you are out of luck, and an election out cannot be revoked without a private letter ruling, which is very expensive, so we don't want to do that. So let's just highlight on page 168 some of the rules for vehicles, how they apply for our 2024 tax returns. And so this section of the book just kind of walks through all the different vehicles that we might find on a farm. And we have a lot of passenger vehicles. Those are really any four-wheel vehicles that are less than that 6,000 pounds. The question I have, because we got to stay up to speed on our polling questions, is, are passenger vehicles listed property? So hold that thought and I'll open the poll and we'll get your wisdom on this one. Are passenger vehicles listed property? Yes or no? Give you a few seconds. If I stop talking, you're like, oh, what happened? Oh, must be a polling question. Oh, you're quick. Thank you very much.
Christine,
Go ahead.
I have a question. Under the SUV exclusion, it had a definition of pickup trucks with a 6-foot bed requirement.
Yep.
That's the first time I've seen that, the bed requirement. I know a lot of trucks are sold with 5-foot or 6-foot beds. So it's like, wow, what if a farmer wants to buy a 5-foot bed? Does it have a tax implications? When we look at these vehicles, they're based on gross vehicle weight. So do you think that the 5-foot, 6-foot distinction goes beyond just the SUV exclusion? I've never seen it anywhere else.
Just for the SUV exclusion, that is
Okay.
it.
Okay.
Yes. So if you do not want to be limited to 30,000 and some odd dollars in your section 179 deduction in 2024, then you have to have a cargo area of at least 6 feet. But if you have a cargo area of 5 feet, you still get to follow all the other rules. You get to take a 30, you get to do better. I mean, if you have a cargo area, of 5 feet, you're limited to the 30,000. If you have a cargo area of at least 6 feet, you have no section 179 limit, and you can take section 179 to the price of the vehicle if you so choose. That's how that works. But otherwise, it doesn't really harm you, because the worst thing that can happen is you're limited to the $30,000 limit.
Okay, thank you.
Good question. I like questions. That's great. It makes me realize you're out there. So let's look at the table here. It's on page 169. I'm going to end the poll and we'll dive back here. The passenger vehicle limits for this year, tax year 1, 12,400 in the first year. If you do not take bonus, if you do take bonus, it's 20,400. And then you can see the numbers. Every year they're just adjusted for inflation. So this is for nothing new. It's just the new 24 numbers that we'll use when we're doing our returns. And of course, these numbers apply to the 100% business use. So if you have less than 100%, you have to prorate, but these are listed properties. The answer to your polling question was yes. So you have to use the vehicle more than 50% for business purposes. If you do not, you're not eligible for these special rules, but we get to prorate. So if you use it 60% business, 40% personal, then you would take 60% of the numbers here. So let's just spin through a couple of examples that we have. Page 170, example 5.28. Len acquired and placed in service an SUV. He bought it for $64,000. It was his primary farming vehicle. He's able to document 100% business use through his travel logs. The SUV has a gross vehicle weight of $8,000. So here he can take $30,500 of section 179, then apply 60% bonus to the remaining basis, and then he uses makers to depreciate the balance. Now pause here. This is a great example to use to say, if the vehicle that he had placed into service was an 8,000 pound truck with a 6-foot bed, he wouldn't be subject to the 30,000 limit. He could take the entire thing under section 179 if he wanted. We also have the extra rule for farmers. It's a temporary Treasury regulation that's been in place for decades. Don't you love those temporary regulations? It's kind of like material participation. All the rules that we look at, right, with the 500 hours, the 100 hours, etc. Those are just a temporary Treasury regulation that's never been changed and probably never will be. But this one for farmers is a pretty good one because a lot of times you'll have a car or a pickup truck that you use for both business and personal. But our farmers are really bad about keeping logs. So they don't have any log that tells how much is for business, how much is for personal. And IRS really does require that for the vehicles. So under this regulation, if you're a farmer, you can claim 75% of the use of your vehicle for business use without any specific allocation records, as long as you use the vehicle during most of your normal business days directly in connection with your business of farming. So if you have a client that doesn't have any allocation records and they use it for both business and personal, this is a great rig to fall back on, and you're just going to be using 75%. Let's look at another example. This one is a passenger vehicle. So we have some farmers that use light duty pickup trucks. So if it weighs less than 6,000 pounds, then it's just treated like a passenger vehicle subject to those limits. It's listed property. So Lucy acquired and placed it into service for $24,000. She uses it 100% in her business. So her purchase is eligible for bonus and Section 179, but it's subject to those limits. So her maximum deduction in 24 is 20,400 if she does not elect out of bonus, but she's not really going to get that far because of the numbers. We'll see how that works. If she elects out of bonus, her first year depreciation deduction is limited to 12,400. So let's look at what she can do. She can take a 12,400 Section 179 deduction, and then she can take up to an $8,000 bonus depreciation deduction. But with bonus at only 60%, you can see you're not going to get to your full limit. So she starts with 24,000. She gets to take the Section 179 deduction, but that only leaves 11,000 of basis. She can only take 60% of that. So she's going to have 4940 to depreciate over the 5-year life of her asset. So the shifting around of bonus has changed the way these things work. So the last little section in this chapter, the figure 5.4, I think is a great resource for you to maybe bookmark or something in this book. It's pretty detailed. We've had charts like this in the book in the past, but this one is a lot more detailed. I added a lot of extra things to it. So let's see, this is on page 172, I think. Let's make sure that's the right page. Yeah, page 171 and 172. And if you're just trying to remember some of the differences, this is a good place to go. It's got the SUV limits, the general limitations, the business income limit, election, qualifying property, etc. So again, hopefully another resource that's helpful for you. And that takes us to the end of chapter 5, which I think we can all breathe a sigh of relief because again, I think it's important to really become experts in our expensing tools in bonus. But again, I know it can get a little bit in the weeds and a little detailed as well. But now I'm going to change to page 127. And unfortunately, I believe that you all have had a lot of natural disasters. I'm guessing maybe not where you live, but close to it. I do understand a lot of farmers in your state suffered a lot from the hurricanes. You could probably tell me more about that, but the chapter in this book, we've just had natural disasters all over the country this year. And of course, some have been way worse than others. The hurricanes were just of unimaginable proportion. I can't imagine what these folks are dealing with. But we've had tornadoes in my state and terrible flooding where whole towns have been wiped out. So it's just been a crazy year. And so that's why we have this disaster issues chapter in the book this year, because I've had some practitioners, some professionals who told me early on that they were trying to find CPE courses that kind of walked through things like casualty losses, casualty gains, involuntary conversion, and there's just not much out there at all. And the software doesn't always do the best job. And so our goal here is just to kind of walk through the basics of ways we can help clients who have had a natural disaster and what the special rules are for farmers, because there are some, and those deal mostly with livestock. But that's our focus here in this chapter. We're going to start by just defining what a casualty is, because this can apply outside of weather. If you have a theft loss, that can be a casualty. So we have to think about that as well. These apply in lots of contexts. It was really, really dry in my part of the country this year. And so during harvest, there were a lot of combine fires. Those would be a casualty. But those types of things that are sudden, unexpected, unusual, anything that damages. So of course, all of our natural disasters count, but there's lots of other things that count as well. And so when we try to figure out what is the tax treatment when we have a casualty, it's going to depend on all kinds of factors. First of all, it matters whether the property was just damaged or whether it was actually destroyed. It depends on how much we had depreciated the property, how much insurance that we received or expected to receive, whether we actually restored the property, we have to pay attention to that, whether it's personal property, whether it is property used in a business, whether it's 212 property held for the production of income. All of that matters. And so there's a lot of things that can happen tax-wise, and there's different provisions of the tax code that, though they're related, they're not the same. And so you can have a casualty loss, you can have a casualty gain, you can have a tax deferral, or you can have a tax deferred involuntary conversion. There's all kinds of options. And so that's the point that I want to raise here. So I'm going to ask you another polling question, because I am very interested if you expect to have clients that suffered a natural disaster this year. And that's right here. Launch that poll. And I hear in the question box, it says we had a severe drought this year. Yes, we'll talk about drought too, because this all applies. So it's just been a bad weather year all the way around. So the majority of you, it looks like, did have a client who suffered a disaster. And if you're one of the 4 that did not, then I would just say, well, you know, these rules will be applicable to you if your client had a theft or a fire or anything else. Hopefully you'll get some value from this session.
Hey, Christine, just
Yes.
in West Virginia, I'd say over in the South Branch Valley and the Greenbrier Valley, you have large farms. And for when I say large, typically they're renting a lot of the bottom land. They'll buy the crop insurance. I don't know the nuances of that, to be truthful, because I'm in Morgantown. I'm not working with those farmers. But I think that's the prevalent question. They're just simply buying the crop insurance. You know, the calculations involved with that. Are there any losses, deductions? How do casualty loss rules apply against a drought like in West Virginia?
So you said they buy crop insurance. I'm not sure. I guess maybe I don't understand. Maybe they do things differently. Could you explain a little bit more what you mean by that?
My understanding is you could go out and buy crop insurance if the yield wasn't as, let's say you had a severe drought and you didn't have the corn yield, the insurance company would pay out.
Oh, sure. Yeah, we're going to talk about, I gotcha. We're going to talk about crop insurance in disasters and things and how that works. That is, yeah, that we're first of all going to cover destroyed property that's not property that we're raising. And then we will talk about, good question. I thought it was like an investment or something in crop insurance.
No,
So
no,
I was
no,
like, oh, you guys do things differently there.
because
These-
we don't have the derechos and the severe
Mhm.
hail like you would get out Midwest tornadoes. You know, for us, it's a gradual drought. I'm not sure that would qualify as a casualty, but it's just kind of an introduction as the distinctions in West Virginia versus, you know, down on the southern coast or out in the Midwest.
Now, do any of you have clients that were hit by the hurricanes? Because I'm on a board, the American Agricultural Law Association, and one of my colleagues on that board is from West Virginia, and she and her husband farm, and they were wiped out, and they're in West Virginia. So I don't know the contours of where everybody's at on this call, but I guess it must have caused some severe flooding or something from the hurricane in certain parts.
If you are in the southern portion of the state, depending on which hurricane is the reference, like Helene that came through really went through eastern Tennessee and western North Carolina, but it did also hit some of the southernmost portion of West Virginia. There were a couple other hurricanes that have come through during the year that have done flooding in different portions, but it hasn't been, I don't think it's been nearly as bad as when Helene came through. Now that being said, I'm curious to know what the disaster status is when it comes to droughts, because West Virginia has had D4 status on the drought monitor for months, depending on the portion of the state that you're in. And at one point in time, I think the entire state was under D2 or D3 status. So we didn't have quite the damage from like some of the tornado. Now, granted, we had a record year for tornadoes. I think we ended up having 20 tornadoes come through West Virginia this year, which is not our norm. Plus some of the hurricane damage, plus having drought issues, which funnily enough were not fixed by the hurricanes. So all of that.
That
And the crop insurance issue that we're seeing is crop insurance programs work really well for certain commodities, but I work with so many specialty crop folks that they end up with no coverage and none of there's not a lot of great programs for them, which has been an issue. And then but there has been some great payment options if you're in hay, cattle, some of the larger commodities. So, and mainly livestock. So it's been a
Yeah.
very interesting year here.
Yeah, that's horrible because the drought is like you said, it's not going to count as a casualty, but we do get to use some involuntary conversion rules. But that means just like I'm raising livestock or something, that's when those drought provisions come in handy. So we are going to talk about those. But unfortunately, if you're just growing crops and maybe you are able to get some crop insurance and you're going to get some income, there's options to defer the payment that you get. Sometimes we'll talk about the rules for that, but otherwise, casualty losses, casualty gains, we're not going to be able to do that sort of calculation for that type of property because that is property that we're raising for sale. It's inventory, and casualty losses and gains apply to our business assets that we hold. And then with respect to our livestock that are business assets, we do have some nice involuntary conversion rules that apply that in the drought situation. It's so ironic though, like you said, with the weather, because that's the way it was in Iowa. We have horrible drought in some parts and then horrible flooding, like whole towns wiped off the map in other parts. So it's just been crazy. So again, whatever you're dealing with, I hope that all of this will be just useful regardless at some point in your career. So the first part with any sort of casualty, and right now we're really talking about property that's damaged, like buildings and things like that, is where we're going to start. That's damaged by some kind of casualty event. So this would not be your drought because your building's not going to collapse because of your drought. But if you had a tornado go through one of your clients' farms, you would apply this. And so the first thing is whether or not you have a casualty loss. And in many cases in the farm, we're not going to have a casualty loss because the starting point is basis, and the basis of many, many farm assets is 0. So that's why in many cases we don't have a casualty loss, but we're going to look at what the rules are to calculate the casualty loss. And the rules are different depending on whether the property was totally destroyed or whether it was less than destroyed. If it was just damaged, it's going to be a different calculation than if it was destroyed. So if the property is damaged but not destroyed, then the casualty loss is going to be the lesser of the adjusted basis or its decrease in value. So we look at what was the fair market value before whatever event came through, and what was the fair market value after the disaster. And if that is less than the adjusted basis, that's what you use. And if it's more, then you use the adjusted basis. And then you subtract from that the expected insurance proceeds. So expected is an important key here because the rules require you to figure out how much insurance do you expect, even if you haven't received it, and that's what you need to include. So example 4.1, we have John, and he had a barn that was severely damaged by a windstorms, maybe one of those 4 tornadoes that went through. His adjusted basis in the building, and he had taken straight line for this, was $100,000. The value of the building before the storm was $200,000. The building after the storm was $150,000, and he received $40,000 in insurance proceeds. So how do we calculate the loss? It's pretty straightforward, but again, our insurance software isn't really, our tax software isn't really good at some of this. So we need to make sure that it's doing it correctly. Here, the lesser of the adjusted basis or the decline in value is going to be the $50,000, which is the decline in value. And we're expecting the $40,000 insurance payment. So he actually has a $10,000 casualty loss. And the casualty loss is going to be reported on Form 4797, just like you would report any other loss. And if we are not already required to file a Form 4797, then we can just put it on our Form 1040. That's another thing about this section. There's a lot of little rules that IRS has given us that a lot of folks aren't aware of. So hopefully we can point out some helpful things that if all you file is the 1040 and a Schedule F, then you can do us on the Schedule 1. You just put a little note that says 4684, and you do not have to file the 4787 just for that loss. Now, what happens after that? Well, the basis in the barn is going to be decreased by the insurance proceeds as well as the casualty loss that we recognize. And then if we restore the barn, then it's increased in terms of the amount of the restoration. So here, the new basis of his barn it is gonna be 100,000 minus 40 minus 10, it's gonna be 50. And if he uses the $40,000 of insurance proceeds to restore the roof, it increases back up to 90. Now, how do we determine the fair market value before the disaster and after the disaster and all that? We know we can always obtain an appraisal, but what's the difficulty of appraisals? They're expensive, they're time consuming, especially if you're in an area where there's been a lot of disaster, then you're going to have a long line. So the other method that's helpful in this situation is the cost of repairs method. So where you can use this is if you're actually going to repair the property, then the IRS lets you include the cost of cleaning up and repairing if you actually make the repairs, if the repairs are necessary to bring the property back to its value before the casualty, if you're not making it better, improving it, if it's not excessive, if it just fixes the damage. And if all that happens, then you can use the cost of repairs method to determine the fair market value. Now, if the property is totally destroyed, then the decrease in value isn't considered, and your casualty loss is just equal to the property's adjusted basis minus the salvage value. So if it's completely wiped off the map, then the only number that matters is what was your adjusted basis. Is there any money that you can get out of the scrap metal that's left over from whatever, got destroyed? That's the question. And if not, then the property's adjusted basis is where you start. So here we have a bin with a fair market value of $25,000, an adjusted basis of $15,000 when it was totally destroyed by a tornado. If she receives $10,000 in insurance proceeds, her casualty loss is $5,000, and the basis and all of that is reported on Form 4684. So what's the error on this page? The error is that no right farmer has a grain bin with any basis. I haven't yet to come across a grain bin on a farm that has basis, or whatever storage facilities you might have for your produce in your area as well. Now, one of the rules that makes people mad, and I get it, but it's kind of like getting kicked in the teeth when you're down. I get questions about this all the time, and it's section 280B about demolition costs. So under the code 280B, demolition costs and the basis of any destroyed structures are generally capitalized and added to the basis of the land. That's hard, right? So here you had this disaster. Your property was wiped out. It's going to cost you money. You have to take the money, you have to demo, you have to get the land prepared for something else. And what do you get to do with those demo costs? Do you get to deduct them? No, you have to add those to the basis of the land. So that is very difficult. If the casualty damages or destroys the structure, and then the structure is demolished, what you do is the basis of the structure is reduced by the casualty loss allowable, and then the loss sustained because of the demolition is determined, and then that amount is what's added to the basis of the land. So here's the example from the grain bin. So after you subtract the insurance proceeds and the casualty loss, there's zero basis left in the destroyed grain bin. And so any demolition, removal cost has to be added to the basis of Helena's land. So her grain bin was located on a 10-acre parcel of land. She purchased it in 2010 for $50,000. If she paid $3,000 to have the destroyed grain bin demolished, the building site restored, the basis of the land is now $53,000, which helps her none because she doesn't want to sell the land. If she spends $30,000 to rebuild the grain bin, the basis of that grain bin is $30,000. So that, again, like I said, is a difficult thing. All right, I have another polling question for you, trying to keep you awake as we get close. We're actually crawling close to our afternoon break, which also means that we are really close to the end. We're on the home stretch. So let me open this polling question up. Sorry about that. My little mouse isn't working the best. Okay, there we go. So this question says, can you aggregate casualty losses across different properties? What do you think? So let's say that I have a tornado that went through my client's farm, and so it destroyed multiple properties. Are we able to aggregate those casualty losses across properties? So give you just a few seconds to weigh in on that.
Christine, I'm going to ask a practical question because, textbook sometimes doesn't serve us. I've had instances with partial casualty losses and trying to determine the damage. And, the question is, can you use the adjuster's determination of loss? Because typically they pay out on the percentage that they've calculated as a loss. Now you go to a qualified appraiser. I mean, it's a very subjective element when it comes to, how much of a barn was damaged, and they're always going to default to the cost to improve or to restore. And if I only have, 40,000 out of what the adjuster said was a $50,000 damage, I'm only going to put 40,000 back into it, more than likely. I mean, farmers typically don't have a whole lot of money sitting around, so they'll
Right.
get the insurance proceeds. It feels like a conundrum. So the question is, could we just go with the adjuster's um, damage assessment and run with it, or we
Yeah,
stop?
I mean, I think that's a judgment call. I mean, I showed you what the regulations say. Um, it's what IRS has published, that it's appraisers or it is the cost of repairs. But in your case, I think an adjuster is pretty much like an appraiser. And I think as long as it gives all of the indicia of being something that's reliable, and I mean, the insurance company has no reason to overpay. So I think it should be a pretty good indication. And so I would feel comfortable in most cases to use that value. That's a good question. And the answer on the aggregated casualty losses is no. And so this page right here on page 132, we kind of walk through this a little bit, but it's all the kind of general rules that apply when we're calculating casualty losses. So business casualty losses, we have to determine them on a property by property basis. We can't aggregate. We have to elect to take into account any loss occurring in a disaster area and attributable. We can elect. This is actually something that's helpful. It's a special election that you might not know about. So you have a disaster, client has a bad year. So as you said, a lot of farmers, struggle with cash flow and everything anyway. And so they have all this, their income might be down. If they had income the year before, there is a special election if you're in a federally declared disaster that says you can elect to take that casualty loss in the year before the taxable year in which the disaster occurred. And I'm going to pause there to say, I want to show you something else in the workbook. Because again, I'm all about trying to have things in this workbook be resources to you long term. And so this might be another place where you might want to mark a very helpful tool in this workbook. And that is, if you have your workbook, you could turn to page 19. And what this is it's a very thorough table. I did not write this. One of my colleagues put this together and it's been updated over the years. And I think it's really great. It is a farm and ranch elections table, and it is all of the tax elections that might apply to a farmer. So it's not just farming only. It's ones that might apply to people who are non-farmers too, but it's all the ones that farmers typically use. So I like it because it gives us not just the election, it also points you to the regulations that you might need to read sometimes. How do you make the election? What happens if you want to revoke it? And is there, the last column there is there any books that have come out from the Land Grant University Tax Education Foundation that have given more information on this? And it's not the ag tax issues book, it's the, if any of you have participated in the national income tax seminars, it would be those seminars. But that's a really nice table. Again, just a little bit of a side note, but I thought it might be helpful to you. If you want to make that election, you would make it on an amended return for the prior year. Another thing about casualty losses, if you deduct a casualty loss, but then unexpectedly insurance pays more than you thought, there's a good rule here where IRS says you do not have to amend your old return. Instead, you get to include that reimbursement in income for the year in which you receive it. So again, that is a helpful rule because a lot of other things IRS is really harsh about. They're like, nope, you have to amend the return. And then the other thing I'll say is that passive loss rules do not apply to business casualty losses. Okay, with that said, I'm going to say, I think, crazy, we're up to our first break. Is that correct, Elisa? I think 2:15 your time. So we're going to break until 2:30 and then we'll come back for the home stretch. So you're all hanging in there. You're doing a good job. I'll see you soon.
Okay, thank you.
We are almost at 2:30, so we have just a couple of seconds left to get your coffee back or whatever. So give you a few seconds and then we're on the home stretch, folks. We only have 2 hours to go. You've done a really good job hanging in here with me. So we still have quite a bit we're going to try to get through and cover. But I do want to also say I appreciate the interaction. So if you have specific things you want to talk about before we end, make sure you raise them because I'm happy to talk about anything agricultural tax that you're wrestling with. So we'll have a chance to do that. If you have anything you want to bring up, make sure to do that. Okay, it's 2:30, so let's get back into the material. So we are at page 131 of the workbook if you're following along, and we're talking right now about casualty losses, and we're talking about the detail about insurance proceeds. And when we're calculating this, when we're trying to gather information from clients, we do have to ask the client how much insurance they received and also how much they expect. So do we expect to receive more than what we've actually received so far, because the rules say that we're supposed to include expected insurance proceeds. And so we have to reduce any casualty loss that we want to take this year by any expected insurance proceeds, even if we know we won't get those until next year. And then in the year we actually get them next year, if we did not receive as much as we thought, then we can go ahead and include the reimbursement in income if we got too much. But if the reimbursement is less, then we realize our loss in the year of reimbursement. So the goal there, I think, is to have the least amount of change in forms possible. So if you expect you're going to receive insurance, let's go ahead and figure it out right now. Now, what we more likely have, I think, in the agricultural world, instead of having casualty losses, most of the time, what we're actually dealing with is casualty gain. And that's, as we said, I think because all of our basis of our assets are usually really low because we've taken that lovely section 179 that we talked about, or bonus depreciation. And so this is something that we have to figure out. All right, is it a good year where we actually want to recognize the casualty gain? Or in many cases, we may be able to do an involuntary conversion, but we have to understand that we're flipping over into a different part of the tax code at that point. So we need to make sure that we're following all of the rules. And so the formula for gain is pretty straightforward. We take the amount that we receive as insurance proceeds or any other compensation, and then we subtract the basis in the property at the time of the casualty or the theft. So that's going to be considered to be gain. And even if the decrease in fair market value is more, when we're talking about this formula, we always use the adjusted basis. So let's go back to looking at that grain bin just because it was a random generic asset. And let's suppose that she had taken, as most farmers would have, a section 179 deduction when she built that. So any sort of storage facility, anything you might have, you took section 179, the basis is 0. If she just received $10,000 of proceeds, even though the grain bin was worth $40,000 or whatever, she still has a casualty gain of $10,000. So if she does nothing, if she just pockets that money, that has to be reported. So gain on the grain bin reported on form 4684. It's 1245 property. It's recapturing that section 179. It is just like she sold the darn grain bin. So you report that on part 3 of form 4797. It's ordinary income, not subject to self-employment tax. And then we have to figure out, do we want to actually recognize the gain, or do we want to tap into section 1033's amazing ability to defer gain, right? So we can defer gain by electing to reinvest the proceeds. And so that is 1033A2A. Now, this section that we're looking at here is for the tangible sort of property that is damaged or destroyed in a casualty. This is not our livestock. So we're going to talk about the special provisions that apply to livestock shortly. But right now we're talking about a storage facility, a horticultural building, anything like that. The rule for this is 2 years. Okay, so we have 2 years to reinvest the proceeds in similar or related in-service property. So one thing I want to remind us of here when we're looking at 1033 is the rule is not nearly as broad for involuntary conversion as it is for 1031. With 1031, I could trade my grain bin for a piece of for a hog barn. I could do that, and that would be fine. Those would be like kind under the 1031 rules. But here it actually has the requirement that it's similar or related in service or use. So in my example of the grain bin, I would think you have to build another grain bin or something that is a storage facility. It's not going to be enough to invest that in a multi-purpose farm building. And also remember that the involuntary conversion rule applies to personal residences as well. If you're in a federally declared disaster with a personal residence, you get a 4-year replacement period for your house. So that's kind of helpful as well. And so you have to, this is something I'm not sure that a lot of folks do, but this is what the regulations require, to report the details of any involuntary conversion for each tax year in which the gain is realized. So in the year of the disaster, you would actually report the casualty gain, but you wouldn't report it as a gain. You wouldn't report it on 4797 and pay tax. You would just report it and put a statement that says that on your casualty form, and then you would attach a statement that says you're choosing not to report it because you're using the involuntary conversion rules. And then in the year in which you acquire the replacement property, you attach a statement that gives enough information for IRS to realize that you did not have to pay any tax because you reinvested all of the proceeds in property that was similar or related in use. So Helena, from our prior examples, she can elect to defer recognition of $10,000 of the gain if she spends at least $10,000 to construct another grain bin within 2 years. That's allowed. If she chooses deferral, then of course the new grain bin is going to be reduced in the amount of the $10,000 to account for the casualty gain. And so it's got a little bit of that carryover basis. This slide here and the example on page 135 gives you an example of what that election looks like. So this is what you would attach to the return in the year of the conversion if you did not if you're not reinvesting in the same year. If you reinvest in the same year, you're good to go. If you are electing to defer into another year, then you have to attach this statement. Now, there is a special rule. If your client is in a federally declared disaster, then that narrow definition of similar and related in service, that goes out the window. So that's actually really helpful. So if you have a casualty gain that arises in a federally declared disaster area, then what do you get to do? Well, you can defer for the 2 years. And when you replace, you can replace that property with any tangible replacement property that's held for use in a trade or business. So that is really broad and really helpful. And so let's look at an example. Helena, let's say that she was in a federally declared disaster area. She doesn't want to rebuild her darn grain bin. But what she can do is actually buy a new tractor. Notice it doesn't even have to be real property. It's just any tangible property used in a trade or business. And then the basis of that new tractor is reduced in the amount of the casualty gain that she does not have to recognize. So the casualty gain was realized, but it doesn't have to be recognized because she's going to lower the basis of the new tractor accordingly. And that brings us up to a polling question. So I'm going to ask you, is it always best to defer? This kind of goes back to what we talked about before with our clients. They're always probably going to want us to defer, but is it always best? So I'm going to take a pause so you know I'm asking a polling question. What do you think? It's probably a question that is self-apparent in the answer. Nothing's ever always best, right? There, somebody gave us a yes just to say, I can give a yes. That's good. That's good. All right, I'm going to close the poll. So if you want credit, you need to vote in this poll, folks. I think you could probably tell by the way I asked the question that it's probably not always best to defer, right? Obviously, we need to figure out if we're having a low income year, then why not go ahead and recognize the casualty gain this year? And then when we do replace the property, it doesn't mean that we're not replacing the property. We just might not want to roll the basis into the new property because maybe we're not going to have to pay really any income on that gain this year because of the rest of our tax situation. And when we replace the property, we'll have the ability to have a new basis if we do not defer, and we won't have to lower it according to the gain that we did not recognize. And that might give us more cash flow at that time. So these are just questions that we need to ask and consider anytime that we have a situation like this arise with a client. So let's look at the rules that apply when it comes to repairing casualty damaged properties. So what are we required to capitalize? What can we deduct? Can we use the tangible property regulations? And the answer to that is yes, but only to the extent that our repairs exceed the cost of the property that was the basis prior to the loss. So let's walk through this. Here's what the rule says. If the reduction in basis is less than or equal to the taxpayer's adjusted basis, amounts paid to restore a building have to be capitalized as an improvement. But if the amounts paid to restore the property exceed the adjusted basis of that property before you had the loss, then the amount required to be capitalized is limited. Here, costs required to be capitalized are just the excess of the taxpayer's basis resulting from the casualty minus the amount paid to restore that constitutes a restoration under the tangible property regs. So that's a lot of words, which I like to give examples. So let's look at this example, which this one does include a derecho, which you all don't have. But if you're wondering what the heck is a derecho, we've had a couple of those now in the Midwest in the last couple of years. And it's a really, really strong wind that just levels everything. So it's a straight line wind. It's different than a tornado, which is spinning and moving. The derecho is just like whoosh, but the damage done is just as bad as a tornado. So it's kind of crazy, and I hope you never have to learn what a derecho is. But a derecho damaged Jerry's farm building, and the farm building had a $75,000 adjusted basis. And he got $75,000 in insurance proceeds. I guess it's a she here. She then paid $90,000 to repair the damage and to restore the building to its prior condition. So the question is, what of that must she capitalize, and what of that can she actually take a present deduction for? Can she? And so here the insurance payment lowers the basis of the building to zero. But when she repairs the building, the $75,000 of repairs in the amount of the insurance payment have to be capitalized. But the excess, the amount that exceeds what the adjusted basis was before, that doesn't have to be capitalized. She can actually deduct those under the tangible property regs if they were expended to repair or restore the building. And so $15,000 there, she can deduct. So just something to remember how we can use those tangible property regs to our benefit sometimes if we're looking for a deduction. Now with personal use property, we have rules that are very strict right now. Of course, thanks to the Tax Cuts and Jobs Act, we have been restricted in our personal casualty losses to only be deductible if they're attributed to a federally declared disaster. Now, outside of that, we can still take involuntary conversions. So if you have a client who's got a strong wind and their roof is damaged and the insurance replaces the roof, you still apply all of the involuntary conversion rules, but you're not going to be eligible for any sort of personal casualty if the amount of the compensation does not equal the damage that was caused in relation to the basis and everything else. If you do have a client that suffered damage or destruction to personal property that was in a federally declared disaster area, remember what the limits are. You can take a casualty loss, but the loss has to exceed $100, and the aggregate losses can be deducted only if they exceed 10% of AGI. So one of those AGI limits, this one is 10%, which is what the medical expense deduction used to be, but now it is 7.5%. So kind of similar and kind of harsh. Taxpayers with property use partly for personal use and partly for business use, they have to allocate. And the good news is the involuntary conversion rules do apply. Now, I do want to turn to those crop insurance and disaster rules. We talked a little bit about those before, but let's really highlight those. We start on page 137. And so what we say at the onset is, of course, insurance proceeds that we get for any sort of disaster-related damage are included in gross income. So if we do get, now understandably, some of your farmers are not able, it sounds like, to get crop insurance because of the specialty crops that they have. But some of those farmers might be eligible for some of the disaster payments that the government has paid out over the various years. And so let's just look a little bit about thinking about disaster payments and crop insurance and the difference and the similarities. So bottom line is, any disaster payment that we receive from the federal government is considered income, farm income, goes on the Schedule F, okay? Any insurance payment that we receive from our crop insurance company for any sort of disaster-related damage is income. It goes on the Schedule F. The question for you will be whether or not the client meets the criteria and wants to or is benefited by deferring that income for 1 year. It is not always an option. In fact, it is a narrow option, particularly if a lot of your clients, which it sounds like might fall into the category where they're not actually receiving crop insurance payments, they're just receiving disaster payments. Well, does the federal government ever do anything quickly? And the answer is no. So the federal government issues disaster payments generally 2 years after the disaster, if we're lucky. And so there is going to be no deferral available because the rule for 451F, which is the deferral rule, says that cash basis farmers can elect to include crop insurance proceeds, and we'll talk about this, but crop insurance proceeds also includes any disaster related payments as well. It's covered by the same statute. It's just they had to do that by regulation. That's why it's not in the language of the statute. They can elect to include those proceeds in gross income for the tax year following the year of destruction or damage. So if I receive my crop insurance proceeds this year for a drought that made my crop not produce, I may be able to defer until next year. But if I receive a payment from the USDA next year because my fruit crops were damaged because of the drought and I did not produce, and I get a disaster payment under some program like ERP or something like that, maybe ERP number 5, I will not be able to defer because I did not receive the money in the year of damage. I can only defer if I receive the compensation in the year of damage. And the way that you can remember and the way it makes sense is to realize the purpose of 451F is just to prevent income bunching for farmers. So this rule is intended to only apply really if I'm in a habit of producing a crop and then selling it in the next year. So let's say that's my habit. I raise my crop and then I sell it the next calendar year, and it is income in the next year. And then, darn it, this disaster happens. I do not get any income for my crop this year because of the disaster. But then I get a payment from crop insurance or a payment from the government in that year that's meant to replace the income that I got from my crop insurance. And so this law says, well, if it had been just the crop that you grew and you didn't choose to sell it till next year, you wouldn't have recognized that income till next year. So 451F is Congress's attempt to say you can defer to next year what you would have otherwise deferred if it were just the regular crop. So it prevents that idea of having to have two sources of income next year and income bunching, and you have a spike in your marginal tax rate because of that income. So because of that purpose, it is fairly limited in scope. Now, here's where we see the regulation that
question.
applies.
I have a
Oh,
question.
yeah, sure.
Back a couple of slides, why would the proceeds on a disaster to pay for repairs be included in gross income?
Oh, proceeds for disaster-related damage. Here on this slide, I'm talking about disaster payments from the federal government to crops is what I'm talking about. That's why it's included in income. So if I have a grove of apple trees and it's wiped out because of the drought, it doesn't produce anything, then 2 years from now, maybe the federal government would say, I'm going to give you an ERP payment, a disaster payment to compensate you for that loss. It's just part of tax law that they've always said that that payment that's made for
So
disaster
you're just talking about the on crop insurance.
only it's not crop insurance only, it is it's crop insurance, but also crop damage. So here I'm not talking about a payment made for damage to a building.
It's the same as if you sold the materials.
Yes, that's exactly right. It's treated just like that, except where you report it is in your government payment line on your Schedule F instead of on, lines 1 and 2 where you would normally report the sale of that. Does that answer your question? What this was meant to? Okay. Yeah, thanks for the question. Thanks for chiming in. And anything else that's not clear, just chime in so I can clarify what's intended here. So here's the regulation that says you can use this election to all federal payments that you receive as a result of destruction or damage to crops caused by natural disasters or the inability to plant because of a natural disaster. So this is a place to prevent plant too. So if somehow the federal government got its act together in a drought year and actually gave you the payment in the year that you were not able to plant, maybe because of a severe drought, maybe that is sometimes happening. Most of the time you probably plant, nothing grows, but if you got it in the year of the disaster, you would have the ability to make an election under 451F to say, okay, I'm going to report it in income, but it's not going to be taxable. It's going to be deferred until next year. But as I said, most of the time, those payments do not come in the year of disaster. And so you're not allowed to use the deferral because this only works for a 1-year deferral. So the way that this works is you have to use cash method of accounting. You have to establish that under normal business practices, any income from that sale would have been included in your gross income in the year following the destruction. So normally I grow my crop, I don't sell it till the next year, so it would have been included in next year's income. I have to show that. I have to make a statement that shows that. And then the election has to be made for my entire trade or business. So if I'm just a farmer that raises lots of different types of crops, I don't get to pick and choose between my specialty crops and my wheat or whatever else I have. It's a deferral for all or none. So again, this is not the most flexible provision that we have in the tax code. Now, when we're talking about normal practice, we have to establish that normally under the way I've done my business in the past, I wouldn't have sold this until next year. I wouldn't have recognized my income until next year. And so what's enough to do that? And case law really says, okay, probably if you sold more than 50% of each crop that you have, then you can probably defer. It's probably justifiable. It has to be a substantial portion. So, you know, use your own judgment, but I kind of like to narrow in on a number. I think you're pretty safe if it's more than 50%. So let's say Royal received $12,000 in 2024 for prevented planting crop insurance coverage. He also received $8,000 in disaster assistance payments for damage to his corn crop in the same year. He operates his farm as a single trader business. He normally sells both crops next year. What are his options? Can he elect to report the $8,000 in disaster payments in 25, but report the $12,000 in crop insurance in 24? Do we have that sort of flexibility? This is a polling question just to see if you're following along. We're going to ask this question here. And do we have the ability to treat them differently? Disaster payments and crop insurance payments. So here we go. And I'm going to launch that poll and see what you think. It looks like we might have something in the chat box. Let's see. Oh, maybe somebody can't answer. Oh, here's the maybe. I like that answer. That's probably more accurate. I just give you a yes or no. But here, we're gonna just see what you think about this. A couple more of you can weigh in. All right, good job. I'm gonna end it. And guess what? This is the first time all day you guys are exactly split, 50-50. Why? Because one of you went off and answered in the chat. So that allowed sort of for the tiebreaker. So here's what the law actually says. Unfortunately, it says no. Because he has a single trader business, he has to elect deferral for both crops or neither crop. It doesn't matter that some of it was disaster payments and some was for crop insurance. They're treated the same. So I'm just saying 451H is not a very flexible provision. It's important for us to know it's there, but it really might not come in that handy. Now, assume that Royal has historically received substantially similar income from his crops. He generally sold 60% of corn in the year of harvest, 65% of soybean in the year after harvest. Would he be eligible to defer crop insurance and proceeds to 25? Because you're like, well, he deferred most of his corn. He just didn't defer he usually deferred most of his soybeans, but he didn't defer most of his corn. Do you have to treat them the same? Well, we've really only had one big court that looked at this and they said, no, you can't. So in the 8th Circuit, which you all are not in the 8th Circuit, so you're not bound to follow this. Outside of that circuit, the answer's maybe you could make the argument that this is substantial because maybe you had more soybeans and together you're more than 50%. So just some things to consider if you get into that. But here's how you make the election. On page 139, you do attach a separate signed statement to the return, or you can do this on an amended return. And the statement is for the year of damage or destruction, because remember, that is the narrow window in which we have to make this election. If we get the payments after the year of destruction, there's no deferral available. And then the statement items are included on 139. Basically, you do have to tell IRS that you normally would have sold the following year, etc. And once we make that election, we cannot revoke it. And requests are made through a letter to the director. Now, I'm telling you what the regulations say, but we don't have a director office anymore. So we just sort of do the best we can figuring out where we would make a request if indeed we have a situation where we want to try to revoke. Notice it's not telling us we have to have a private letter ruling, so we might have a little bit more option there. But on your Schedule F there, you see that crop insurance proceeds, federal crop disaster payments, they're treated exactly the same. This is from 2019. That's why that year is on there, but the form hasn't changed. you always report all the proceeds you receive on 6A, and then 6B is the amount that you want to recognize with tax. And then if you're deferring, you have to attach the election. And then the next year, when you report the deferred amount from the prior year, you put that on 6D. So that's how that all works. Now, we do have a new statement in Pub 225 as of last year that says, if you receive proceeds from an insurance policy that is based on revenue, then you do have to allocate, because you can only defer payments that are not based on revenue. You can only defer payments that are made because of damage, so loss or damage. So you do have to allocate. So that's something that we have to keep in mind. PUP 225 used to be very confusing because it said that you could only defer if you did not have a revenue insurance policy. Well, those of our clients that have crop insurance, 99% of them have some revenue component in there. It doesn't mean that if they get a payment, it's to pay for lost revenue. It just means that in some cases, they will get lost revenue. So what happens is you get this statement that shows what the payment is for, and then if it's for revenue, you do not get to defer that. If it's for damage, you get to defer that portion, and then you allocate if it's for both. So that's just how that works. Now we're going to move on to page 141, and we're going to talk about two separate tax provisions that deal with livestock. And so these provisions both deal with drought, but they also deal with other weather-related conditions. So this is going to deal with 1 year deferral is the 451G provision, and the involuntary conversion rules, they can go on forever if you look at your county and you remain in the drought area. So we'll talk about how that works as well. But here's where we're talking about any sort of livestock that your client might have. If you had to sell that livestock because of a drought, a flood, or another weather-related condition, 451G, which is sort of the sister provision to 451F, which is the crop insurance deferral, says, oh, you can defer that income to the following year. Again, this one is not that helpful because it's just a 1 year deferral, but it might come in handy for the right client. So it's good to know it's out here. So here, the principal trader business has to be farming. They have to use the cash method. They have to establish that under normal business practices, they would not have sold that livestock if it hadn't been for the drought. And then the conditions cause the area to be eligible for federal assistance. So it doesn't have to be the county where the livestock is eligible for federally declared disaster. It just has to be because of a federally declared disaster in the region. Maybe you weren't able to get the feed. Maybe you weren't able to do what you needed. If you can prove that the area's designation as being eligible for federal assistance caused you to have to sell the livestock, then you can take that deferral. Now, what do we defer? We defer the difference between the amount of livestock that we sold and the quantity we would have sold if we'd have followed our usual business practices. And just like everything, IRS is going to look at it in the light of all the facts and circumstances, and probably if we get audited, our past history, just to show that we didn't make anything up. Now, this is the provision that applies to all kinds of livestock, okay? The 451G provision applies to all kinds of livestock, any livestock, and that's what it means. So it's not just your business asset livestock. It's not just your draft, breeding, and dairy. It is also your market livestock. If you have market lambs, market hogs, market cattle, anything like that, that you sell because of a drought that is receiving federal assistance, then you're eligible to defer the income from selling that extra livestock to the next year. But again, narrow, that's all you get to defer is to the next year. If they're held for the sale in the ordinary course of business, the election has to be made by the due date of the return for the tax year in which the drought sale occurred, right? So that's what we have. If, however, the livestock are held for draft, breeding, or dairy, then the election can be made anytime in the 4-year replacement period for the postponement of gain under the 1033E2 provision. So in that case, you'd go back and amend to decide if the 1-year deferral would have been better than deferring it for the whole period that you have under the regular involuntary conversion rules. So we'll talk about that in a minute, but just know that that little thing, that little rule might come in handy, and it's kind of a little known rule that, oh, you can change your mind and you can go back. So if you want to make this election, you do have to attach a statement to the return or to the amended return. And the statement just has to include your name and your address and all those items that are listed on 142 for each class of livestock. Because what's different here is you can make a different choice depending on the class of livestock that you're deferring the gain from. So here's an example that shows market livestock that was sold and deferred. So in 2024, we have actual here, a flood, could be a drought, could be anything during a severe rain event. His flood was located in a federally declared disaster area. Because of the flood, he sold 150 market cattle, including 100 that he would not have sold until 2025 if it had not been for the flood. Trey received $270,000 for the cattle he sold. Because he's a cash basis farmer, he's allowed to defer for 1 year the income he received from the 100 head that he sold because of the flood. And so that's how you do it. It's reported exactly like you would report the crop insurance deferral. It's very much similar to that. Here is a statement example on page 142 about what that statement looks like. And then livestock outside of the disaster area, like I said, they might qualify. What it says is you just have to show in your statement that the sale or exchange occurred solely on account of the weather-related conditions that were subject to the federally declared disaster, and that might have impacted water, it might have impacted grazing, it might have impacted other requirements, cost of feed. So if you can show that it flowed down to where your client is, they may be eligible for that deferral. So that's 451G. And again, this time of day, we're going to roll into another polling question to keep you alive and awake. And what we're going to ask you here is, in addition to 451G, is there another deferral option? So I'm going to launch this poll now. Again, we've got to have credit for being in this webinar, because that's important. So we don't want to miss out on that. So if we could answer the question. This is a little bit of a trick question, and I'll explain why. So really, if you say yes or no, I'm going to say you were right. You were probably just thinking about this differently. So give you a few more seconds. Good job, everybody. You're doing quick on the polls, so that's very impressive. All right. So there is another deferral option, but not for market livestock. Okay, so that's why that was a trick question. So the tax code does provide us with 1033E, but it doesn't apply to the example with Trey, because Trey had market cattle, and this only applies to draft, breeding, or dairy. So 1033, any sort of involuntary conversion is only going to apply to an asset, a business asset. And just remember, like our breeding cattle, our breeding livestock, our breeding sows, whatever we have, those are just treated like a tractor in many cases under the tax code. They're just business assets. So if we have any of those dairy, breeding, or draft livestock that we have to sell because the severe drought or other weather-related conditions Here, we have a little more flexibility. And the first one is you do not have to be in a federally declared disaster area. That's awesome, okay? Because a lot of drought areas, you're not actually having a federally declared disaster. So this one applies in your drought area. If you've got clients that do any sort of breeding or dairy, and they had to sell things because the drought was just making it very difficult, they can defer generally under 1033E. We do still have to prove that they would not have sold under the normal business practices. So, you know, these animals are often culled, but you only cull a few of them. And if you're in the middle of a drought and it's just becoming too stressful for, you know, having your breeding livestock being able to sustain themselves on whatever pasture you have, then you might just sell them and say, I can't do this. This would be a situation where you can postpone the recognition of that income for up to 2 years, typically. But if it's eligible for federal assistance, the replacement period is extended for 4 years. And then in your case, IRS can also extend the replacement period just for drought beyond the 4 years. And so here, the last notice that we got was actually in 24. I didn't update this slide, I apologize, because in our book was written before the notice came out, but our September 2024 notice, which we do include on our CULT website. If you ever go out there and you want to find the notice, you can find that in our tax resources section. But there's a whole list of all of the counties in the US that are under drought conditions, and that's been extended. So if you're out there, then you will be able to keep deferring gain from the sale of draft breeding dairy livestock. Now, under 1033, just like when we talked about the other disasters, the replacement livestock generally has to be the same kind as the original livestock. So if I have to sell some extra breeding heifers, then I would have to replace them with breeding heifers when I finally, after a couple of years, decide to reinvest. But if the disaster makes it not feasible to reinvest the proceeds in similar property, maybe the drought's just going on too long, I'm just going to hang it up, I can't do this anymore, then I can actually reinvest it in other property as long as it's used for farming purposes. Okay, so here's helpful tip on this. So example 411 on page 144, it's Tia's usual business practice to sell 5 raised breeding heifers during the year. In 24, she sold 20 because her pasture was flooded. It could just be drought or whatever else, right? Her basis in the animals was 0. Because of the weather-related event, she can postpone all the gain on the 15 excess animals by treating their sale as an involuntary conversion. And the book there on page 144 gives you a sample statement of what that looks like. Now, when she actually purchases those replacement heifers in 2026, her basis is going to be 0, plus any price she has to pay for the animals in excess of $21,000, which is her deferred gain. And so when she replaces them, she does have to attach to her 2026 return the statement that says the date the replacement heifers were bought, the cost, the number, the kind, and a copy of the information that was attached to the 24 return. Now, if it turns out that she pays less than the amount of gain, which is almost unheard of, then she would have to amend her 24 return and pay tax on the difference. But otherwise, she is good to go. Unfortunately, if she dies before the replacement heifers are purchased, the executor has to amend her return to declare gain for all of it, which I think is kind of unfair, but that's the way it goes. Now, on page 145, we kind of walk through those considerations we might want to think about tax planning wise before we just automatically say defer. Nothing earth shattering there, just basic tax planning things. So just might want to look at that. Now, the next topic I wanted to bring up to you is a topic that is not in the workbook, but this has been probably the most widely questioned topic of the year for me. I get emails from all over the country on this every week. And so all of my ag tax seminars, I've sort of added this little topic in here because I think it is really important to kind of talk through. And so my polling question, and this is helpful for me to gauge where you all are at with this, have you had any clients ask you about the residual fertilizer deduction? And if all of you say no, it's okay. We're going to talk about it because I'm going to give you the ability to make sure that you know you're on the lookout for it when and if it happens to you. So let me open the poll. We're coming along. You guys are doing well on these. All right, so have you had clients ask you about the residual fertility deduction? And give you a few seconds to answer. Oh, and a few of you have. And so most of you have not, which is actually good because it gives me a chance to kind of tell you what this is and what to be on the lookout for. And again, like I said, some of you have, but the majority of you have not. So let me tell you about this. Because again, it's really become a hot topic, and the promoters just may not have wound up in the eastern part of the US yet, but they are in the western half of the US. When I go to Idaho, my folks have been hit with this. When I'm in the Midwest, they've been hit by it. So I'm sure they're coming to you in West Virginia as well. And so what this is something that's actually been around a long time. It's not something that is all bad. It's not something that you're necessarily not allowed to do. It's just something that promoters have gotten involved with. And so I liken it to promoters that got involved with the ERC. The Employee Retention Credit was a valid credit that was passed by Congress during a very difficult time in our country's history. And so it was intended for a good purpose to compensate employers that kept employees on the payroll, and it had valid provisions. It was probably a little too generous, which meant that fraudsters came in. It meant that third-party companies realized, wow, we can make a ton of money on this by charging a fee for our services and helping clients claim the credits. And that's exactly what I've seen happen here with the what's called sometimes residual fertilizer deduction. Sometimes it's called excess fertilizer deduction. Lots and lots of activity, but little guidance. And so what happens, for those of you who aren't familiar, is your client will get approached by someone. Maybe they're going to be purchasing land. So your farm client is going to purchase some land. And there are methods that these companies have to realize that they're going to purchase land, or they're sending out glossy brochures. And what the brochures and the context that they have when they just call people up say is, well, you're going to be buying land, but don't you realize we know that you cannot depreciate land. So there's no value that you can assign to the land that will be depreciable down the road. But that land has been fertilized, it has nutrients in it, and those nutrients are they're valuable, they're worth something. And so if you assign a portion of the cost of the purchase of the land to the value of those nutrients, then you can deduct the cost of that. And because it's fertilizer, you can deduct it under Section 180, which is the provision under the tax code that says if I'm a farmer, if I apply fertilizer, if I take hog manure and apply it to a field, I can deduct the cost of that in the year I do it under Section 180, or if I choose not to elect to deduct it in the cost of my purchase, I can spread out the deduction through an amortization deduction, maybe over 3 or 4 years, whatever the life of that fertilizer is. So they take that provision of the tax code that says, yeah, if I'm a farmer and I fertilize my land, I can take a deduction for that. And they say, you're buying a farm and there's fertilizer on that farm, and you should be able to allocate a portion of the purchase price to the value of that fertilizer, and then that will give you a deduction. And all of that, there's some truth to it, and it all kind of goes back. We don't have very much guidance from IRS on this at all, but what we have is a taxpayer advice memo from 1991. It actually has the year 92 on it, but it was issued in 91, and it's TAM 92-11007. And in this TAM, the advice that was asked for IRS is, can we take an amortized deduction for residual fertilizer that is in the land that we're purchasing? And in this case, the IRS denied the deduction, but they denied it because they said that the taxpayer corporation that was trying to do the deduction, were not the beneficial owners of the fertilizer because they did not own the land. So they said it's the owner of the land. So that was sort of a side issue. But in determining this case, IRS did go on to say, hey, in order to amortize the cost of fertilizer that you acquire with land, you have to prove these things. So there's authority, I think, even though this isn't strong authority, but we've long said, okay, if you purchase a farm that was fertilized, maybe that there was manure spread on there, and they put on enough that it's going to fertilize your productivity for the next couple of years, you can assign some value to that, and you can take a deduction for that because that is a valuable asset that you purchased along with the farmland. But IRS says in order to do that, you have to establish the presence and the extent of the fertilizer. So what does that mean? Well, it means you have to get some sort of agronomist or expert in soil to go on to that field and say, yeah, I'm doing my soil tests and I see that, yes, there's P and K here, and there's these things that, yes, it's here. You have to show the level of the soil fertility that was attributable to fertilizer that was actually applied by the prior owner. Why is that? Well, because the tax deduction isn't available for soil. So if you just have soil that has a lot of fertility in it, that's not what a deduction is for. You only get to take a deduction if it's something that was put on the land as part of the business. So if the prior owner had fertilized, so the agronomist also can go and see, hey, is there excess? Was this something that looks like it was applied? Now, ideally, you would have an agreement between the seller and the buyer, but notice they're going to be at odds. And because you're not selling a business, you're not required to file the form where you actually have to put the actual assets and match them up. So because of that, it leaves some room for disagreement. But you have to provide a basis upon which to measure the increase in fertility to the land. Like, you have to have some ability by this specialist to say what the baseline level of fertility would be if nobody ever fertilized the soil, because there's still going to be nutrients in the soil, right? And then you have to provide evidence to say, over what period will that residual fertilizer be exhausted? So if you go through those 4 things, you might be like, well, okay, I could see somebody could prove that, but in the end, maybe the most that you would have to be able to deduct would be the cost.
Excuse me, I have another question. Another
Oh,
question.
sure. Yeah.
Are we assuming that when we purchase this property, then we allocate a part of the purchase price to the fertilizer?
That is what they're suggesting needs to be done. Yes, that's exactly right.
Sounds good.
Okay. So they're saying this, and I'll tell you in a little bit about how these third-party promoters are working. So in the example of the TAM, what happened is they did allocate a portion of the purchase price. And again, IRS denied it in that case primarily because they weren't the beneficial owners. They gave us these factors. And what I was saying was, if you look at those factors, the most deduction that you really should be able to take would be the cost of the fertilizer over a couple of years. Because the idea behind you taking the deduction for this farmland that you're purchasing is that, oh, I'm not going to have to fertilize because it's already fertilized. So I'm purchasing this. And so I'm actually purchasing fertilizer already with the farm. So it's kind of like pre-purchasing the fertilizer. The thought is too, if I'm purchasing the farm, I probably can take the deduction using section 180 because any expenses paid or incurred by me during the year, if I'm a farmer, to acquire fertilizer, lime, all of that can be deducted presently under 180. So what happens is a lot of people take this residual deduction. It just goes on Schedule F like you would deduct any other fertilizer. And we haven't had any audits from the IRS that have brought this into the public at all to know what IRS thinks about it outside of this TAM. Now, heirs, if I'm inheriting property, I certainly can't use section 180 because I didn't buy that. But some people who inherit land, if I'm a farmer and if I was not farming the land before, some people are taking this deduction for land that they inherit as well, saying, well, my dad fertilized before he died. Now it's my property. I know the value of the fertilizer. I'm going to attribute it to the value of the land, and I'm going to take an amortization deduction over a couple of years to accommodate the value of that fertilizer that I inherited along with the farmland. And so there's a couple different things, like we just said. You know, you could also do a more hardcore cost segregation approach. So, you know, we have the allocation that we do when we purchase a farm: fence, hog barn, tile, you know, paved lots, whatever it is, all of those assets get assigned a value. But then so fertilizer could be one of those, or you could say, you could make a little bit slightly different argument and treat it like a cost segregation, like you would do if you bought an apartment building and then did a cost seg study to have all this 1245 property taken out. Now, I will say, back when we started this session today, I mentioned that the definition of 1245 property is important because it not only tells you whether or not something is eligible for section 179, it tells you whether it's subject to recapture under those provisions. And that's the provision that somebody asked about this week as one of the companies that does 1031 exchanges. They said, okay, we're having all of these clients that are having soil studies done, and they want to exchange their farm for new farmland. And you all know, since the like-kind exchange rules changed, we cannot trade personal property for personal property. You have to have real property. And you also know that the rules did not change with respect to 1245 recapture. So if I have a farm here that has farmland, and let's say I have a hog barn, a single purpose agricultural building, I can do a like-kind exchange, but I have to have sufficient amounts of 1245 property on this side of the equation in order to absorb the cost basis of the 1245 over here. If I do not, what happens? The rule says I have to recapture all of the ordinary income that would arise from my relinquishing the 1245 property. And so the question was, could residual fertilizer in the farm that I'm acquiring be 1245 property that I could use to absorb the 1245 from the property that I'm exchanging? And after some research, my answer is no, because 1245 property is defined as personal property, tangible property, I should say, not personal, tangible property that is subject to depreciation. And we have no guidance anywhere that fertilizer is depreciable The only guidance we have is that it would be amortizable. So it doesn't look like it's considered to be an asset. Otherwise, we could take section 179 for our fertilizer, and that's not an option. Instead, we have to take 180. So here's what I've seen, and I'm passing this along so that if it happens in your neck of the woods, you're prepared. Clients come to tax professionals with a spreadsheet, and the spreadsheet is something that they paid a company a couple $100 an acre to provide. And so they ended up, if they bought quite a bit of land, they paid this company in multiple thousands of dollars, sometimes 50, 60, sometimes a couple $100,000 to do a soil study. And what the numbers have shown, now mind you, in Iowa, for example, our average land price per acre is $12,000. And some of the spreadsheets that these companies have provided have assigned a value of nutrients of $6,000 an acre. Now, obviously, that is beyond the pale. At that point, you are going into the soil and you're valuing things that are not able to be depreciated or not able to be a deduction because it's not fertilizer. We read what the IRS said. I mean, it's excess fertilizer. You can't amortize land. And at a certain point, these nutrients are just what is comprising the soil. So I say we have to be very careful about what the client presents. If we follow those 4 things where there might be a time for the valid study, and I think in a lot of cases there are, you make sure that you have to pay for an expert to prove that the soil actually has nutrient levels in excess of baseline. What does that mean? It means that they're only there because somebody put hog manure or fertilizer on the land. And then you have to demonstrate through the experts that the excess fertilizer is actually depleting. It's being exhausted over a certain period of time. And what is that period of time? It's how long will it be before you have to fertilize again? Oh, somebody's got a comment.
Again, it would
Yeah.
be a lot easier if those materials, chemicals were in a separate building when we acquired them, so that we
Yeah.
know we had the quantity, we know the quality of them, so forth. We wouldn't have an argument then, but
You are absolutely right.
easier.
Yes, thank you for that. That's a great comment. That's exactly right. That's why too, I mean, I know it's hard, but the way that you could pretty much have an airtight ability to take this is if you work with the seller and the seller's got, they're kind of fighting it because they don't want to have to take ordinary income for part of the purchase price. Because if you're saying that a portion of what you're purchasing is fertilizer, then that's not going to be subject to capital gain, right? So that's why they're worrying about this. But if you could work it out with the seller, that they could give you the history of their fertilization, then you would have more proof and evidence that would be helpful. And then just be consistent. I mean, just the craziness of how people are using this. And then they're still fertilizing. So if you're going to take a residual fertilizer deduction, then you're not going to be fertilizing the next year, because that's the whole point of it, is that you have enough fertilizer that you don't need to. So I just needed to share this with you because, again, it has become such a hot topic, and you'll start probably seeing some brochures, because if these folks do not get audited, I have no doubt they'll just keep on keeping on until they finally get stopped. And of course, they always say, well, we're not tax professionals, but we consult with tax experts. So they have some white papers and things that they've paid for from some tax experts. But then they give these spreadsheets with these really high numbers. And then all they say is, we're not the tax experts. But then clients who've paid thousands of dollars for this study come to you, and then they get very angry. I've talked to lots of tax professionals who get clients very angry if you using due diligence say, I can't take this deduction, this doesn't work, the numbers don't add up. So a couple questions you could ask your client. It's like, so what would be the useful life like if you were really having $6,000 worth of nutrients in the soil per acre? Wouldn't you have to amortize that over like 200 or 300 years? I mean, wouldn't that be how long that would take to deplete? And then the other thing I wanted to point out, here's the other thing these promoters are doing. They're contacting people because they're going through land sale records, and they're contacting people who have sold land up to 8 to 10 years ago. And they're saying you have probably missed a very important deduction because your tax professional didn't know about this. And then they're claiming that you can go back in time with 3115s and take a deduction for the excess fertilizer that you purchased along with that farmland. And I'm saying, if you did not have a soil test done, if you did not have evidence of excess fertilizer back then, how could you possibly prove it now? So again, I see promoters kind of like ERC. I get real nervous when they mess with our clients because our clients believe them. They have lots of letters after their names. So I wanted to point that out.
I have another
And
comment. I have another comment.
yes, good.
Sitting here in West Virginia, we don't see the size of the acreage, but I had a client that had a farm in Nebraska. We might be talking about tens of thousands of acres,
Mhm.
and it could be a lot of money. So
Ab-
having those experts analyze and come up with the numbers on what it's valued at could be astronomical.
You are absolutely right, Jack. And Nebraska is one of those states where they've really been targeting. So I've gotten a lot of calls from Nebraska where they're just sending out mass mailings of their shiny brochures. And so I'm not saying it's not right to take these deductions sometimes, but we have to be very careful. And I don't know how much pasture ground and things that you have, but they've been targeting that too. So they've been sending brochures to people and saying that you can take this deduction if you buy grazing land or pasture ground. And my question is, who fertilizes pasture ground, grazing ground? So it doesn't seem to make any sense. But again, they're just sort of trying to reach everybody they can for the fees that they get to do these studies. So that is one of the big things that has been hot this year. The other thing that we've been seeing a whole lot more of is the research tax credit. And again, this one is valid, so I don't want to suggest it's not, but I'm going to ask you another polling question because I like to know what you all are affected by or what you're hearing in your practice and how this is impacting your clients. So has a promoter approached your client about the research credits? Because farms of all different sizes can be approached by this. And I'm just here again, just to kind of let you know this is going on and to give you the food for thought about what you need to think about. Because I get calls from people from different parts of the country that maybe don't deal with agriculture as much, and they get these things and they're like, you know, seems like this is a valid company. I mean, I looked them up on the internet. They've been around for a long time, but you know, being around a long time doesn't necessarily mean that you're valid. So I'm going to close down the poll. Very good. It looks like not a single one of you has had a promoter approach you. So again, I just want to kind of give you the gist of what's been going on in this area so that if it does happen, you can be prepared. And this is the research credit. And maybe you've used the research credit outside of agriculture for some of your other clients. It's been around a long time. It's been favored by policymakers. It can be fair. It's been one of those provisions that every time we have a new law, sometimes they might slip in kind of a new benefit. And so the last example was the Inflation Reduction Act increased the payroll tax credit that's available for the research credit from $250,000 to $500,000 for those businesses that qualify. And so what this is if you're a business that has gross receipts of less than $5 million and you've been doing this for less than 5 years, then it's like the ERC. It's a payroll tax credit, and we know how that works. That's like money in your pocket, and it's up to $500,000. So interestingly, a lot of the same companies that did ERC are also big into the research tax credit, and some of their work is valid. And then I just worry that other parts of their work are a little too aggressive. And so what is the research credit? Well, we talked earlier today about the fact that we could deduct our research expenses forever under Section 174. And then the Tax Cuts and Jobs Act came along and said, okay, and starting in 22, you have to amortize those over 5 years. So research expenses can be amortized, but the research credit is different. It takes those expenses that are not amortized and it creates a tax credit, and it's based upon increases in research activities. And so the whole point of the credit is to reward companies that seek innovation, increase investment in research, right? I mean, if you think about companies that do scientific research and things, that's what this credit is designed to incentivize. But there's a huge push right now to encourage agricultural producers to take this credit based on different things they might do. So there's a lot of complicated bookkeeping. The alternative simplified credit is really the one that the people that I've seen take it have used. It has much simpler calculations. It's easier to determine whether you're eligible. And so what you would do is you would look at your qualified research expenditures that were more than 50% of your average qualified research expenditures over the prior 3 years. So if you just had an increase in researching activities, you look at your last 3 years, and anything that's 50% more than the activities you have then, the credit is 14%. Now, if you didn't have any in those years, because you weren't in existence, then the credit is 6% of the current tax year. So I had to give you a little bit of idea of just what this credit, how valuable it could be, what it could be worth. But you take this, you calculate it, but what are your qualified research expenditures? That's the big question. So when I get calls from tax professionals who are working with a client that raises livestock, and they're like, well, you know, this company says that my client can get a $100,000 credit. I'm like, based on what? Like, make sure that you know what it is. And so here's what the statute says. It says activities have to be experimental, meaning that they're aimed at developing a new or improved product or process. They have to seek to discover information that's technological in nature. They have to be intended to gain new technical knowledge. They have to entail a process of experimentation that's aimed at developing a better product. Again, this is really scientific research. And that's one of the things that the promoters say is, oh, this doesn't have anything, no white coats, nothing science. No, it is scientific. You might not wear a white coat, but there does have to be scientific research involved. What does not qualify? You can see that list there. It's things that, you know, just assorted things, adapting an existing business process, modifying business components to taste, things like that. Other things that are funded otherwise. But here are the expenses that if you're legitimately doing research, here's the expenses that you can use when you're calculating that 14% credit. You can count the wages and salaries of your employees and any supervisors that are engaged in that research. You can take the supplies and materials that are consumed in that research activity, and you can calculate your credit based on those. And you can include the cost to employ any consultants, engineers, etc. Now, where these third-party companies have been focusing on agriculture is, for example, let's say that you are growing fruit trees. And let's say that you are going to try a new variety of fruit tree. And so you have your trees that you've always grown, and now you're going to plant a new kind of fruit tree. So some of these promoters, so you plant like a new plot of a different variety, and then you just use it in your business. It's just like the other one, it's just different. Some of the promoters would say, oh, well, that's experimentation because you're comparing the new plot with the one you've grown for a long time. So what are your things that you're able to count as expenses? Well, all of the costs of the planting and the seed and the salaries of the people involved and everything. And I'm just like, that I don't think is the research that they're talking about. Now, there are companies that are very large, of course, that develop like seed corn or seed, like actually develop the seeds. Now, those companies will be involved, of course, in valid research to see which apple seed is the best, and they'll have whole teams of people devoted to that research. That's what this is for. I don't think it's for the average farmer that just switches out a different kind of feed to one to the livestock one week and then tries a different feed the next week and says, which one did they seem to do better with? I think we have to have a lot more scientific proof and evidence and design to our experimentation than that. But a lot of this remains to be seen because we do not have a lot of agricultural cases. We do have quite a few cases where the research credit has been denied to businesses outside of agriculture. And I think those cases are helpful to read because they kind of give us, what does a court look for, right? So if you want to read more about it, if it gets to the point where you have a client that is approached by it, I gave you a quick overview now, but just because I wanted you to understand what's going on, what the push is. And then if you get to the point where you have a client, I would suggest you spend some time researching. We do have a couple of pending cases that are in the courts right now that will work their way through, and we might have some new law before too long flowing from those cases. But the last thing I'll say about the promoters, anytime you're working with a company that exists to promote a particular tax benefit, they seem to always oversell whatever it is that they're selling. It was just like ERC. And they will always say, oh, there's all these cases. So in many cases, they'll cite a couple of cases, and then people say, oh, okay, it's established because this case stands for that. I would just say if you have a client that's getting that information, make sure you have them get the actual cases and then you look up and read the cases. And I almost guarantee you that if you read the cases they're citing, they do not stand for the proposition they're cited to stand for. So just be careful on that. Now we're going to go back. Oh, yes.
You brought up a couple of instances where you mentioned tax audits. What are you seeing out in the Midwest? Here in West Virginia, they're almost non-existent. In fact, a lot of our tax seminars, they'll never audit a West Virginia tax farmer, so take whatever losses you can get. Is that pretty much what you're seeing out west?
That is what I'm seeing out west, but it's not what I'm saying because I still tend to say we got to follow the law, whether we're audited or not. But yes, it's a crazy situation. And because of that, it's why we have all these promoters, because they're saying, oh, people have taken this fertility deduction for years. Now let's push the envelope because nobody's going to audit us anyway. And for a while, you know, with the new money that was put into the IRS to increase audits, they did step some things up and they started down that road. But now if you're following all of that, the money that was put in there by the Inflation Reduction Act, $20 billion, has now been taken away to wait and see what Congress is going to do because they want to reallocate that to something else. And so, you know, it might be in the situation where we might not have audits. So, you know, it makes it hard, I think, for tax professionals who are exercising due diligence, because in a lot of ways it feels like you're standing up to this whole movement of the Wild West where anything goes because nobody's audited, so you might as well just do it. But it, you know, if you're an ethical tax professional, you don't do it that way, so it makes things hard. So yeah, I appreciate that, and I do agree. Farmers are almost never ever audited. It's very rare. We do have some audits. I've talked to some professionals on this circuit that have had audits, but I'd say the percentage is very much below 10, very much below like 1%. It's very, very low. So you raise a really good point. All right, chapter 3 of the workbook. And if anybody has a great experience with auditing, chime in, or if you have other thoughts on that, chime in, because this is a great opportunity to just talk about things that you've wanted to talk about. So page 91 in the workbook is a whole chapter, climate smart and conservation tax issues. Couple prefaces to this. This chapter was written when it looked like everything was full bore. Inflation Reduction Act credits were in place. USDA was just showering farmers with money. And it looks to me, we're going to talk through this, like a lot of this will be pulled back, and we'll have to watch and see what happens. But that's part of what we'll talk about today, is what things might stay, what things might be pulled back, and how does it impact the bottom line of our clients. So I do have a polling question. We got to get enough polling questions in here to make sure that you've all got your credit for this big, long day. But do your clients participate in conservation programs through the USDA? So if you could kind of answer that, I'm sure that quite a few of them do, but we'll see based on your answer.
And this is
Give
the
you a
section I'm really interested in and everyone's feedback, because we have one of these climate smart commodity programs through WVU, but we have only just started the application process and won't have more people enrolled until next year. So in 25 and 26, we're going to be rolling out new programs. So if they're not enrolled yet, they might be next year.
So Lisa, what specifically is your project giving the money for? What types of projects are you looking for, or are farmers going to be participating in?
So the project that we have is specifically for those individuals engaged in beef cattle, either for beef or as livestock. And we are doing incentive payments for those folks that are grazing. It is for the implementation of practices on farms, so those production practices. There is money that we're giving to them for reporting purposes. We are giving money out for hosting workshops on their farm. It's all kind of under the same purview of the same project, but that's the focus of that one. And then we've got another one that'll be rolling out in 2026, but that's technically Regional Conservation Partnership Program dollars, not climate smart commodity, but they're going to be similar, where we're still paying for implementation of practices on the farm. It's just broader practices. So that is coming.
So thanks for weighing in. And again, what I'm saying is we got to watch and wait, because I think we're in for a whole new transition to the USDA in terms of what the priorities are going to be. And Congress, as we spent the morning talking about, is going to be scrambling to figure out how they can meet their goal of extending the Tax Cuts and Jobs Act. And so a lot of the discussion along that line has been, a lot of people in Congress then want to repeal portions of the Inflation Reduction Act, pull back some of that money. So there's a lot of uncertainty in this area. So as I said, when I wrote this chapter, it was full bore ahead, all of this money being poured into programs for farmers. And I'm not saying that's going away. I'm just saying things are changing. So we do have to watch out, because the Inflation Reduction Act was a $400 billion investment over 10 years. It was for clean energy, climate smart practices. And there's been a lot of talk with the election and post-election about, the current administration has a different philosophy than the incoming administration, and what that will look like. So I want to start off by giving you an update on where we are with the Farm Bill, because as I mentioned this morning, the Farm Bill expired at the end of September. So Congress has not done its job. We have a Farm Bill that expired actually at the end of 23, but then it was extended through September of 24. And then it was just left to expire at the end of September, knowing that nothing horrible was going to happen. Maybe you can't sign a new CRP contract, but you're going to get paid under existing contracts. The IRA money is still available for the climate smart things that we're talking about. So we'll just wait and see what happens. So now, if you're following the news, Congress has to get some kind of extension to the Farm Bill actually passed by the end of this year, or we're going to go back to that part of the permanent law where dairy prices are set and required to be set at what they were in 1930, and the government has to buy this. I mean, this is a must do. So we'll see what happens with the spending bill, but the farm program, the Farm Bill is a huge part of all this. And when we talk a little bit about that, we're going to talk a little bit more about that IRA funding that came in. Look at that chart there with the yellow. That is IRA funding that was put into conservation programs that are separate from Farm Bill funding. And so what we've been hearing in the Farm Bill negotiations before the election, we were hearing, oh, maybe we'll take the IRA funding, make it part of the permanent baseline for conservation spending. And then we just won't require the conservation practices to be all climate smart. Maybe we'll make it more broad so that if you have manure management, something like that, you can cover those, you can get payments there. That was kind of the approach we were hearing. Now we're hearing the approach that IRA funding that was put in there, we can use that anywhere in the Farm Bill or pull it out altogether. So it's possible that money that has not been spent yet, that was allocated because of the Inflation Reduction Act, could be at risk there. But all the money that was allocated additionally to conservation is specifically allocated for climate smart activities, not just traditional conservation practices. And so the definition of that is directly improve soil carbon, reduce nitrogen loss, reduce capture or avoid or sequester carbon dioxide, etc. So that's what all of this money was put into. $17 billion of extra funding for USDA programs, which is in addition to a lot of other programs like Lisa mentioned that were already sort of being funded by USDA. But again, all of this could change. But right now, an additional $8 billion for extra contracts in EQIP, $3.1 billion for conservation stewardship, $1.3 billion for agricultural conservation easements, the Regional Conservation Partnership Program, $4.7 billion of additional funds for that. That's things like the type of project Lisa talked about, even though her money came in before the IRA, so it was under the different project. But those are the types of things that we've seen funding everywhere from the USDA. And the money has, in many cases, been going to partners, not to farmers directly. And then those partners are paying farmers to implement different practices. So that's something different than what we've really seen in the past, where the money comes straight from USDA. Now, in all cases, we're going to talk about that money that farmers receive being income, but we're also going to talk about how we handle that on the tax return in terms of benefits that might be available. But with the USDA programs that are funded by IRA money, Inflation Reduction Act money, and again, this is part of what the negotiations of the Farm Bill is going to incorporate, it only covers eligible climate smart practices. So those include cover crops, crop rotation, filter strips, grass waterways, mulching, field borders, tillage management, all that. Are some traditional conservation programs ineligible for the Inflation Reduction Act money? That's what I want to ask this polling question. And when I ask this, I'm also going to read the comments in the question box to see what's there, because I can't do it all at once. So here we go. Launch that and see what you think. So while you answer that polling question, I'm going to see if I can get in the chat and see if there's, oh, that's a Climate Smart Commodity Program. All of it has been contracted. Yep. So a lot of that is already out there. But again, there's a lot at risk of money that was allocated for down the road ahead. All right, so did you get your polling question answered? It looks like yes, and that is what the majority of you said, and that is the correct answer. The restrictions on activities include things like manure management, terrace management, irrigation efficiency, traditional wildlife habitat activities, waste storage, all those things. Those are not climate smart activities. Those are not eligible for the new dollars. So here again is that chart. With that Farm Bill extension, we've got to watch to see if Congress actually gets that into the spending bill by the end of this year. And I'm sure they will extend it. But then when they're negotiating the new Farm Bill, we have to see what they do. They might eliminate the IRA funds entirely. That's what the House Majority Leader actually said this last week. So we're just watching and waiting to see what will happen. In the meantime, let's just kind of remind ourselves of what happens when because there is all this money. We're going to have a lot of clients who receive it. And so we do need to know what the type of tax implications are for the money that we receive. And so it's all going to depend on the type of activity, the way it was funded, whether I'm a farmer, whether I'm a crop share landlord, whatever I am. The bottom line to start is that all payments that we receive are income, right? That's the place to start. Now, we might not land there. We might actually be in a place where we do not have income from something because it's excluded. But the starting place under Section 61 of the tax code is always it's an accession to wealth, it's income. And that's the way it is with USDA funds, right? So if we receive money through the USDA programs for any of these things, it's generally going to be reported on our Schedule F as income under a government payment. We'll usually receive a 1099-G for most of these programs. So 2025, Grayson's a farmer. He received 1099-G, reporting an $8,500 payment from the USDA. It was made through the CSP program because he engaged in these climate smart practices. He reports the income on lines 4A and 4B of Schedule F. So it's reported just like farming income. Now, any of these expenses that we incur as part of our climate smart or conservation activities, we have to ask if they're ordinary and necessary and presently deductible. Maybe they're depreciable. Maybe they're have to be capitalized. This is where people get a little bit confused. Our clients certainly get confused, and we have to be the ones to tell them how this all works. So some of these expenses, they're presently deductible because they're Section 162 expenses, which is great. In order to deduct these things, though, they can't be incurred to improve depreciable property. It has to be actually a business expense that takes place in the year. And so the examples here would be if I plant a cover crop, if I clear brush, but it's routine. Unfortunately, if I just clear out a whole windbreak for something, and that's not very climate smart probably, but sometimes I have to do that in order to get some new vegetation going. That will not be routine, and that is not deductible. That's probably one of the biggest issues people misstep on is they think that clearing land is deductible. Well, it was years ago, but that provision is long gone. And you have to add the cost of that generally to the basis of the land. And then any interest that you incur associated, you can presently deduct. But let's just look at the example on 95. Marty raises corn. She receives $25 per acre cost share payment through a government program. Her total expenses were $32 an acre. So what happens with Marty? Well, this could be anything. It could be, specialty crops in West Virginia where you get a cost share payment and you just look at your expenses and how you would normally handle them. So here her expenses were $32 an acre, which she can deduct because those are present 162 expenses. So she can deduct those expenses this year. but she has to include the entire cost share payment in income because she's deducting the associated expenses. So that income is reported on 1040 Schedule F lines 4A and 4B. The next category of expenses that we often incur with implementing some of these practices. So remember what might happen. You might receive money from one of Lisa's projects, right? That you get money, that money's going to be income, but then it's like, okay, what tax benefits can I have associated with that? And so sometimes we have depreciable expenses. And what that means is obviously that whatever it is that we're installing is going to have a useful life longer than a year. And so if I have to purchase some sort of structure, like an anaerobic digester, something like that, I'm going to incur depreciable expenses. So the one thing too that sometimes our clients don't understand is that if you're building an earthen structure, a terrace, that is not depreciable. A pond, not depreciable. What about bioreactors? I don't know if you have many of those, but those are ways to filter out nutrients and filter out harmful composition in the water that's flowing over the land and have clean water come out at the end. So you have all these wood chips and things like that. So that's just an example of a depreciable item that I might get a cost share payment to build one of these. And I would then get to take an associated depreciation deduction over 15 years. Probably would get to take Section 179 for that too. What about an anaerobic digester for a livestock producer? You know, there's a lot of uses for those right now, not just implementing traditional manure management, but in taking this and then converting it to biogas. And so the thrust behind a lot of these things has been new tax credits to say, oh, if I'm producing biogas, I get a clean fuel credit. Or if I, you know, so there's lots of extra tax credits in addition to like the investment tax credit that you can do. And then there's also some of these structures where farmers aren't necessarily putting up their own anaerobic digesters unless they're very large, but they can be part of the value chain where there's a group maybe gets funding to install anaerobic digesters, and then farmers bring their manure and get paid for it. So again, it's something supplemental income. In that case, that payment of the selling of the manure to the company that has the anaerobic digester that's turning that into ultimately renewable natural gas, it's going to be income on the Schedule F. It's going to be the sale of a commodity. That manure is the sale of a farm product. Now, if I am taking the manure and I myself am converting it into biogas, then all of a sudden I'm like, okay, is my biogas generation activity farming? And in that case, I'd say no. So, right. So we have that issue too. Sometimes if you've got a client that's into the creative side of it, you might end up with two trades or businesses. You've got your farming trader business that sells the manure to the anaerobic digester business that is creating the biogas and selling that. And so we have to look at how all that works. But question, does anybody know what the class life of an anaerobic digester is? This is probably the weirdest polling question of the day, but hey, you're on your last 25 minutes. So in the last 25 minutes, we have a little leeway to ask weird questions. So what do you think? Just take a guess. We'll give you the answer in a minute. I should have asked you if you have any clients that are participating in any sort of activities that involve an anaerobic digester. That might have been more interesting. All right, I'm going to close down the poll and keep going here. And so if you place an anaerobic digester into service, it has a 7-year life. If the biogas is used to produce electricity, then the person who's creating that electricity might be eligible for the production tax credit. If the producer doesn't burn off the biogas, they might be eligible for the investment tax credit. So you see all these Inflation Reduction Act credits converge on something like an anaerobic digester to say there's a lot of money out there right now for these projects, which is why we've seen a lot more of them come up. Other cases, like I said, the producer might sell the manure. The other thing they're working to do is to have the digester take crop residue. And you could take any sort of residue that you have on your land and you could put that into the digester and you could get paid for that as well. What about if you plant a cover crop or you plant prairie grasses? The idea is, okay, there's certain times when you actually have to harvest that cover crop. What if you harvest it to put it into an anaerobic digester? Or what if you cut the prairie grass at certain times when you're, instead of burning it, and put it into an anaerobic digester? So again, there's a lot of people that have been working on trying to find alternative income streams for small and large farmers alike in this area. But again, things are evolving now. A little more uncertain than they were a couple months ago in this space. Now, we talked about presently deductible under Section 162. The second thing sometimes is some of these projects give us a depreciation deduction because we're creating something that's depreciable. The third thing that we have under the tax code is some of these projects, some of these things that we're doing. If I'm a farmer, I actually get to deduct the cost of implementing them under Section 175. So let's say that I get a payment from one of these regional programs, kind of like the type that Lisa talked about, but let's say that my program is going to pay me to plant grassed waterways or prairie strips, or to have filter strips or field borders, or do cool things to have wild flowers so that there's more absorption of carbon and those types of things. So if I do that, what would my normal tax consequence be? Would I get to take a tax deduction for establishing a row of trees or grassed waterways or any of that stuff? No, that's why we needed to have Section 175, because the tax code gave us no incentive to do these things. This goes all the way back to with soil conservation. The idea is, oh, we need to have terracing and things. And the farmers are like, yeah, we need to have terracing and things, but I can't afford to do this. And you're not giving me any tax deduction for doing it. So I'm paying all this money and I get no deduction. So what are you going to do? And so way back during the time of soil conservation, Congress passed Section 175 to say, okay, if you are engaged in the business of farming, you can currently deduct expenses that you pay for the purpose of soil and water conservation used on land used in farming, or to prevent the erosion of land, or for endangered species recovery. I put a lot of examples over there on the right. A couple of limitations is the deduction is limited to 25% of your gross income from farming. You truly have to be a farmer. Also, with the push for climate smart practices, and climate smart is a concept that came about way after the concept of soil conservation. So the question is, does Section 175 apply to all climate smart practices? And I think in most cases it does, because these are all going to be, you have to implement it according to an NRCS plan, but all those practices that I talked about, like filter strips and grass waterways and all that, they're specifically listed in the USDA document of climate smart agricultural practices as soil health practices. So if it's a soil health practice, it should be covered by the soil conservation deduction. Now, remember that you can only use section 175 for non-depreciable items. And so you can't use it for anything you would otherwise be able to depreciate. But if I am part of an NRCS plan that includes planting rows of trees and a pond and all of that, if I don't have section 175, I'm going to have to take the cost of all of that and just add it to the basis of my land because that's not depreciable. So that's where section 175 is really helpful, but I do have to be engaged in the business of farming. And engaged in the business of farming means I can even be a crop share or a livestock share landowner. So if you're engaged in a lease where you have a share of the livestock that are raised on your ground, and then you are a farmer for purposes of 175. But if you're cash renting your land to somebody that's grazing cattle, you are not eligible for section 175. So what does that mean? Well, it means this. Example 3.3 on page 98. We have Ronald, he's a retired farmer, he cash rents his farm. Now, some of these numbers, again, they're different than what you have. His 600-acre farm might be attributable, same rule. If you're talking about a 50-acre pasture in West Virginia, he doesn't materially participate in farm. He just rents his pasture out for cash. Same thing. Let's say that he spends money to establish some kind of climate smart practice. Here, it's to establish grassed waterways on his farm. It could be planting prairie. It could be any of these things that, if done pursuant to an NRCS plan, would give a farmer a section 175 deduction. But here, he's not a farmer. So what does it mean? It means that he has to add the cost of that expense to the basis of his land. He gets no tax benefit. Now, if he had entered into a non-materially participating crop share lease, or in the case of the pasture, maybe a livestock share lease, he would be a farmer. He would be eligible. In order to take section 175, the land has to be currently used in farming. If I buy new land that hasn't been used in farming, I do not get to use section 175 to prepare the land for farming. So that is unfortunate about this provision as well. So there's examples in your book galore. There's all kinds of examples on page 99 that come straight from the regulations if you want to understand that a little bit more. And then again, this section 175 deduction is limited to 25% of your gross income from farming. If the expenses are within the limit, the farmer deducts all of the expenses. And so for the purpose of section 175, what does gross income from farming include? It includes income from the sale of the production of our agricultural products, our fruits, our animals, our livestock, all that. It does not include gain from the sale of farm machinery or gain from the sale of land. So that can trip it up, especially in these days of no like-kind exchange for the sale, for the trading of personal property. That results in a lot of gain because we're not rolling it forward with 1031. So we have a lot more gain that's recognized in our gross income, which means that a lot fewer farmers will qualify for that. You don't get to count that when you're calculating your 25%. So here's an example on page 100. Perry's a cash method farmer. Here's the income he has: proceeds from the sale of corn, gain from the sale of his cold breeding heifers, gain from the sale of a tractor, gain from the sale of farmland, and interest on a loan he made to a neighboring farmer. And you can see here only the sale of corn and the sale of the cold heifers is gain from the sale of is farm income for purposes of the 25% limit. All right, we're getting close to the end here on this. I'm going to ask you another polling question. Again, I like to give you enough polling questions so that if you missed a couple, you're not going to be penalized for your credit, because again, you sat through this, you deserve your credit. So this one you should know based upon what we just talked about. Does gain from the sale of equipment count for purposes of the 25% limit? So give you a few seconds to weigh in on that, and need a couple more of you to vote. And the answer is no, it does not. Gain from the sale of livestock that is held for draft, breeding, or dairy counts, but gain from the sale of equipment does not count, nor does gain from the sale of farmland. Now, if you do have a carryover, you can carry that over to future years. We're not going to go into all those examples. Again, this is an election to choose to take the Section 175 deduction if you qualify. No IRS approval is required. You just take it in the first year that you qualify, and you have to keep going by that method unless you decide that you want to change methods. In that case, you do have to submit a signed written request by the due date of the return for the first tax year when you want the new method. You don't file a Form 3115, nothing like that. It's not a private letter ruling. It's pretty straightforward, but you do have to tell the IRS what you're doing, and there's an address there that you're supposed to send that to. If you sell your property after you've taken the Section 175 deduction, during a 10-year period, there's recapture that's according to a particular schedule right there. You can see how that works. So that is the deductions that we can take for Section 162, for depreciation, for Section 175. And then the idea that if we don't qualify for any of that, what do we do with the cost? We have to add it to the basis of our land. But sometimes we get these cost share payments, right? Like what we talked about. Government might pay money. So most of the time, if it comes from a private company, it's going to be income, and then we're going to hopefully have an offset. But sometimes if we receive a payment, Section 126 will allow us to exclude the value of that cost share payment. And where this comes in handy is if the allowable depreciation for something might be less than the cost sharing payment we receive, right? So, okay, I'm willing to do this for the good of the cause. You're giving me a cost share payment, but I'm actually losing money on this because I can't take adequate depreciation to compensate for the cost to me. And so this isn't for my business. I'm doing it for the good of society. So here, 126 sometimes steps in to give an exclusion from income. Also, it's important to note, if I'm a non-farmer, like Ronald was in my example, where he's a cash rent farmer, he might be eligible for some income exclusion from cost share payments if he meets the requirements. So I will point out that that section of the book, 105, 106, gives a very thorough example about how to calculate cost share. But if I tried to walk through that example at this part of the program, I think we'd all roll our eyes to the back of the heads. So I'm going to skip some of this. I want to make sure we only have a little bit of time, and I want to make sure that we cover the things that I think might be of most interest to you in this chapter. If you turn to page 109, I will show you this little chart that we have in here that might be helpful. It's just a chart that tells you what is the practice that is climate smart practice, like conservation, easements, CRP, cover crops, all that sort of thing. And then what is the tax treatment to the producer or the landowner? And then finally, what if you get payments from outside sources? What about the cost sharing? If it qualifies, do we get to exclude it? And so that chart seeks to help to kind of make things a little more efficient when you're analyzing those questions. So I got another polling. Again, this is more like feedback than anything else, because I like to hear and have you answer. But I'm just going to ask you if you've heard of the 45Z credit. So my screen says, has anybody asked you about it? I'm just asking you, have you heard of the 45Z tax credit? Curious if any of you have heard about it. It's just sort of a section that we're going to move into where I'm going to kind of give you an update of what's going on with some of these tax credits that are coming through the IRA that have been in the news talked to about farmers. So, okay, it looks like not a single person has heard of it, which is actually good because I just want to give you a quick review of what's going on. This is flowing from the idea that with all of the tax credits that the Inflation Production Reduction Act provided, it has opened up a whole bunch of supplemental income opportunities for farmers. I mean, all across the board. We already talked about the anaerobic digesters, but we also have all kinds of other options of projects that are cropping up where groups, even like the one Lisa was talking about, are paying farmers specific amounts of money to implement certain practices or giving them an income opportunity outside of the farm. For example, I have a picture here. That is a CO2 pipeline, a carbon dioxide capture pipeline. And in the Midwest right now, we are in the middle of figuring out if there is going to be a carbon capture pipeline connecting the ethanol and biofuel plants that exist in the Midwest that create fuel from all of the corn and soybeans that are raised. And one of the things, if you're going to create fuel, you're emitting a lot of carbon into the air. You may be using a bio material like corn or soybeans, but the production of it is emitting a lot of carbon into the atmosphere. So the greenhouse gases are being emitted. So the score of your carbon intensity score might be fairly high. So you might not qualify for some of the credits and things. So the idea is, oh, what if we capture the carbon that's emitted from the production of the ethanol, and we ship that in a pipeline under the ground, and we sequester it in the ground in North Dakota. Okay, so that's what's going on in the Midwest, right? As you all are looking at different things in West Virginia, but it's the same concept that what happens is all the landowners that are in the path of this so-called pipeline, which has gotten a permit in Iowa. It's not being built yet because it also has to be approved in North Dakota and South Dakota. And it's also relying on the fact that there are tax credits for the sequestration of carbon that might be at risk, and there are tax credits for the production of the biofuels that might be at risk. So I think the whole thing is a little bit riskier, but I'll tell you, this company that's trying to build this pipeline has spent millions and millions of dollars buying easements from farmers who own the land, and they just flat out bought the easements. So our farmers have sold easements. So again, another income opportunity. And the clean fuel production credit is the credit that has promoted a lot of this, because the idea is if I'm producing clean fuel, so I'm producing it from corn or soybeans, it's biofuels, then I'm going to get a special tax credit from the Inflation Reduction Act. But I'll tell you an IRS story. And the IRS story is that this credit, of course, went into effect in August of 22, like in terms of that's when the Inflation Reduction Act was passed. But the 45Z tax credit is not supposed to go into effect until January of 2025. But do you know that the IRS has not issued guidance yet on how the 45Z credit will be calculated? And they just announced last week that they won't until before the end of the year. And so that's been the difficulty. And the reason why I'm talking about this in the agricultural class isn't because the fuel is made from corn and soybeans. It's because what this credit was doing was looking, and we don't have the guidance yet, but a predecessor credit, the USDA issued the first guidance ever that said, okay, a fuel producer over here is going to get a higher credit if they purchase their feedstocks, which feedstocks could be from any source. It could be from anything grown anywhere, not just corn and soybeans, from farmers who implement certain climate smart practices. And so this made big news. If you just look at 45Z, all the farm pubs across the country were talking about it, because the idea is, oh, are farmers going to be able to get a premium price for selling different things to companies that are getting tax credits for producing clean fuel. And so that's just another piece of the puzzle. Your book talks about electricity produced from renewable sources. That starts on page 115. If you have a client that puts solar panels on a hog barn or a poultry barn or something like that, they are most likely eligible for an investment tax credit. And I'm going to ask the last polling question here, and I am really curious about this answer, and that is, do you have clients? Hold on. You'd think I'd have it down by now, right? That might be the last one. We might be out of polling questions, so I guess I don't have to ask it. I'm curious if you have seen an increase in solar and wind use. Oh, there we go, Lisa. You're the
I
best.
found it.
Are you seeing an increase in solar and wind among your clients? And just curious if you've seen that. And if so, you know, on your end, there are all of these tax credits that are available. The book goes through a pretty thorough review of how those work. If it's a production tax credit, it's where the amount of electricity that you're generating goes beyond what you need for your farm or your house. And if you're selling it back to the grid, you might be eligible for the production tax credit. The book shows how that works, where it's reported. If you are just investing in solar or wind to power your business, then there's a tax credit for that. The investment tax credit, it's a 30% credit. So again, all of this is out there for now. We'll see what happens. It does look like there might be some question or chats in the chat box. See if there's anything directed to me.
Oh, I just had a comment that solar
Oh,
and
good.
wind is pretty
Yeah.
regionalized, so that might indicate, depending on where people are, yes or no.
Yeah, no, that's helpful. So all that saying, where did I get this Microsoft Teams pop up? It's telling me that we're done with this class almost, but I just want to kind of get to the end of showing you what else we have in the book here. All these things are eligible: energy, property. Of course, the big people are eligible for these credits, but don't forget that our smaller farms are too. There's an example there in the book about a dairy that's eligible for the production tax credit, a swine company that's eligible for the other. There's the carbon oxide sequestration credit. The crazy thing about the credits is this carbon pipeline, the credit that is been raised to be a really large amount, it is refundable. It's fully refundable. Like, you don't have to have any income in order to receive it. And so most of the credits are not refundable, but they are tradable. So somebody else can purchase the credit if they have tax liability and you do not. And that's what this direct pay and transfer talks about. So the last section of the workbook talks about carbon credits. That's nothing new. It has gotten a lot more competition though from all the payments from these programs. And again, as you know, you can't sell a carbon credit if you're getting money from other programs. So the future of all that, we're not sure. The book does explain how the USDA is involved now in all of that. There's going to be basically new standards and everything. So all I can say on all of the climate smart issues is stay tuned. I think you're important advisors for your clients, but I'll stay on a minute if anybody has any questions. Otherwise, I want to thank you so much for sitting through this day of agricultural tax, and I hope that it was somewhat worthwhile for you. Reach out to me anytime by email. You have my information in the slides if you have things you want to follow up on or other issues that we didn't touch on today that are important in your business. I always love to talk to professionals from other parts of the country, and it was great to spend the day with you. So thank you, Lisa, and thank you everybody online.